Well, we're up about 0.5% from the 30-day lows, but we're still making a series of lower highs and lower lows. Where you could argue that we're forming a downward channel beginning with those 30-day highs. And this chart is looking at a 30-day 1 hour increment here. And it's been a notable slide since then. We did have a bit of a rally within the past couple days here. Past couple trading days, excuse me, but it's fizzled out pretty convincingly and took us down into new 30-day lows. So the 2 points to watch on this chart
really quickly. Let me get this out the way in case you're catching this in the replay. Good morning, my name is Sandra, and welcome to my channel From Lack to Legacy. On this channel, we're all things money, investing, and mindset, particularly how to go from a scarcity mindset to a mindset of abundance. If that sounds like something that you might like, you're in the right place. We are a community of traders. I am a new trader, a very novice trader. I've been trading for less than 6 months. And everybody's here. People who have never traded before, and we have experts in our community as well. So everybody's welcome, 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 welcome. So hey everybody, I know I saw Tara and Marilyn. Marilyn, thank you. Marilyn always sends some important, wonderful, easily digestible, current, intel. So check the community tab, you guys. It's good stuff. Good stuff on the community tab. In particular, a video by Chris Sane about Tesla today. So guess what? We'll be watching Tesla. So the Fed announcement is at 9 o'clock, and I need to continue to prep. So I will turn this up, and I will get prepping.
And really what you're looking for is a breakout beyond either of the two trend lines. We have a sharper trend line going across the highs, a shallower trend line going across the lows, and what you'd want to see is a move beyond either of those.
Good morning.
That would be convincing,
good morning,
a big
everybody.
breakout in either direction.
Okay, let me go look over here and see what's happening.
I was going to say, as I look at this, it's not only the trend lines that are narrowing, but also
orders, which have been made so much easier. Because I know how to set up a template now, thanks
right near
to
104, just above that point, we've got our yellow 21-day exponential moving
Yes,
average, our
help me,
purple
Frank
252-day exponential moving average
Johnny
converging
and
near the
everybody.
same spot.
Many
We've
people.
also got the 103.60 level is something I had my eye on because that's the highs from early May and the lows from early June. That's our red dashed line there. The lows that I was looking out for,
3 more minutes to the
green
Fed
dashed line, that's our
announcement.
old lows from May. So a couple
I think it's
sources
supposed
of
to be at
support and
9,
resistance to
so
monitor as well
we'll
in
see.
this product.
Rick, as I look at this chart
be
here,
waiting.
screaming out is that divergence we're seeing as we post a new low in price, but it looks like the bottom study there, that RSI is not participating, it's lagging a bit.
Yeah, and that could be another positive sign for bulls in this product. We've got typically more bullish pattern, and we've got this bullish divergence in the RSI here. RSI trending upward while price trending downward. That could be the precursor to an upswing in this product.
All right. Closely, Rick Ducat, appreciate you bringing it to our attention today. That's our show. Thanks for joining us to talk futures here on the TD Ameritrade Network. Stick around, still lots to come. Oliver Rennick, Morning Trade Live, headed your way next.
I like TD Ameritrade's news.
Opportunities can be hard to find, like catching lightning in a bottle. In uncertain times, it's tempting to retreat or simply wait and see. At CME Group, we empower those who act. We deliver tools to help manage risk and capture opportunities in every market climate, across every major asset class, to seize each possibility at precisely the right moment. CME Group, opportunity is everywhere.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is, how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of applied volatility could help the trader choose between them. We also introduced strategies designed to harness changes in implied volatility. For instance, time spreads like counters and diagonals are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the education tab on Thinkorswim for the full options for
I wish there
volatility
was
course
some way
and a whole
you
lot
could
more.
delete multiple orders from your saved orders place space. Maybe somebody knows how to do that. Because I don't.
In Wall Street, bringing you in-depth market coverage and real-time trade ideas. Do not miss our exclusive interviews with CEOs, bell ringers, traders, and stock pickers, keeping you informed as you navigate your investments. Don't miss Trading 360 at 11 a.m. Eastern and the watch list at 2 p.m. Eastern, live from the New York Stock Exchange, only on the TD Ameritrade Network.
Every time I delete it, the tray goes back
We empower
down.
those who act. Those who see the correlation between things above and things below the surface. Those who navigate risk by meeting every turn with a heightened awareness of what's possible. Constant assessment. Determine the best position. Catch the perfect wave.
Hey, everybody.
Where risk meets
Good
opportunity.
morning. Good morning. Good morning. I think the Fed chair announcement should be happening like now.
Good morning and welcome to Morning Trade Live. It's Tuesday and we await the Fed chair's speech this morning, coming up pretty soon here, basically any minute. Futures are down. We got a pretty hard fade yesterday after a real strong start to the week, so this could be pretty interesting. We got some interesting stock stories to talk about, a lot of analyst notes out, a couple of interesting company-specific news
Tesla
items making
contracts
headlines.
And
But mostly this is a
contracts.
macro-focused
For
morning,
today.
as the stock market has been dragged by tech down over the last few weeks. The NASDAQ is very close to those lows. So there's definitely some tension here. Bonds and the dollar have been a little bit mixed. Some of our very reliable relationships from the inflation regime of 2022 have started to fray a bit. That's made it very difficult for traders. So we'll see how this morning goes. After last week, we saw kind of a classic reversion back to the bad is good regime, where a bad ISM services on Friday started an almost 2-day rally, but we lost it yesterday afternoon. Maybe chalk it up to some jitters ahead of Powell today. Maybe just chalk it up to reality setting in, where the yield curve continues to make lows. Bond yields are generally getting inverted across the curve, and the message of recession seems to be getting louder. Futures right now, kind of chopping around, a little bit up from the morning as we look at the response to the text of Powell's speech today. We do have rates up. Yields are a little bit higher this morning. Bonds selling off.
Hey,
Dollar is
Al.
higher
Hey,
here,
everybody.
up to about 40 pips.
Up Wonderlust.
Let's look at the
That is
chart to
such
see
a
where we
cute
sit right
name.
now. The 10-year yield is at an interesting spot.
I am
About
learning everybody's
3.5%,
names
a little
now,
bit
y'all.
above that right now.
Like
This has
government
been an
names.
important level. Goes back to the summer of last year. 3.5 was the high,
let me
and then
get
it
back to my
acted
grind.
as
I'm picking
yield
contracts. I got
support
Tesla, a
most
call, and a
recently,
put.
where at
Already-
the close of last year, we got quite a bit of trading.
Already in my tray, my template that
and now we settled back onto it.
the community taught me how to
It's a real
do.
good way
So
to describe the
that makes
10-year
me feel
chart right
good.
now.
So now I'm going to do the
Zoom
same
way
thing for
back Over
QQQ.
the year, you could argue we're still
I always
up
start out
trending,
with
but in the short term,
you know,
there's been quite
those
a bit of
things
pressure on
already
yields
queued up
and quite a bit of strength
so
in
that I
bond
don't waste any
prices.
time
And so this
trying to
chart's
figure
kinda
out what
middling
contract.
right now. What's
I'm
interesting
sure
is if you
everybody
look at
does
the
it like
dollar,
that.
the dollar has a little bit more
Because
conviction.
why wouldn't you?
Remember, over the last 18 months, rates in the
So
dollar moved in the same
QQQ dropped
direction. Yields go
quite
up,
a bit
dollar went up. Very
overnight.
reliable, That was the
But then
inflation
she's
regime.
going right
Surprisingly high
back
inflation, surprisingly
to
hawkish Fed.
270.
Bonds sell off really hard,
Whatever.
dollar goes up,
I
yields
think
go
that
higher.
270, which
Now that
was
relationship is
formerly
starting
a
to break a little bit
support,
because while the 10-year is somewhat
is now
directionless
going
around
to be
3.5%,
resistance.
dollar is
I'm
not.
looking at
We
it.
continue to make lows in the dollar here. And the
But I better
short-term
get over
basis, we're
here.
very clearly trending lower in the dollar.
Yeah.
To me, the stagflationary
We'll
macro
see.
regime
We'll see.
probably looks
We'll
something
see
like
if
a
it's
lower
now going
dollar,
to serve
but
as
higher or sticky
resistance
yields.
because it was support
Because if we
yesterday.
have inflation remaining at a
And I
level
was
that's
hoping that
still
it would break
painful for
through,
the
and
economy,
it did overnight. And so we'll see how the Fed chair
It's gonna be hard to
announcement
get yields to go too
affects
far
the
down,
markets
even if the
because
economy
it
slows
will
down.
affect the
But the
markets.
dollar might,
We'll
because
be
if
here
we've
to watch it
lost
all
the
in living
momentum
color.
from an
Those are
economy
usually
coming out
some,
of
well, I don't
COVID,
know.
leading
That last one
the
was pretty
global
volatile. We
recovery,
made a little
which
money
we
that
were,
day,
and
but I
thus
got caught
also
up.
leading the
Mm.
central bank
I made
tightening,
it out though.
that dollar could start to soften. In my view, if we have the
So
yield
let
curve
me
continuing to
see.
compress, which we do, that's clearly a sign of
Let me
economic
get over
risk.
here
And then if the
and
dollar
get
starts to
these
slide,
QQQ
but interest
contracts.
rates remain fairly elevated, that's probably telling us that the Fed's going to still have to be aggressive and stay alert to inflation risk even as the economy slows. That's probably the worst case outcome, even compared to last year. There's a lot of focus on inflation peaking, which it looks like it is. But right now, I would argue the elevation of inflation is more important. Inflation as an output of right now, Kev. Nothing really here that's addressing policy so much, more about their role in avoiding over politicizing the Fed and remaining an independent body tied to, of course, their mandate, to which he says they will stick to it. I guess unless there's any Swedish questions, there's nothing really here that's going to derail, I think, any of the narrative, whether bullish, bearish, hawkish, dovish. I mean, the idea that they're going to stick to the mandate here is pretty standard. It's a pretty vanilla commentary so far. I think that's probably why you got futures popping.
I don't expect Jerome Powell, Oliver, I don't expect Jerome Powell to go over to Stockholm and make any groundbreaking announcements over there. I expect him to stay on topic, as frankly, Oliver, all the members of the FOMC have stayed on topic. They're fighting inflation. The good news is they've got a labor force participation rate that ticked up. They've got an unemployment rate that ticked down. Leisure and hospitality is buoying the labor market, Oliver, even though as high-profile companies announcing layoffs. So
he is passionate about this news this morning.
Fourth-quarter earnings are going to be real interesting as everyone seems to be ratcheting down expectations. Boeing just got a downgrade today after their run, but that stock was way overbought.
We're hoping the Fed announcement makes some kind
really
of
surprising
movement.
there. But overall, Oliver, this market is trying to digest all the surprise
so
information we got last Friday.
Here?
That rally lasted about a day and what seemed like a few minutes, Oliver, right? By midday yesterday, a lot of that rally that was overnight, Sunday night and Monday, was gone. So this market is back to dealing with the jobs data, the expectations, CPI data coming out on Thursday. That'll be significant as well. So a lot going on coming up in the back end of this week, Oliver.
That's the highlight for sure here. As there's no revelatory commentary from Powell.
And it's
obviously the focus
jungle
shifts then to CPI.
Slightly.
To your point yesterday, the hard fade that we got didn't seem like there was really much rhyme or reason. So I'm not sure that a lack of new language from Powell necessarily puts us in the clear. There was no language yesterday, and we decided to just get it out. So it's going to be an interesting day to kind of see where we go without any real catalyst at this point. When I was watching the future show, and Jenny was talking about the Coinbase cuts. There's a lot more the same here in terms of the overall narrative for employment and jobs. So I think whatever the market had in mind yesterday for Powell and the worries, I don't think they go anywhere until inflation gives us a clear.
Yeah, exactly right, Oliver. If you're looking at the overall news today, Jerome Powell, I expect his comments to be benign. You're looking at a higher U.S. dollar.
No, it shot up at 8:30 though, so that was before he started speaking.
That should drive us in the morning. The overnight markets. Now we'll see at 8:30 Chicago time, 9:30 Eastern, how the markets open, and then we're off to the races, Oliver.
Okay, all right. Thank you, Kevin Hanks, host of Fast Market. Let's talk more stocks on the move this morning with Renita Young, our senior markets correspondent, here with me in studio.
Good morning, everybody.
On I think its own specific news.
It is always a beautiful day. I'm telling you. Oh, I gotta do my thing. What I'm grateful for.
Speaking of independence.
Speaking of independence, so Apple was negative a little bit earlier. Now it's flipped positive, and
it's
because Apple is strengthening that push to produce its chips in-house, and it's saying now that it wants to take out one of Broadcom's components as well as components from Qualcomm. Both of those shares, Broadcom and Qualcomm, are falling in the pre-market, and it wants to do this by 2025. This is on a report from Bloomberg, citing sources familiar with the matter, of course. But this is significant because we've certainly seen through the 2018 U.S.-China trade war a push to get more American products produced in America and more products produced in the countries of origin, right? And if that didn't really tip the scales, the pandemic did with the supply chain issues. So we're seeing Apple really strengthening that push right now, and companies wanting to become more independent on their own.
It's a pretty big deal. Possibly a bigger deal for Broadcom than Apple right now in the short term. But obviously this could be very positive for Apple in the long term. Try to insulate yourself from third party supply chain risk. Maybe try and bring costs lower. Could be a big factor for them over the long term. In the short term, though, the fact that we're selling off on this after generally this has been talked about and expected, tells me that it's a pretty big deal. I mean, this has been talked about for a while. So the fact that we're still getting hit on the confirmation of this news, maybe this timeline is a little bit faster than what investors expected.
I think so. And so now that we've put a date to it, right? So these sources of Bloomberg, they say between 2024 and 2025, they expect Apple to have its own cellular modem chip by the end of 2024 and early 2025. So that's right around the corner.
It is. I know. It sounds like it's a far ways away, but this is 2023.
Right.
Coming up pretty soon here, and Apple making its own chips in a pretty full extent. On the opposite end of the spectrum this morning, let's talk a little merger activity.
Oh, wait a minute. Whoa. Maybe that's why. Because I was on TD Ameritrade. I was going to say something.
It does work that way if they can actually build a case that goes beyond, sure. Or there's somebody else of great interest. We don't know that, though, Jim, at all. But we have no sense for that. Right now, the case that's been built is certainly against Sam Bankman-Fried. It does appear the government has a number of key witnesses. Right. They're going to bolster its ability to bring a very forceful case, but we'll see how his defense plays
right up
out.
to support at 270. Well, now, maybe resistance, I'm sure.
Okay, which a
Which
lot
is
of
coming
people
from
dismiss
under
because they
now.
think
So what was
they're smarter than
support
the government, and they gotta
yesterday?
know. I mean, when
But I was hoping that she would break through. She didn't. Overnight, she did. And now I think this price level will become resistance.
All went to the Southern District.
Again, I've been trading less than 6 months. These are the musings of a novice trader. But
some of these
here,
people who
you're
they focus on
welcome
through the
to
years
ask
also have
questions,
almost
feel
unlimited resources
comfortable.
themselves.
I
It's
do.
true. Certain ones have
And
been
I
able
can
to fend
thank
off
my
the feds to some extent.
mentor in my mind, Stephanie Perry, Rashida Dow, and Adelia Bordestray. Those women helped me free myself to practice in public. It doesn't have to be perfect. She told me that they would be terrible, the first videos. I don't think these are terrible, but they have certainly gotten better. I remember when we first started, I was sharing screen to screen.
Oh, Ethereum's running.
It was rough.
Ethereum's running.
But over time,
Oh, well, there you go.
I learn more the
GameStop.
more I
Let me get in
do.
that one
And
before
so it has
gets
been such a,
before it really at
I
450.
don't know, it's a
Let me get in
learning
that one
curve,
because that
but
thing's
it's
about to break out.
fast
AMC,
and
David,
you get to
60.
acquire
You
all
never-
these skills. So it's
people
been
are
pretty
gonna go to
pleasant.
movies again. So
Been
maybe
pretty-
you ought to get into
been
it.
pretty
Now, the
pleasant
CEO
experience.
finally sold
Good
something.
morning,
But isn't
Frank.
this the moment?
sold plenty. Right. Your point is that they're not dissimilar from those meme stocks
Good
of
morning.
2 years
Yeah,
ago.
we were in here early because it was the Fed announcement day. Are you checking the community tab, dude? Yes.
Stupidity.
And I'm looking at Tesla today. Did you see the Chris Sane video that I posted? He posted the levels, and Johnny shared a chart with me. I'll have to ask him, can I share that? But at any rate, it had the levels for Tesla. So that's, look, keep your eye on Tesla today. All of them, really. So I don't know. It looks like maybe a bounce up. I can't tell.
When I looked
But
at
this is what it looks
crypto
like on
and
the
I look
hourly.
at what's going on. I'm
That's what
thinking,
QQQ looks
well,
like. Let's look at
we've
Tesla
got some pretty good
on
situations.
the hourly.
No.
Okay.
Just
But you know, we're looking at everything. We're looking at the TTT. I love calling that my lemon squeeze. I know lemon is not in that. TTM lemon squeeze. I said that to the TD Ameritrade guy. He was like, yeah, it's called my lemon squeeze. My MACD.
But you know, it was also the most. I mean,
Okay,
Lisa
this
saw
is on
it.
our
My wife saw it.
hourly
She said,
chart.
"Why are you in that?" I said, "Well, because it's going higher."
Our
She said,
RSI.
"Oh, that's a time-honored reason to stay in."
It's about 12 minutes before the market opens.
Take a look at the pre-market here as we get set for the opening bell. Keeping our eye on Q&A regarding Powell, but we've come off the session lows. We'll get to Apple and some of this news about chip
The
suppliers,
NASDAQ is
Bed Bath,
down.
a lot of calls on
Supposed-
Boeing, Delta, the cruise lines, Netflix,
Futures.
AT&T when we come back.
Okay. I hope y'all can see that. So we'll see. Curious. Let's see. Where is Tesla now? Holy moly. So QQQ is at 270. Oh, came through. Where's Tesla? Anybody trading today? I promise you, 121. Okay, Tesla went to 121. Let's see, 121.50 at the height. QQQ. Okay, let's see. Man, who's in the chat? Frank, anybody doing Tesla today? Whoa, look at that. Look at yesterday. Oh my gosh. It was a perfect, like half and half. You can make money going up half the day, money down half the day. That's the beauty of QQQ. QQQ will cut you up if you don't know how to play her. But I had seen that pattern before where she does the exact thing. She shoots up in the morning, gets to a high about midday, and then somewhere around, what time was that when she started? Let me get this out the way. Somewhere around noon, about midday. Look at that march straight down and out. Right back to 270. I don't know. I've seen that before. I bet you I could go back and find this at least 2 other times. That exact same pattern. And look at this. Even look at how the volume is so telling. I think to go back and look at it, all technical analysis is being able to look forward or look in the present, but it's also about looking back and analyzing too. And I enjoy that too. That's why this thing suits me. I'm telling you, I like looking. And I like looking at patterns, and look at this. It's so clear to see, but you have to look at it on multiple time frames. I'm learning. So thank you, Johnny. Thank you to the community. You all make me better. Everybody says watch on all the time frames. Christine just said the same thing. So I'm learning. Still pretty, just beautiful. Okay, let's see what they're talking about on the news. If anything, CNBC always takes a lot of breaks, though, too. I think they take more breaks than TD Ameritrade. And maybe that's why I go back and forth. Mm-hmm. Is everybody ready for today? Who's got one-on-one scheduled? Yo, I gotta get a big wall calendar. Oh, because first of all, I'm not working with my regular phone. Everybody knows I lost my phone. So, hey Nigel. Okay, we got new subscribers. Yes, when they do it. I was coming over here to get. Oh, coming over here to get. Okay. Yep, I need to be able to see. Oh, that's why I need my other computer. Who else is here? Frank, what you trading today? I have no idea. I do. Elle asked me yesterday. She said, Sandra, I think it was Elle. Somebody asked me, what's your trading plan? Are you following your trading plan? You know darn well I wasn't following my trading plan because I'd never trade Tesla. But I mean, I made some money. Tesla was good to me. So it worked out. But no, I don't normally do that. Okay. I think I'm good. I think I got everything. You looking at Apple and QQQ? Okay. So what you thinking? Oh, what is that? FL2L is looking at Tesla, I see. What's FL2L? You know, I don't know what that is. Frank, what's FLTL? I mean, FL2L. Ah, ha, 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 ha. That's funny. I like it. That's so cool. See, look at this. We branding all over the place. Oh my goodness. That's cool. Yep. I like it. I'm taking it. Thank you. Thanks, Frank. That's my trading brother. I mean, man, we were in here trading. We were looking at each other like, what the heck? But we made money in this kitchen. That's where we started. It got rough. It got rough too. I don't know. I realized I needed to practice more. Yep. I knew the potential. I saw the potential in it, but I realized for me, I need to study. I need to be a student of this so that I'm confident because my confidence comes from knowing. When I know, like, I know I'm prepped and prepared, I'm confident. I don't care, what the market is doing. If I'm not prepared, I don't feel confident. And so even though I did take the Tesla trades because Johnny sent me great charts. I watched Chris Sain's video. I looked at the charts myself. I studied them. I plotted my support and resistance myself. I wasn't able to do trend lines though. I don't know. I'm gonna need some help with that. So our next Zoom session is going to be support and resistance. I can do that. I know. I think I'm pretty good at that. But not trend lines. I am not good at trend lines. So maybe somebody in the community could present on trend lines, how to draw them. That would be helpful. And then we'll continue the work with candlesticks. I found a much better presentation slide like setup. So instead of watching that, don't listen. I was gonna say, instead of watching that dry movie, do not discount that dry movie. That dry movie is the truth. If you need a candlestick intro, that it's flat, it's fractal flow. Please check it out. It's a great video. I don't know where it is. It's somewhere it's on the community tab. But instead of doing that, because I don't like that form for myself, I don't like receiving information like that. I don't like people reading to me either. But so what I have is a combination of, some diagrams along with just a little short explanation, which I think will be a little bit better because then it can be a little more interactive. That will make me feel better as a teacher. It takes some getting used to, you all, just talking into the air and not being able to see expressions. So I'm going to have to figure that out. Good morning, Johnny. Welcome, welcome, welcome. Are you looking at Tesla today? I popped a video that Chris Sain did on Tesla. He called out some levels and stuff. So I'm looking. Y'all know that's still, I don't know. I'm not, I am not familiar with Tesla. And even though I have that information, I still feel so much more comfortable. And I need to break out of that because you need to be able to trade, everything. I think at least you should know how to trade other things. I'll leave that there because you can't be a one-trick pony your whole trading career. So I want to look over. I do have Tesla calls and puts loaded up. I got QQQ calls and puts loaded up. The truth is, I really didn't want to trade today, y'all. I wasn't sure what to expect with, Powell announcements definitely can move markets. So I wanted to be, up for that just in case. But the truth is, I don't know. It feels like such a kind of lazy day here today. So I don't know what I'm going to do. I'm here though. I'm present and accounted for. We'll see how it goes. Yeah, Johnny, I'm not mad at you. And good for you. Have fun on the farm today. That is so wonderful. Johnny, one of our community members, they have a farm. Johnny, is it a blueberry farm? And where is it again? That is so amazing to me. Yeah, we're doing all kind of things. Some of our members or some of our subscribers, some of our family members, are like world-class travelers, y'all. I'm not gonna call anybody out, Frank. World-class travelers, y'all. It's just so interesting, the people that you meet. You know, some of our, yeah, it's a blueberry farm in South Georgia. Wow. That's amazing. Yep. It's a blueberry farm. You want to shout out the blueberry farm? There goes the bell. There goes the morning bell. I think I'm going to be playing it kind of cool today, folks. Because I don't know. I didn't hear any news. Did you all hear any news? I don't know what the Fed chair said. So we watch. We watch. We watch. I'll be watching Tesla and QQQ. I'll be going back and forth, watching them. Let's see, market watch. Look, the NASDAQ look almost, well, I was going to say split down the middle, but no. It's probably more red than green because you got Tesla, green, Amazon, green to begin. Okay. SPY is green by a tiny bit. Oh, there we go, Apple. Okay, well, not so fast. But I like this little market watch thing. It's just a little overview. Did everything just flip? What? Red? A lot of volatility in CHOP. I can tell you that. I can tell you that right now. That's on the 30. Let me look on the 3. I don't know. Straight up. Okay, I'm going back to QQQ because she's hitting 270. Okay. Let's see what she's going to do. She's going to bounce off of it? We don't know. Is she going to go through it? 270.29. Let's see if she can stay above 270. Oh, that's an awful big candle. But it's awful wicky too. Let me look on the 15. Okay. Look on the 5. Christine said, look at all of them. Look at all the time levels. I agree with that. Look at all the time frames. Why not? Because I think every time frame holds a bit of information. Did this thing just shoot up to 270.80 right in front of me? Frank, are you in on the morning scout? Oh, shucks. Well, wait, let's see. We need some confirmation up in this camp. I'm going to need some news, too.
Its revenue to reach 4.9 billion to 3 billion this year. That's with a 7 to 10% year-over-year growth, below that consensus estimate of about an 11% year-over-year growth. The company is also projecting adjusted earnings per share to reach $1.25, between that and $1.50 in 2023, compared to the $3.10 consensus. So you can see why investors are not really happy about that news. These new lowered expectations are way lower than the ones before. The company is also giving us a peek into the 2022 full year financials, saying that it got $1.075 billion and $4.57 billion in revenue compared to that $1.06 billion.
Frank, are you doing anything? Are you in a morning scout?
Respectively. That was for the fourth quarter and the full year.
Okay, pretty big cut and pretty big drop in the stock alongside it. Lower by 11% to down near the lows of the year.
Right.
Okay, let's keep going. Royal Caribbean Bit of a different tone this morning, an upgrade. But then when you pair it with the downgraded Norwegian, trying to play favorites in this group, I don't know if that's going to work. It seems like they all trade like the same.
It seems like they do, right? But this analyst over at Morgan Stanley, which gave the upvote and the downvote, is saying that the debt is way worse at Norwegian Cruise Lines. And also that the company's industry or the industry's supply growth particularly is hitting this cruise line worse, and that those things together create an unattractive risk reward for Norwegian Cruise Line. But he also boosted the price target on Royal Caribbean from $40 to $50, upgrading it from underweight to equal weight. And as we're heading into this important quote unquote wave season, this peak booking period, it may remain a little bit mixed. And that's because, of course, consumers are stretched. However, we still have the consumer who's going for the experience over the things. So they may not buy the iPhone, but they may buy the cruise trip. But it's all setting an uncertain view of this industry. It's just that one company is in a better position than the other because one has more debt than the other.
Okay. I guess when it's that simple, it's kind of compelling, you know? I think with debt being probably one of the biggest problems for these companies, saying to sell the one that's got more of it. Okay, works for me. Makes sense. Thanks, Renita. Okay. Both of them doing all right this morning. Royal up about 1.5%. Market finds its appetite here. Buyers come in at the opening bell and push stocks 0.5% higher. I got Sean Cruz with me in studio to talk about it. All right, Cruiser. We've got Coinbase up now 9% after announcing big cuts. We've got cruise lines up. Actually, Norwegian's down, but Royal's up. So I guess people are paying attention to that note. And it seems like, well, without anything shocking from Powell's statement today, we're back to the good vibes.
Yeah, and I think I wasn't surprised to see that rally yesterday not hold.
Yeah.
I mean, the whole rally was predicated on wage growth came in, 0.2% lower than what we expected.
Let's see if we go back, if it rejects and comes back down to
I figured
270.
as soon as we heard from the next Fed speaker, they were going to reiterate, no, we're still going to be pretty aggressive with our hikes next year. It's kind of what we got yesterday. Powell didn't necessarily make it worse, but I don't know that he really made it better. I think the market maybe was on edge a little bit that he might come out and sort of double down or even take it a step further about how hawkish he intends to be this year. So I think now we've got through, the Powell speech. That was a big one I think the markets were looking at this week. Inflation data definitely is going to be something to keep an eye on, and then we're just going to be looking ahead to bank earnings.
Okay. Those bank earnings, which will kick off later this week, I do think are going to be pretty huge, given that we've got companies like JP Morgan trading at 8-month highs.
Chop.
Yeah, Friday morning. Until then, let's talk about some of the other companies. And Jerry, analyst notes out this morning. Boeing has had a great run.
You doing anything this morning?
Hits from Morgan Stanley, who had said to buy. I think essentially saying that some of the improvement has been now understood.
Don't forget, y'all, everybody hit the like button.
It feels like this stock still has a long way to get back to normal, to what they were, not just before the pandemic, but before, obviously, the fatal tragic crashes.
Yeah, and I think one thing is this analyst sort of in that note gave a little bit of a hint at what they're watching. So they're saying, look, everything that we know now,
this morning?
Nothing is more or less reflected in the stock price. I mean, they still have, a price target.
I didn't hear anything earth-shattering.
So they raised the price target, so it's just above where the stock's trading at. I think what they're saying is they're looking more on, any sort of indicators of their ability to hit production targets further down the line. They talk about 2025, 2026 production targets, and then also just free cash flow generation. So I think they almost tell you, here's what to keep an eye on if you want to know if we are going to
kept the same.
Raise our price target again, he kept the same energy. Put it back with an overweight or a buy rating. So they're telling you to look for any hints about production clearing up because they do talk
Somebody
about
says
supply
back to
chain
happy
issues. That's one
times.
thing they're focused
What
on.
does that
And
mean?
then free cash
Let's
flow,
look
so
at Market Watch and
profitability.
see what this is.
All right. Are we rolling the top
Oh,
gun
that's pretty
B-roll
much
here? or is
overall
it Boeing?
green, y'all.
B-roll? I guess it's Boeing.
That's looking like a pretty
all right.
overall kind of
So
greenish day.
looking at the
This is
the 5-year chart for Boeing,
the NASDAQ.
I feel like it's pretty exciting
Here's
for
the
investors
NASDAQ.
that do think
It looks
there's
like
a comeback. I mean, it's still
Google
$500, $450 stock at its highs before
Broadcom.
everything went wrong.
Well, let's
But to
see.
the point,
Who's
I get it
red?
from Morgan Stanley too that you can't just look at the chart and go, it used to be here, it's going to go back there. Certain things maybe have permanently changed. I mean, is that kind of part of it that they're
okay, so cost, but not that
free
far
cash
down. They're
flow
not down by much.
side
So okay,
is going to
things
be
are looking
different?
up.
Like, is their
QQQ
margin
is up
going
a
to be the same
little.
as it was
Okay.
pre-COVID, pre-crashes? How do those two things change that? I mean, I know that some of the supply chain stuff might change some of the margin dynamics. I think also to some extent, the checks and balances that they have instituted now into their process maybe also
I'm thinking it's
change
going to
the
go back down
profitability
to
of this business long term.
270.
It will, and I think that that's why they're really focusing on their ability to navigate that moving forward, and that's why they said that is what we're going to be keeping an eye on, because I think it's not certain to what extent that will change, where sort of that new normal for cash flow profitability that you can expect. So that's why they said we are focusing in on free cash flow profitability metrics. They want to see how that develops too. The other thing is, I think if you look at Boeing, it looks like if they can get back above this 210, Boeing, if you look at price ranges they've traded at previously, you have to expand that chart back to a 2-year chart if you want to see when they were last really up above 210 and able to hold that. They really do hit these sort of $10 ranges. So they got above 200. I think if they can get back above 210 and hold 210, that might put them in a good spot to form some sort of a base moving forward if you're just looking at the chart. But I do think it's going to be one of those things where they really need to start delivering on the cash flow front. I think that's going to be the first thing to drop. Getting a sense of what production is going to look like in 2025, 2026, that might take a little bit longer to ascertain, I think.
All right, good stuff. I like the analysis on the chart too. It seems like it makes sense given how long we traded around 210, 220 before we took that big leg lower. Let's talk some tech here. The rest of our stories this morning are largely tech focused. Microsoft is going to invest into OpenAI, the home of ChatGPT, the latest homework cheating craze for middle schoolers around the world.
Is that what it's used for?
I think that's what it's used for.
I haven't used it for
other than creative tweets where people now have ChatGPT dunk on people for them.
I have heard that people really like it's supposed to be
people
really
are like
good
obsessed with doing the ChatGPT thing.
I've heard it's pretty spot on. I haven't really tried it myself, but if you look at, whenever you hear a deal of this magnitude going out there and it's making these headlines, that is a good time to go out and just take a look at the stock price. And
I'm surprised
the stock
that the
price will
market
tell
is
you
still
at least
green. Me
at first
too.
blush how everyone is interpreting this deal and what it can mean for the future
Okay, Elle, you got
prospects of the
meetings
company.
this morning.
So the stock's up a little over 1.25% today. I think that's an indication, at least for now, that investors don't think this is a waste of money. It's not going to bear any fruit for the company moving forward.
Okay, cool.
So I think it's going to be a matter of
checking
one.
on everybody.
Is
Look at
this
it
deal
going
actually
right
going to go
back to
through? The
270.
details of this are pretty interesting. It sounds like they have a 75% stake, or they get 75% of the profits until they recoup their initial investment, and then it drops down to 49. So I think that's an interesting design, and I think maybe that's why investors like it, because they're going to put out $10 billion, but they're going to try and recoup that as soon as they can from the company. So I think that might be helping with the sense of, what does this mean for the bottom line? What's this mean as a good use of cash? It doesn't sound like they're just throwing $10 billion into a hole and hoping something comes back out of it.
Okay. Microsoft pushing forward on this, I do think is pretty interesting, given that I think we associate a lot of the AI utility right now with
This is why
Alphabet.
You sit out. Some mornings it's okay.
In particular, I mean, I love talking to my phone.
Okay.
I talk to my phone all the time. I think that the phone has,
See
and
if
I
it's
do have
going
a
to
Google
bounce
phone.
off. So now
Very, very
270
responsive,
will
knows what you're looking
serve
for. I've generally been pretty impressed by voice
stays
AI.
up there, maybe support
Amazon
again.
Alexa, hit or
That's
miss.
amazing.
That
That's
thing
like
can't
right
figure
before
out
your
that I
eyes, you get to see
don't live in
market structure.
Cicero.
You get
whatever
to
the heck
see
that
it in
is,
living
like,
color.
Cook County, man. Like,
So
why
if
can't they
it
figure
goes
that
down,
out?
maybe it'll bounce
mean,
off of that 270. Maybe it'll pierce
I'm
through.
interested to see everyone's
Who
developing
knows?
this
Maybe it'll
stuff.
consolidate. I
You
don't
have to
think it's gonna
eventually
consolidate
move it
this
into
early
a
in the
product,
morning,
or
though.
what's the value?
And then with
Yeah.
those
Other than
SMAs
here's
all
a
spread
cool
out
thing,
like
you
that.
can make it say funny stuff.
that dope
That's not
candle.
monetizable to me. I think they want to see what are
Ooh.
you going to do in your business, or
I look at candles totally differently now. Now that we've been studying candles together, I look at candles totally different. I look at candles as telling a story right before my eyes. Like buyers and sellers are actually in there battling, and you get to see in real, almost real time, you know, the battle unfolding. Come on. That red candle started out so promising. It had such a big body, and those sellers came in. So that's the story that's running in my head. It's like, which helps me understand really what's happening. Oh my goodness, look at that.
On Semi is definitely responding to this down
Mm.
4%. And I do find this to be
Ford has a $2 move. What? Ford made a $2 move. See. Okay, swing trading, you all. I have made some money on a swing trade. Yep, it looked like it was losing and it was down. And I woke up in the morning. I promise you, I made some money. But swing trading, I don't know, it's something about that overnight time. I like being able to have eyes on my money. I wonder, do your stops? I guess they must. They would sell you out or execute. I don't know. Like, what happens if your triggers are, or your alerts or whatever it is, are hit overnight? Do they execute overnight? I'm just asking. Again, you know, I'm new. I'm new around here. These are my questions. Wow. Okay, look at that, y'all. Is anybody looking at the stair steps? You know I love a stair step pattern. And when it's all red here, come on. You know I love a stair step. That's 3, 6, 9, 12 minutes. We'll see. Because it could get caught up in these SMAs. You know, it's around 270. 270 is a pretty strong support and resistance either way. I don't know. See, you know that if you trade the same ticker every day, you know QQQ has, you know, at 270, she got to stop and she got to say hello. That's what Christine said. She got to stop and spend a little time there. So we're going to let her work that out. Okay, let's see. Whoa, we're coming down. What?
Maybe a little bit of that kind of lingering macro pressure will find its way into the stock eventually. Lastly, this morning, net app. What do you
now
think
everything
about
is red.
I think this one
Everything on Amazon. You fight.
I mean,
The fight is futile.
going out there and saying it's just
Amazon is going to come, I guess, join your buddies.
In general, saying, look, there's
Let me
things are going to be
hush.
softening this year. I think this is more of a lack of confidence in corporate spending on hardware than it is anything else. And so it's not anything that I would say is specific
if
to
we have a
NetApp, to be
crossover
quite
down
honest.
here,
I
this
think this is just
MACD.
more of a macro
That's
type of a
interesting.
call that this analyst is making.
Oh,
So
that
it'll be
looks
interesting to
good.
see, you know, maybe
That
there's
looks
going to
so
be some
good.
investors who hold
From
off
top
until
to
we
bottom,
get to
you know, QQQ
another
will do that
earnings.
in a
If
minute.
you look at Oracle, Oracle's trading a little bit lower this morning as well. They're sort of trying to figure out where they want to be in this space. They're trying to get away from just being that hardware company, but I think this is one where you're going to want to just wait for maybe an earnings report to see if things are really starting to slow down out there for this company.
Okay. All right. Again, this one fits a little bit more into the kind of macro trend where the networking and infrastructure stocks have just been really killed.
It's barely off of its lows though, so it's
it's still downtrending. Nothing too big here. All right, stocks flipped red. Thank you, Cruiser. The conversation just long enough for the stock market to go back down. Nice work, Cruiser. Thanks a lot, man. Okay, coming up, let's talk some companies that are working. Energy stocks continue to be some of the top picks from our guests, so let's continue to trade them.
I'm looking.
Crude oil a bit higher this morning.
I'm trying to see.
Let's walk through how to analyze a company's financials on
Look at it,
Thinkorswim.
right back at
To
270.
get started, Go to the Analyze tab and select Fundamentals.
That
Enter a
is
symbol,
amazing.
then select
Is anybody
Enter.
else watching this?
To download detailed
Right
analyst
back at
reports,
270,
select Download.
270.
By the Numbers provides balance sheet information and other fundamental data.
That's
Company
amazing.
Details provides summary takeaways on key metrics and what drives the stock. Takes a more numeric look at similar information. If you find
That
any of the
270
information particularly
is
helpful,
such
you can print it
a
out or take a
strong
screenshot. For more demos on how to think or
price
swim,
level.
head to the Education Center on
Should
tdameritrade.com.
spend some time there, I think. I don't know. 276. What is this struggle about?
We empower those who act. Those who see the correlation between upswings and downswings. Those who manage risk by meeting each obstacle with a perfectly executed strategy. A measured approach, the right tools, driving accuracy. CME Group, where risk meets opportunity.
When traders tell us how to make Thinkorswim even better, we listen.
Still up $1.
Like Jack. He wanted a streamlined version he could access anywhere, no download necessary. And Kim. She wanted to execute a preset trade strategy in seconds.
At
So,
one point in
we
time,
gave
the
them
sales
Thinkorswim
can
Web.
be, sometimes it can be overwhelming.
Because platforms
'Cause
this
I can be
innovative
watching,
aren't
you know,
just
I'm
made
watching
for
all of
traders,
this stuff.
they're made by them.
But I
Thinkorswim
like having
by
it.
TD Ameritrade.
I like trying to figure out that correlation too. Like how does it fit in the puzzle?
Stocks are going back and forth here. Haven't quite picked a direction.
Welcome.
Crude
Hey,
oil,
y'all,
though, has
y'all.
been clearly directional for months. It's been downward, but the energy companies are still trading near the highs. All right, let's get into it. Joining us, Neil Dingman, Managing Director of Energy Research at Truist. Neil, welcome back to the show. Happy New Year.
Thanks, Oliver. Good to see you.
Appreciate that. So this gap still hasn't closed. We've got crude oil every day risking new lows, but the energy companies quite persistent.
See what the heck
Any
Tesla over
thoughts
there
on
doing?
how long that can last?
I think it can
Oh,
last
Jesus,
well in the next
y'all. Look
couple
at the
years.
Tesla
I think
move
I call this
unfolding.
year another banner
Holy
year.
smoly cannoli.
I don't think the companies are going to have the record free cash flow they had last year. But the setup I see, I mean, look, I'm
Anybody watching
forecasting
this?
$85
shoot, y'all
oil
can't
this year
see it. Let me
versus
show
about
y'all this.
75 where we are now.
Look at
But I think
Tesla.
there's a good chance that we could. There's just a lot of reasons I think we could go above the 124.
Right. Did anybody get
high
in
oil
on
price
Tesla
we
this
saw last
morning?
year. I mean, you look and on the supply side, Russia production I think could roll over, and on the demand side, if China takes off, which again the stats I'm seeing, I mean, flights are almost up to 9,000 commercial flights this weekend versus 3,000 in December. So to me, both sides,
Maryland
the
sent it to
setup
us.
is
I posted
incredibly
it.
positive.
Okay,
I told
so
y'all watch
you're of the view
Tesla.
crude oil
I said I'm gonna watch
prices will
QQQ.
firm up. If they don't, do the stocks have to drop, or can they pump up dividends and payouts even if crude stays
Yeah,
down below 80?
dance, but nothing like this.
Somewhere around that
Look at Tesla.
65, 70 spot where we are, a little below where we are now is still the sweet
Oh my
spot. I mean,
gosh.
my company is still anything above $55,
Straight
anything
to the
above
ground, straight
250
from
gas.
the word
My
go.
companies are still printing cash, as I always say. And so, again, I still think they can pay out
First
a ton of
15
free cash
minutes of the
flow,
day.
which is going to then translate
Lord,
into
that was
shareholder
the
return, as
scalp
you
of the
mentioned.
day.
They don't need the $100
Anybody looking at
oil. I
that?
mean,
That
to
was
me,
the scalp
anything
of the
above
day.
55, and especially
Oh my gosh.
75 plus where we are
Okay,
now
wait
is
a
just a fantastic price for them.
Okay. The distinction between Occidental and Diamondback in your coverage, buy ratings on Oxy and Fang,
Ford made a
holds
$2 move
on
this morning. Oh, Lord, let
Chevron
me check it.
and Exxon. How come?
Just purely the free cash flow yield. Again,
Ooh.
I would say
Oh
across the
my
spectrum,
goodness.
I like the entire
Wait a
group,
minute.
but it comes to be
It's
more of a
almost
relative
hard to
trade.
watch.
And
I hate it
if
when it
one
does
plays
that.
Oxy or Diamondback, you can see free cash flow yields upwards to
Lord.
20%. Whereas if you play the
5,
majors,
10, 15
you're
minutes.
lucky to get, you're not even going to get quite
Good money,
10%.
good money.
So
Anybody
again,
in here
you'll get a
making
nice
money?
shareholder return from
Hey,
all of them,
Shauna.
but you'll get that much more from the two independents.
Welcome, Shauna. Welcome, welcome,
Okay,
welcome.
so the
Girl, wait a minute.
free
Look at
cash
this.
flow
If
dynamic
you had
sounds
some
like we've
money
got a
on
pretty
Tesla this
high,
morning,
bar
I'm just saying.
here.
Watch this. You got to see it on the
I
3
mean,
minute.
that kind of does speak to the point, though, of a
Look at
market
that. Look at
where
that. Look at that.
investors have found preference in
3, 6,
dividend-paying
9, 12, 15.
companies,
None but money.
profitable
All day.
companies. Is there anything that
Had to
Chevron
play.
Exxon can do
And
at
guess what I
this
chose to
point
do? Go watch my girlfriend
kind of
QQQ.
appeal to that
Go hang out here with my
dynamic
girl.
right now? Can
And
they
she
make
ain't doing
cuts
nothing but
anywhere?
snaking her way through the
Or
day.
is it just
like,
purely a volume and scale business where they
I
have
got
to
time
spend
for
to
it.
make money?
QQQ.
There's cuts that
I'm gonna
they've
put it
made. I mean,
down.
both
Seriously, I'm gonna
Chevron
start
and Exxon,
studying.
interesting
I'm gonna
enough,
start studying
have pared
Tesla.
down their portfolios in the last
Yep, you have
almost
to be
2
a
years,
fool
more than they
to
have
keep
in
doing
the
this
prior
and not go
10
over
years.
here
So they certainly
where
are
this
cutting.
easy
They
money is
certainly
happening.
are focusing on their high margin business that includes here in the U.S. the Permian
I
resources
can't
for
believe
both of
Frank
those.
didn't get it. Let's see
You know,
what
and then
Apple did.
internationally,
Maybe
of
Frank got
course,
some Apple
Exxon
money
has
this
Guyana, which is
morning.
just incredible.
Ooh,
Chevron
Apple
has
did the
other,
same legit.
large projects that they're
3,
focused on.
6, 9,
So I do
12,
like that their
15,
focus
you know.
is now much more defined than it has been in the past. But I still think, at least in the near term, an
Tesla still
investor is
looks
going to get a
sweet.
higher,
That looks
a
sweet,
higher
sweet.
yield, better shareholder
Something about
return
that.
by somebody like
That's so
Oxy. That
perfect.
again, you look at Oxy,
Even
and
if you only got in here.
they
Well,
announced
see,
about a
I
month
would have
ago,
been
2
scared
months
though.
ago,
I wouldn't
the
have
best
known
well
if
in the
it was
Permian,
gonna
best well in the
bounce
U.S. ever,
off of
producing
this
over
or any of these.
11,000 barrels a day. It was just an
No.
amazing well in the
I don't
Permian
know.
Basin. And then what I like
That's
is,
me.
of course, Oxy's doing a
Because
lot
all
of
that,
the
all this,
low carbon ventures as well, which investors seem to like.
she under there now.
Stocks
I'm
still
willing
looking
to bet
pretty good,
if she's gonna
holding
be,
pretty
it's gonna be a
strong
red day.
near the highs as we
Maybe
just saw
she'll
for
continue
the
down.
Exxon
Now that
chart.
she's
Is
cleared
there
from-
any potential
That makes more sense
this
to me.
year for
Look at QQQ.
legislative or political disruption? What's the status in your mind about the potential role of policy in these companies right now?
No, I think, in fact, just the opposite. I think the administration here is in a bit of a conundrum with the SPR. They've drained it now to levels that, if they continue at that pace, is almost unsustainable. In fact, they've already talked about having to think about trying to replenish that. And if they do, they know that the problem. The minute they announce that they're going to start a program to start refilling the SPR here, at least domestically, it is, in my opinion, that alone would push prices another $10 or $15 higher if they go back to that. But they've now tapped it to a level that they could do it for another few months, but beyond that, I think so. They realize, look, if they put any other programs out there that cut back on production, it's just going to have the reverse impact and keep pushing prices higher. So I think they really find themselves now in a place where they've got to figure out how to try to replenish that without pushing prices dramatically higher.
Okay. Love the thoughts, Neil, and seemingly resonating in the investment base right now with the stock still doing quite well. So we'll definitely keep in touch this year and revisit that crude thesis. Pretty bullish. Thanks, Neil.
Thanks, Oliver.
All right, let's do some trading. I got Tom with me in studio. Bullish on Occidental first, and then you've got, with respect to Neil's views here, a little bit more caution in your trade for Exxon. Let's go Oxy.
Yeah,
let's get pulled up here this morning.
Well, I mean, the stock's up nearly 100% from year-ago levels. I think that caveat that, Warren Buffett owns nearly 21% of the shares outstanding.
Yeah, people love that.
You got to take that into account. And to Neil's
Good company.
To Neil's point, if they have to replenish this SPR, that's at the lowest level since 1984. So that could put a bottom in crude oil, and we all know that these companies trade in high correlation to the price of crude. So I looked at something that implied volatility is low just because of the fact the stock has run up so far. So I looked at a directional bias trade, but I'm giving myself some time or duration on this for it to play out, where I'm going to buy a slightly in the money call out in the May cycle. So giving myself about 5 months till expiration on this one, buying the May 62.5 strike call as opposed to buying the stock, right? And then against it, because maybe I think it goes up, but maybe it kind of sputters out around 75, which is still a great gain. A $12.5 wide bullish call vertical to the upside, paying roughly a debit of about $5 for that. So your break even of 67.50 to the upside over the next 129 days is about 4.5% above the current share price of Oxy. So while you might want to buy the shares, less capital intensive, leverage the option market, implied volatility is relatively low. This is a long Vega trade because you are buying that slightly in the money call, which has a higher delta, reacts more like the stock. Then to offset some of the costs on that bullish call, you sell that 75 strike against it. So this might be the way to look at it if you've got maybe a longer term view, about 5 months in the position.
Okay. All right. So pretty bullish here. I like it. The call spread, volatility in these stocks has been fairly muted for the most part, but they can still get a little juicy here and there. Exxon, which is about $5 below the high, kind of looks for the first time in a while, maybe as good, if not better than Oxy on kind of the shorter term. It's got a little bit more upside momentum.
Yeah, and it's got that 3.3% dividend yield also, which, that's when, you look at a strategy in here. Do you want to own the shares? Do you think it's going to maybe consolidate those all-time highs of 114? Even this 110 level seems like a good area of resistance here. So I looked at something a little bit more conservative where I can take advantage of that not only implied volatility going into earnings at the end of this month, but also that dividend yield. So looked at a cover call strategy where for every 100 shares of stock that I buy, I'll sell an upside call, but I didn't make it too far out of the money to the upside, Oliver. Basically at the money, at the 110 strike call. You're paying roughly a debit of about 105.80. Maybe it's a little bit lower. The stock has come off of session highs. But if you pay 105.80, that's where you're buying the shares at a discount to the current share price, which is about 109 over the next 38 days. That break even of 105.80 on this one, which is what you paid on, it's about 4% below the current share price in Exxon. So this is a paid to wait type strategy where you can still own the shares. Maybe you want to own the shares, but you can continually sell upside or at the money calls against your long stock position to reduce your risk, reduce your break even point, but also increase your potential profitability on a position like this. So still long the shares, still collecting that dividend, but selling option premium against that long stock.
Good luck.
All right. Okay, so different approach here for the group that Neil's a little bit more cautious on, Chevron, Exxon, not cash flow heavy enough to warrant his buy rating. Thanks, Neil Demon from Truist and Mr. Tom White here in-house doing some trading. Let's talk some more about those Coinbase cuts when we get back. We've seen the pattern of stocks rallying after making tough layoffs.
Man, you catching in at
$2 Coinbase.
move
Stock market is also firming up. Quite a bit of chop this morning. Bonds still selling off. Dollar still higher, and equities right now are slightly up.
Because QQQ ain't doing anything but chopping around. So it's best for me to just sit on my hands. Sometimes you can see a pattern so beautifully on the 3. Sometimes you can see it on the 5, sometimes you can see it on the 15.
One of the most commonly used features on thinkorswim. Start by going to the Charts tab and entering a ticker symbol.
Okay.
Select time frame to adjust time intervals or to favorite a time frame. Select style to change the appearance of the chart. You can add drawings by selecting drawings, drawing tools, and then type of drawing. For symbol comparisons, select studies. This also gives you access to hundreds of pre-built studies, including a number of classic patterns. The grid icon lets you view multiple charts at once. You can even initiate a trade from the Charts tab. Just right-click anywhere on the chart and select either buy or sell. For more demos on how to thinkorswim, head to the Education Center on tdameritrade.com.
When traders tell us how to make thinkorswim even better, we listen. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim Trading from TD Ameritrade. It's a 13-hour flight. That's not a weekend trip.
15 minutes to wait.
Why not? I'm gonna take off.
Now, you downloaded the TD Ameritrade mobile app so you can quickly check the markets?
Yeah, actually, I'm taking one last look at my dashboard before we board.
Excellent. And you have thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set. Have a great flight.
Thanks.
We'll see you. They're getting so smart.
Choose the app that fits your investing style.
Oh, sure. Tesla's still moving down. Oh, tight. I'll shout out the time, folks.
Okay, we're in hour 2 of the show here. 30 minutes into trading. Stocks are trying to pick positive for the day, but a little bit back and forth generally this morning. We do have bonds selling off. We'll talk about the 10-year yield and what's happening in treasuries with Ben in a moment, taking a look at some of the macro charts, as there's no big disruptive move this morning after Jerome Powell's language was focused more on the Fed's role as an independent economic policymaker and not a tool for other policy. Market seems to be okay with that. No big comments on inflation or anything of the like so far. We're going to look at Coinbase in some detail. After the layoffs this morning, shares are higher. The crypto exchange is our morning trade. We're going to discuss the Fed's role in housing and take a look at a pretty decent couple months in the home builders. Charts are looking quite all right, maybe connected also to the drop in the long bond yields and mortgage rates over the last several months. For the chart master, we still have other analyst notes out. A lot of sell side activity here, particularly in the world of tech. We'll talk chips with NXPI, cloud with Snowflake, and AT&T. Right now, let's look at some of those charts and check in on the market action with Mr. Ben Lichtenstein, host of the Futures Show. Stocks trying to catch a bid here. Nothing surprising from Jay Powell. In fact, nothing really about the economy at all. He gave us a pass this morning.
Yeah, it seemed to be more focused on kind of laying the foundation in terms of how the Fed's going to act moving forward with the Republicans taking the House. It was kind of seemed a little bit more politically driven, but in terms of anything that was tied to economic comments, I was joking in the office. It seemed like he was kind of screaming into the gully, into the valley, screaming echo, echo, and basically was hearing, same thing that we've heard before in terms of comments. Now, I think that the market liked that, right? For the most part, we were kind of trading around lower to and now nearing again back to unchanged levels. And, this is, though, very representative of what we've seen in terms of the bigger picture, this kind of chop trade, right? We rally on Friday, kind of sell off on Monday, rally back on Tuesday, which is why, I always say when you're seeing this kind of intraday sort of lack of conviction one way or the other, but yet some nice wide ranges within the intraday moves, you have to kind of take a step back. I always say when in doubt, zoom out. And I've been doing that. And I've been finding a couple markets, Oliver, that have sort of nestled into the middle of the range that we established last year, which we talked about this yesterday, basically signals that we're waiting for more information.
So for stocks, it really depends on which index we're talking about, right? Where the Dow is pretty elevated still over the past year long. Even though it's in a downtrend, it's at the high end of it, whereas the NASDAQ, on the other hand, is like, if we get a bad sell-off here, we're making new lows. So stocks are quite disparate, depending on which index we pick. The S&P somewhere in between. Let's talk bonds and the dollar, which, to your point, are kind of in a little bit more of a no man's land. I talked this morning how the dollar looks quite a bit weaker, where Treasury yields haven't quite followed downward the way the dollar has. What do you see?
Well, I'm looking at that exactly, and I'm noticing here, first and foremost, as we look at the U.S. dollar on the daily time frame, you get the huge run-up that we saw last year to the highs up around 115. When things all of a sudden shifted, you had the EU come a bit more hawkish than they had been. Christine Lagarde turned that corner that she talked about. They went from negative to positive, and we've seen not just the euro currency firm up as the dollars come off. We've seen the British pound, for example, which saw a sharp move higher off the lows from last year. The Canadian dollar, the Japanese yen is another one.
The yen.
So all of that being, you've got the U.S. dollar, which has come off. Now, I was mentioning earlier how the dollar is right back to the middle of the range that we established, recently taking out, dollar took out those August lows here. And there you can see lows again down around that 104, 105 level. And yesterday back down, and today below the 103 handle. Now, I've got a side-by-side chart queued up here. If we could pull that, I'm not sure if the producers have access to it. There it is. This is the dollar. We just looked at this. Look, below the 50-day moving average, recently taking out that August low, as I mentioned here, now back to levels we haven't seen since May, June. We're talking below 103. But Oliver, to your point, now we're looking at futures here. So again, think of the mirror image for the 10-year yields. But notice here, look at where the August high is for the futures. So that shows you that the 10-year yields have a ways to go to the downside to catch up with some of the momentum we've been seeing in the dollar. So again, where does this weakness in the dollar come from? Well, I think you have to go back to some of the strength we've seen in, recently stocks coming off those October lows. You also have the Fed, which is kind of shifted a little bit, right? They moved away from that 75, those quadruple, very aggressive stance to 50. And there's even speculation we might see 25 after the numbers we saw Friday. And then again, just sort of pointing out here, lastly, what's playing out in terms of the discrepancy and how the dollar's really overdone it to the downside relative to what we've seen in terms of 10-year futures. So again, if the 10-year futures were up where the dollar is right now and kind of playing along, we'd be up around 122, 123.
And we'd have interest rates quite lower.
Significantly.
After the break in the dollar yesterday, to me, that's really important. Again, adding on to what you're saying here, because the trend and the momentum to the dollar downside is continuing as we speak, basically. Today we're higher, but yesterday's big sell-off in the greenback continued this downtrend, whereas there's no such breakout even within our shorter term range within bonds. There seems like there's a lot of conviction in the dollar. And if you saw this type of dollar breakdown at any point last year, anytime we saw the dollar drop like we did last year, stocks loved it. And this time around, it's not clear if they love it or not. And that's a really big deal, because with the dollar making new lows after spending a lot of last month around 104, you would think that could be a springboard for equities, but we haven't quite seen it yet.
If we could pull up a longer-term dollar chart here, just a final thought. We had Scott Bauer on this morning on the Future Show. He joined us to talk financial markets, and we looked at the dollar. Let's take a weekly candle look here at like 4 or 5 years of data, because Scott was pointing to this 104 level. Now, Scott's been very bullish the dollar all the way down, okay? And he's been talking about, and a little less bullish the dollar through the 108 handle, through the 106 handle. But a longer-term chart of the dollar shows how we're now testing key resistance from, we're going 3 years back. Here it is. Look at this key area here, that spike that Scott brought our attention to. So you can see where we're kind of matching up at that level. Scott called this a line in the sand, basically. So something to keep an eye on here in terms of these relationships.
All right. When in doubt, zoom out pretty far, and you'd be surprised what you might find. I like that. Okay. Thanks, Ben. Good stuff. Stocks here trying to catch that bid. After yesterday's fade, hope springs eternal. Let's talk some company news and get back to one of the big stories of the morning, which is the Coinbase layoffs. Kevin Green is taking a look at the details for us, senior markets correspondent. All right, Kevin, how many people, how soon, and what does that leave us to operate the exchange?
Definitely. So when we are actually looking at the stock today, it's up about 3.5% last time that I checked. So the company actually issued a statement here to be able to try to lay off about 950 employees, which would be about 20% of their workforce. And this is an effort to obviously reduce operating expenses. And right now they are projecting that the reduction in operating expenses should be around 25%. And this overall restructuring plan should be substantially done by the second quarter of this year. They also provided unaudited financial results, and they do believe that their average annual monthly transacting users, as well as average transaction revenue per user, along with operating expenses, will actually meet or be consistent with their 2022 full year outlook that they provided in November here. And they also believe that their adjusted EBITDA will actually match their expectation of being negative $500 million for the fiscal year that they had for last year, the ending in December 31st of 2022 here. So overall, they are trying to continue to cut costs in order to manage their business. We have seen obviously a reduction in interest when it comes to the crypto trading market. It's not only transactions alone as far as trading volume, but also the amount of assets that a lot of these brokerage houses or these exchanges have on their books as well. So they're trying to mitigate that as much as possible here and try to right-size their business for future growth and future earnings.
Okay, right-sizing the business for the future. How much of that future depends on the token prices going back up to get people excited about trading and pumping up the volumes? I've seen a lot of analysts start to seemingly admit that that's a pretty big factor.
It is. I mean, at the end of the day, even if you have a token that's fairly high priced, you still need to have the transaction volume. You have to have a lot of trading around that as well. And so it just does not just automatically mean the higher the price of Bitcoin, the better this company is going to be. You have to also have the interest in the crypto markets as well. I believe that when we get to more of a regulatory structure within this industry, you might see a little bit more interest. But a lot of these traders, especially young traders, are a little bit skeptical about this marketplace, as we've seen several collapses over 2022. Right now, I mean, it's kind of interesting, Oliver. 2 years ago, we were talking about crypto and the law.
Oh, can we get blockchain to fix that? Come back, Kevin Green. I wanted to hear more negative crypto stuff. Okay. Coinbase with the cut, Stocks up 6%. And we have seen that quite a bit lately. As these companies make layoffs, investors view it as a positive, cleaning up the costs. All right, thanks, Kevin Green, for the rundown here. Let's trade it. We're not done quite yet. Tim Biggin, lead option strategist at Delta Derivatives, betting that maybe the worst is past for the stock. Technically, it kind of looks a little bullish here, Tim. I hear you. You know, bouncing off the lows, not too bad.
Yeah, absolutely. And I like that price action over the past several days or so, Oliver. Certainly that 31 area, you know, had a nice reversal day. It closed a little bit lower on the day than yesterday, a big up move followed by today. So I'm cautiously bullish here. I like the fact that although implied volatility has softened a little bit, we're still well over 100. So certainly rich option premium. So I'm just looking to go out to February and selling out of the money put spread with plenty of safety here. So I'm going out selling the February 25 puts, hedging with the 22.5 puts. Last I looked, trading right around 30 cents. Certainly if the stock rips higher, maybe a touch less than that. But I like the fact that this trade returns over 15% with well over a 30% downside cushion. I don't know if, you know, Coinbase and crypto in general is ready to resume a red hot rally here. But I think given the fact that we have suffered through some major catastrophes, certainly in the crypto space, I think things are maybe starting to settle down here. So I like to be a buyer on further weakness, and in this case, much further weakness in COIN. So I like this trade on that front, again, being bullish but not aggressively so, simply because volatility, although it's softened, is still here in this May, to say the least.
So not really a bet on a big move to the upside, just preparedness to buy and a sell-off for Coinbase, or at least collect premium if you know, it doesn't drop.
Yeah, absolutely. I think that, you know, crypto and coin is probably here to stay, right? And it certainly has come down dramatically from the highs, you know, about a year ago. But, you know, at what point it settles out, it's difficult to say. But I think somewhere lower than the recent lows, it will find some support again. So I'm banking on that.
Indeed. It
And
don't
again,
take
I'm
long to
capturing
get
a lot of
cooking at
implied
all.
volatility here. The nervousness in this stock is extreme. And I think it's somewhat unwarranted as it has the lower levels. I don't think coin or crypto is going to disappear, although it has come down sharply.
I have my closing order
All right,
ready.
makes sense. Chart seems to be accommodating for such a trade, given the buying activity around the low 30s that's been going on for a while.
We'll discuss these base hits.
Some time now that it's been unable to break to new lows.
Are good. Base
Thanks for the
hits are
trade,
a
Tim Bigham.
goal.
Always appreciate you, sir.
We take base
You
hits.
bet,
We love
anytime.
them.
Take care, OJ.
All right, we'll see you this year. Tim's lead option strategist at Delta
So I
Derivatives.
am going to consult these
Stocks
charts,
are
though,
making some
because the
ground
charts
to the
will tell
upside
you
here.
if you should
A little
stay.
bit of a choppy start, but no
So I'ma
shot from
say
Jerome Powell, and people are
we're
feeling good
real
again.
oversold, but that's looking
Particularly
pretty
what's
good.
been
On the
interesting is the
15,
housing market.
let me roll
Home
through and
builders
look at the
are on a
hour.
nice run for the last 6 months. Maybe some of that we can attribute to a bit of a more slow-moving Fed. 25, 50 basis points in store for 2023 instead of 75 every time they hike. We'll come back and talk about the recovery potential for this very crucial economic sector. There it is, 80 bips in the NASDAQ. We're off to the races here.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you an active trader? Our active trading webcast series is designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcast and start learning today.
I'm Nicole Petalides, coming to you live from the New York Stock Exchange every single market day, from the opening to closing bells. Tune in to the TD Ameritrade Network.
When traders tell us how to make Thinkorswim even better, we listen. Like Jack. He wanted a streamlined version he could access anywhere, no download necessary. And Kim. She wanted to execute a preset trade strategy in seconds. So we gave him Thinkorswim Web. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim by TD Ameritrade.
Let's walk through charts, one of the most commonly used features on Thinkorswim. Start by going to the Charts tab and entering a ticker symbol. Select time frame to adjust time intervals or to favorite a time frame. Select style to change the appearance of the chart. You can add drawings by selecting Drawings, Drawing Tools, and then Type of Drawing. For symbol comparisons, select Studies. This also gives you access to hundreds of pre-built studies, including a number of classic patterns. The grid icon lets you view multiple charts at once. You can even initiate a trade from the Charts tab. Just right-click anywhere on the chart and select either buy or sell. For more demos on how to Thinkorswim, head to the Education Center on tdameritrade.com.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Hey, y'all.
Take control of your financial future.
In and out
Next Gen
today looks
Investing,
like
weekdays at
I'll
1
sit on
p.m.
these
Eastern,
Apple puts.
only on the TD
Well,
Ameritrade
I got
Network.
calls that turned just like that. They were up frame 1 minute and down the next. So
Stocks seem to
I
have
still
found their
believe
footing
that
after
today
Fed
may
Chair
be a
Jerome
green
Powell's
day.
testimony to the Swedish Riksbank
So
included
I'm gonna
not
hold
much
on
about
for
hiking, not much
QQQ
about inflation, and a lot
for
more
this
about policy
morning.
independence. So perhaps the coast is clear here today. Let's talk about a group that has apparently benefited from a slowdown in the higher interest rates. That is housing. Joining us, Jason Kern is the president of investment management at Cortland. Welcome back to the show, Jason. Happy New Year.
Hi, Oliver. Happy New Year. How you doing?
Doing pretty well, looking at a market that seems to be finding relief, and no surprise from Jerome Powell's commentary today. And housing extending a lot of strength here over the last 6 months. What do you think's happened here? Because the chart of the home builders is trading at the highest since April last year.
Yeah, well, Cortland is in the rental apartment business, and we're in the private real estate space. So fundamentally, we are making very long-term and illiquid investments. So we don't tend to be swayed too much by day-to-day moves in the stock markets necessarily. But you're right in the sense that our industry has slowed down, much like home buying has over the last 6 months for a lot of the same reasons. You think about a personal home buyer whose mortgage rate has gone from 3% up to 7% kind of overnight. They're going to be much less able to make those numbers work. Same thing with us. Cortland had done probably $7 billion of acquisitions of apartment communities over 18 months, probably an apartment community a week for 18 months leading up until the middle of last year. And then we've done nothing since for the same reason, with mortgages, with the cost of debt being so much higher, very much harder to make those yield numbers work unless and until there's some price capitulation and you start to see prices coming down. So much like a home buyer, and I find myself personally in that circumstance myself, having recently moved to Atlanta, housing prices haven't gone down here at all, and yet the cost of mortgage is more than doubled. We see the same thing in commercial and residential, real estate transactions where sellers are few and those that are willing to sell have not yet closed that, that bid-ask spread and capitulated and reduced their pricing, which is why you see very little deal volume out there today.
So sellers are few in the multifamily market, and why is that, Jason?
Yeah, well, it's similar to someone who owns a house. You don't want to, sell an asset and pay down very attractive debt that you've locked in, and it really is just that, that price discovery part of the market. And this happens every time there's disruption in the real estate cycle where you have buyers that are looking for deeply discounted deals given all the noise out there, sellers who don't want to take a write down on their holding value of their assets. And so neither the twain shall meet. typically. So that's where there's very few buyers and sellers sort of coming together. I do expect that to change later this year, though. You'll have sellers that become more and more motivated for whatever reason. Maybe they have debt expiring, maybe caps that are expiring, and they'll have to come to the market, have to meet the market, and there'll be, I think, some pretty interesting deals at discounts to what we would have paid earlier last year.
So it sounds like you think the seller will break first in this game of chicken?
I do. And, multifamily real estate is incredibly liquid. I mean, in 2021, we did $350 billion worth as an industry of, private apartment buildings changing hands. That would have been a big number for the entire real estate industry in days past. So there's a ton of inventory out there. I think we all know residential real estate is a bigger asset class than equities and bonds combined worldwide and in the U.S. So it's just a huge inventory of potential deals out there. And so even if there's a slide off of historic highs that we saw in 2021 and first half of 22, still going to be a lot of activity, I predict.
What role is region and location playing right now? Is this description that you're giving pretty widespread and uniform, or is there a lot of difference in that relationship between buyer and seller depending on where you go? Just kind of thinking about last year, some of the migration trends that showed up within the United States.
No, it's a great point. The big hazard in making any broad brushstroke comments about real estate is it is very much location, 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 as the adage goes. I think that's really where Cortland has thrived over the last 10 plus years since the GFC. We have focused on, based on our proprietary research and the macroeconomic and demographic trends, we have focused on the highest growth in migration, Sun Belt, Desert West, Mountain West markets, which have absolutely outperformed, and we expect will continue relatively to outperform. I mean, you look at rents today, and our rents are still up 5% year over year in the last month as we've re-signed leases, so that doesn't feel too bad. Certainly not 15%, 20% up year over year as we were experiencing a year ago when there was some sort of unnatural market forces happening. But frankly, even in Southern Florida right now, you're still getting double-digit rental increases year over year. So yeah, very much picking the right metros, the right markets where you have job growth, in migration, and therefore rental growth sustainability is key in our business.
So the fear then, if I could kind of push you to project maybe on the macro side a bit, one of the main fears economists had was that this year was going to bring a big upturn in rent and thus inflation as a result. Is that fear maybe overstated at this point?
Yeah, I mean, this my personal view is that the headline CPI that the entire market is looking at actually is overstated. I'm not the only one to note this. Rental inflation is the largest single component of CPI. And the way that the Fed measures it, frankly, doesn't make a whole lot of sense to me. It's a very sort of outdated survey methodology that they use. Recently, you've seen the Cleveland Fed publish a report that says if you look at actual rental data, it's probably 4 quarters lagged, let's say. So there's still the appearance of rent inflation, significant rent inflation in that CPI, which we're not seeing day to day. Again, our year over year rental growth in these hot markets has fallen from 20% to 5%. So there's been a major deceleration. Rents aren't going negative for us yet, but coming down to a more normalized level. That is not yet being reflected in CPI. So my hope actually is that the Fed and other market watchers start to take that more into account and realize that the Fed's actions actually have slowed the economy more than might be immediately obvious when you're looking at CPI numbers.
Okay. Like the thoughts, Jason, unique and good perspective for us, especially those who are trying to navigate a housing deal over the next year. Good conversation here for those in that quandary. I appreciate it.
Great. Thanks, Oliver. Take care.
You got it. Jason Kern joining us from Cortland. All right. So that impasse between buyer and seller likely to break in favor of the buyer, with sellers likely the first to cave, according to Jason. Okay. But definitely a little relief here from rates in the Fed over the last several months. And maybe not as big of an inflationary pressure from the rental side. So definitely some interesting nuggets in there. Coming up, let's talk some tech. 2 out of 3 of our names in the Chartmaster segment today are important tech names. Cloud with snow, chips with NXPI. And we'll take a look at AT&T, which has been a bit of an unsung hero the last quarter, trading the highest since the summer. We've got earnings coming up a couple weeks for AT&T. Stick around.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Thinkorswim by TD Ameritrade is more than a trading platform. It's an entire trading experience. With innovation that lets you customize interfaces, charts, and orders to your style of trading. Personalized education to expand your perspective, and a dedicated trade desk of expert-level support that will push you to be even better and just might change how you trade forever. Because once you experience Thinkorswim by TD Ameritrade, there's no going back.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy.
Tune in 24 hours a day, 7 days a week on tdameritradenetwork.com to all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
It is a choppy morning. We got no direction in stocks just yet. Back to flat. Let's talk about where there is conviction in analyst notes. Two tech companies and AT&T. Rick Ducat and Renita Young joining me here to take a look at some of the notes and the charts corresponding to them. Let's start with AT&T. Been a big run the last quarter, Renita.
And it's more runs, I guess, today. These shares are up today on an upgrade from Wells Fargo, taking AT&T from equal weight to overweight and boosting that price target from $17 to $22. Now, this analyst says that the U.S. telecom sector is a relatively defensive play for 2023, and that wireless subscriber growth should still remain above historical levels, and of course, specifically at AT&T. He says that the fiber to home construction should still grow and fixed wireless should continue taking share. AT&T is
think I'm
probably
swinging
the biggest,
too.
arguably,
You got
by
out,
many
I'm
measures.
swinging.
And so he's expecting it to continue
It's
to
two
be
calls
the
on
biggest.
QQQ.
But he recommends
She going up.
investors be selective given that
And I
current
got time. I got
inflationary
10 days,
backdrop.
so
It's still dependent
I'm holding
somewhat
out.
on
I have made
consumers
money on
and whether or not
swings.
they have enough to
You
spring
just
for
gotta
AT&T's
sit.
plans
You gotta
versus
sit, and you gotta
bundling
have
with
enough time. That's
Xfinity
why you
or
gotta
even
buy enough
Verizon.
time.
Kind of seems
You
to
gotta
me
get
like
good
the cut the
contracts.
cord
So let me
bear
go check
case
on
for
my
these
contract
companies
again, but I'm pretty
has sort of run
sure.
its course.
I feel like it's a good
because
one.
they're talking about wire
And
in, fiber wire
we gonna
in.
hold tight.
Part of that, I guess, is from the housing boom
Two
too. You know,
calls.
a lot of people are still just as a default getting houses built with the cable included, et cetera. And the fact that that's contributing to the bull case and not the bear case anymore, even as Sprint and T-Mobile try and carve their way into the wireless side, it's like both the hardwire and wireless for AT&T
Yeah,
suddenly
I'm
seem like a
pretty
bull case, which is like
confident.
a total 180
It is.
from where it was the last couple of years.
And so much so that this
Yeah.
analyst has named
I'm
AT&T
staying
his
put.
top pick for 2023
Wow, holy cow.
on the upside potential to the possible consensus estimates. So he's He's really boosting it up there.
Yeah.
We'll see if this follows.
Well, I think that's also an important point is the fact that they think it's going to beat what the consensus estimates are. So perhaps just too much bearishness still locked into this company. I mean, just look at 6 months ago, AT&T imploded, shares crashed hard, and then it was the earnings that really made this chart recover, right, Rick?
Yeah, top pick. Wow, that's pretty ambitious here, especially
for AT&T.
Yeah, with a $22 price target, that dashed blue line there, that would take us above our yearly highs. So not much technical basis in the near term for it, but just a nice big upward move there. Looking at the chart here, you mentioned the last earnings that we saw. I was looking at earnings from 2 times ago, from July, because we never actually filled this gap yet that we created here with this this opening price action here. So that's near about 2050. That's a point to keep our eye on to the upside here. I'm curious as well if we could be seeing a cup and handle type pattern play out here. We have, this type of price movement where we form what looks like a cup type shape. Then the handle here is a brief downward move, and then the resolution of the pattern would be to move back upward above that green dashed line there, 19, and that's the point where this gap down started. So could be that kind of thing shaping out here. RSI was showing a good example of bearish divergence in the past few months. RSI was trending downward while price was making more highs. It was the precursor to this drop off that began right up here. And RSI now above the midline here, break more bullish price action happening. Lots of support to the downside. We've got all 3 of our moving averages between 18 and 19, especially the yellow 21-day and purple 252-day exponential moving average are converging with that trend line right near the 1880 level. So that could be a very very staunch source of support there.
Pressure's on for AT&T to try and break above $19 here, close that gap, and suddenly turn this chart from recovery into rally mode. And Rick Ducat with the arrows going Robin Hood on us this morning. Okay, let's talk some tech here. NXPI for chips, a pretty interesting note out. We've got 2 of them here, both in the tech sector, but different sides of it. And the more optimistic one is on NXP.
Absolutely. So we got to remember that these chip companies, they produce different kinds of chips, and so NXP is doing better today as UBS upgrades it from a sell to a neutral, boosting the price target by $7 from $160 to $167. And this analyst believes that the company's free cash flow is going to be resilient this time around. And the stock's risk reward is more balanced at the current levels right now. Keep in mind, NXPI's it's releasing its financial results for the fourth quarter and for 2022 coming up on January 23rd, the conference, or January 30th rather. The conference call is on the 31st. So we'll get to see if what this analyst says will follow through with the company's free cash flow specifically.
So we got about 2 weeks until earnings, one that's a lot of times associated with the auto business, and that has been a pretty tough racket lately. All right, but not a bearish note, not like the most bullish thing I've ever heard, but it sounds like they believe free cash flow improvements, and that's kind of the holy grail right now of the market. How's it looking, Rick? Are we still downtrending in the stock or what?
Yeah, the broader trend is down here. We had a more short-term uptrend based on our yearly low, or starting with our yearly lows right there. And the uptrend has continued for a little bit, but it was broken here when price dipped and fell below all 3 of our moving averages in very short succession here. But now we're getting close to that price target. It seems to me like they were looking at the lows from back here earlier in this year, back in March, around that 167 level. So that's our blue dashed line. That would be the thing to be following if you're curious about this price target. But we can see here that the downtrend going across these highs, we had a brief foray upward there, still in play there. So the area near the purple 252 EMA is right near this trend line between maybe 171 to 172 or so. So some support to the downside here. We've got our two shorter term moving averages, yellow 21-day EMA, orange 63-day EMA between about 160 and 161. So they're clearing above that today, but giving back some of the gains. So that'll be an important spot to hold going into the close here. RSI also moving above that 50 midline. That's an encouraging sign because it happened at the same time price was breaking above the two moving averages there. So that adds a little bit of greater credence to this move upward. Support and resistance, 153 to the downside, roughly these range lows. And as I said before, 252 EMA to the upside.
Yeah, all the moving averages are starting to condense a little bit here. So maybe a little bit of a coiled spring. Perhaps in NXP, the chips overall as a whole too. Okay, lastly in the cloud, we got one more here, Renita, on Snowflake. Expectations are getting dropped by an analyst.
They are. They're getting dropped by Barclays, lowering the price target on Snowflake from $180 to $169, which is still above where it's trading right now, but keeping an overweight rating on the shares, which is likely why they're trading a little bit higher right now. Now, this analyst over at Barclays says that the valuation levels are still pretty interesting for U.S. software broadly in 2023, right? Interesting can be a good thing or a bad thing, honestly. But the estimates, he says, remains seemingly too high given the macro headwinds. So he believes that the market has injected way more optimism into it than what these headwinds really should be. And he believes that the first half of this year is going to remain difficult for software. This is in line with a couple of other companies that we've heard from over the past few days. But he does see hope for the second half, also in line with what other companies says, as numbers do not seem to have a significant downside. Couple other things to know. Piper Sandler also lowered the price target on this company from $200 to $194. Also maintained overweight. Last week, Wells Fargo said that Snowflake was a great cloud stock to buy on the dip. So I guess people bought it on the dip, and now that might be why it's rising today too.
There's a lot of negative tone for the first half of the year from this analyst without a very negative price target expectation. So even though they're cutting to levels that are quite above where it's trading right now, because we're at 136 and change, and their price target is still above that, 169. You've got it there for us in the blue, Rick. So it's an overweight rating. Price target significantly higher where it is. Kind of sounds like lip service to me.
Yeah, the chart doesn't look super strong right now here. And it's looking to me like they were basing that 169 level about on where that gap began, because we came close, but we never actually filled the gap. So that seems to be what they're looking for with that price target change. Nevertheless, we're looking at this downward channel shape here starting off the 6-month highs there, making new 6-month lows just a couple days ago. Right now, today, we're flirting with that yellow 21-day exponential moving average, brushing up against it, but not really able to clear it yet. Moving averages are all trending down still. Not really looking super strong here. We're in the middle of this downward channel still. Cleaner on the top trend line, a little messier on the bottom. We had some forays to the downside there. And the 124 line, I thought we formed a bit of a double bottom around that point. The recent yearly or 6-month lows did get a bit below that on the intraday, but roughly you try to look for these rough points where price bottomed out in tandem with each other. RSI still in bearish territory, but recovering a bit, still following the price action downward. Not really much else to say about this one, Oliver.
Yeah, the downtrend seems pretty locked in still. Pretty well-defined channel. And then maybe we've got this kind of double bottom, but to your point, it technically did make a low. So the down channel holds, and the stock's got a lot of proving to do. So right now, though, it's shaking off the cut to the expectations, up 1% as the market flails around. All right, interesting charts here for tech. Thanks, Renita Young. Thanks, Rick Dudecat. Seems like AT&T is the winner of the three. Coming up, we still got 20 minutes left this morning to talk about the action. Equities are having quite a wild day so far. Jeannie's going to give us an update on Amazon and its Buy with Prime service ahead of our market meetup. Stick around.
Many traders may be willing to take on additional risk in pursuit of aggressive growth in their portfolio. More power to them. But if you're looking for a less risky alternative, you might want to consider checking out our income investing course. In the income investing course, you'll explore investing strategies designed to generate regular income and preserve capital. First, we'll delve into risk and return preferences. You will learn about the different ways to allocate a portfolio and create a payment schedule. Then we'll take a deep dive into the assets commonly held in income portfolios: dividend stocks, bonds, equity REITs, and cash. You'll also learn about routines for managing a portfolio over time. Along the way, you'll watch videos, take quizzes, and perform paper trades to practice your new skills. So if you're looking for an edge, consider your education. Head to the Education tab on Thinkorswim for the income investing course and a whole lot more.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy.
Tune in 24 hours a day, 7 days a week on TDAmeritradenetwork.com to all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads like counters and diagonals are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on Thinkorswim for the full Options for Volatility course and a whole lot more.
Let's walk through charts, one of the most commonly used features on Thinkorswim. Start by going to the Charts tab and entering a ticker symbol. Select time frame to adjust time intervals or to favorite a time frame. Select style to change the appearance of the chart. You can add drawings by selecting Drawings, Drawing Tools, and then Type of Drawing. For symbol comparisons, select Studies. This also gives you access to hundreds of pre-built studies, including a number of classic patterns. The grid icon lets you view multiple charts at once. You can even initiate a trade from the Charts tab. Just right-click anywhere on the chart and select either buy or sell. For more demos on how to Thinkorswim, head to the Education Center on TDAmeritrade.com.
We empower those who act. Those who see the correlation between things above and things below the surface. Those who navigate risk by meeting every turn with a heightened awareness of what's possible. Constant assessment. Determine the best position. Catch the perfect wave. CNE Group, where risk meets opportunity.
Okay, let's check in with Jenny for a story about the one and only Amazon. Another day, some more news flow here, this time with the Buy with Prime. Tell me it's good, Jenny, because I rely on this thing.
It is good news, Oliver. I think it's more good news actually for third parties, I guess, depending on how you look at it. But Amazon did announce some new features with their Buy with Prime. They will widely roll out in the United States through the end of January. Now, this means actually with this new feature, they will take a slice of transactions on non-Amazon websites, which is a move that could have a pretty significant ripple effect on the online shopping sector. Think names like Shopify here. But Buy with Prime will allow retailers to offer shoppers benefits that are included already in this Prime program, including free delivery and a more simplified checkout experience. It was first announced actually back in April, but it was only available on a limited invitation-only basis. So Amazon says that having the Buy with Prime option does increase actually its third-party retailers by about 25% on average. And the e-commerce giant also did unveil a new program today called Reviews on Amazon, which allows Prime merchants to display ratings and reviews from Amazon customers on their own website. So Amazon has really figured out a way to take a slice of transactions now outside of its own website. I think this is great news for Amazon, and it also is good news for you if you're familiar with the Prime program to simplify your shopping experience on outside websites, because Amazon notoriously has one of the best checkout experiences really out there. It is so simple really to spend money on Amazon, but we're seeing shares hold on to their gain today ever so slightly. Have given up some of their earlier spike, but still up about 1%, which is outperforming the overall market. They did also additionally announce that while they're preparing to close 3 warehouses, we could see about 1,200 UK jobs perhaps right now in trouble. So continued job cuts. This follows news we got last week that they were laying off a pretty significant portion of their workforce. But Amazon is a company that employs over 1 million people across the world. So 1,200 jobs seems like a drop in the bucket, obviously significant if it's one of your jobs, but still perceived as positive by the street, considering they are still in the green today, at least as of right now.
Yeah, as of right now, key word is Apple just slipped red, now down about 1%. So Amazon playing a little bit nice with outside vendors and allowing us as customers to get plenty of options and hopefully always get the best product the fastest. All right, thanks, Jenny. Appreciate it. Let's bring it to Dan Grant, Michael McCurr. Let's talk about today and this week. Dan's a senior specialist of retail trading. He's a bond guy. Michael McCurr is director of Schwab Advisor Services. So let's talk some bonds here first, Dan. We got a little bit of a sell-off in treasuries, down about 50 bips, but this 10-year just seems like it's glued at 3.5.
3.58 with well inverted 2s to 10, 67, 10-year to the 3-month at 102 basis points negative, and then the 10-year to the 6-month 123 basis points. That is ahead of Thursday's CPI expected month over month, down negative 0.1. We have crude oil and natural gas prices still kind of full collapse. And you guys have been talking about the dollar a lot.
Morning, living my dream.
What are your thoughts
I
on that?
am making breakfast.
I like the fact that you're now coming back together. So the dollar's breaking and the yields are, the price of the bonds are coming back up, right? So I still want to see that clamshell close where we have weakness in the dollar, hopefully strengthen stocks,
right? and strengthen bonds.
Yeah.
That the clamshell you're talking about is basically the dollar going down, yields kind of remaining elevated. We talked about this with Ben earlier. You're looking for it to close by yields coming down some.
Correct.
Okay.
Correct.
It does kind of seem like if we punch down through 3.5%, we will get that clamshell to close. You're the only one who uses clamshell, Dan, and I like it. I'm going with it. So if that clamps back down in favor of the dollar, that means we get lower rates. But lower rates and lower dollar, is that what the market wants right now, Mike?
It depends why those two events would happen. But largely, I think that would be a tailwind to the U.S. equities and probably to the rest of the world equities as well. I mean, more specifically for the multinationals, that the rising dollar had been a headwind for them throughout largely the second half of 2022. Now, the falling yield, falling dollar with it 10% off the high should be a tailwind there. I do think that, the tailwinds for the dollar, there's It's hard to come up with them right now unless the data is significantly stronger than expected and making a move back towards the previous highs on inflation or, let's say, aggregate service demand. But all things that we're seeing and all the data points recently are not pointing towards that. So I do think that headwinds are building, not only from a fundamental standpoint, but also from a technical standpoint on the dollar specifically, but also now on the 10-year yield as well. But even if the 10-year yield does drop below that 3.5% level, I do think you're probably going to see a substantial amount of support come in right around 3.25%, that old consolidation and chopping range throughout the beginning of 2022, right between basically 3 and 3.25. And I think that's an area where you would see support too.
Okay. All right. So the reasons for why these things may happen, of course, sometimes is a little bit murky. But for the most part, it looks like persistent inflation slowing growth is one way you get lower yields and lower dollar. Do you think that's, are we going to see that break negatively for stocks, Dan, or do you still have hope?
There's 2 more quarters of Fed uncertainty. Right? I mean, we got to go back to that. The Fed is still talking about 50 more basis points between now and June, and that's kind of peak rates, with a peak right around 4.95. I thought it was significant. Person that doesn't set policy, but Jamie Dimon came out and said rates could go north of 5%, and there's a chance we could be at 6% Fed funds. Market's discounting that. They're saying no way. No, there's just no way we can go there.
Yeah,
not sustainable.
A lot of the strategists and traders on the show have told us that that's the discrepancy to bet on right now, or bet against rather, and bet that the market's going to have to get a little bit more hawkish in line with what the Fed's messaging has been.
And a new contract available to trade is against 3-month funding rates, which is the new SR3 contract, a futures contract.
What's the ticker for that?
SR3 U23, SR3 Z23 are the SEP and DEES contracts for next year.
Oof, all right, that's when you're getting specific, when you're trading the specific bond contracts.
Massive upside hedges being placed. Upside
I'm just getting used to
price.
the 10Y future. I'm behind the game. I'm using 10Y now, in case folks didn't recognize.
The ZN.
Yeah, no more TNX index. The 10Y future is pretty fun. Okay, Mike, why didn't Powell tell us anything interesting today? Can you give us an answer, please?
So a couple things. I think, first and foremost, he didn't push back on Fed President Daly's comments yesterday about the Fed considering that 25 basis point hike. I think that is fairly significant. Frankly.
Morning, BB.
He didn't tell us anything incrementally new, primarily because you have that CPI report.
Hey, BB,
coming
I'm
out
making
later in the
breakfast.
week. And really, there's nothing to change the Fed's, objective of slowing aggregate demand to bring inflation down. They're not going to declare victory.
Hey, BB. Hey, y'all. Hey, everybody. I'm making breakfast, and I'm watching QQQ. I need her to go back up because I got 2 calls cooking.
Stubbornly too high.
She's on her way up now, 271, 23. I need her to just keep doing what she's doing. So I'm going to pull this out so I can go check the money.
Continues to
resources.
BB, are you
available from
trading
TD
today?
Ameritrade.
I'm trading
You'll learn tips and
QQQ,
tricks to help
and I need to
navigate
be watching it on my phone
TDAmeritrade.com,
because I need her to just
Thinkorswim,
go up so
and
I can
mobile-based
cash out real
platforms.
quick.
Best of all,
Have a
you
good
can ask
day.
questions by chatting directly with an education coach. It's
Yeah,
interactive
I
learning
need
at
her to
its
keep going
finest.
up. I need her
Tune in
to
live or watch on
shoot
demand.
up to the top and do
Head over
something
to
special.
tdameritrade.com/webcast
And then
and start learning
I'm out.
today.
I'm making breakfast though. I'll check back on y'all
So it's in the sweet spot for valuation. I think they're going to do really well from an operational point of view. I think going forward, they're going to give really good guidance. And so I'm just looking for a nice pop from Bank of America when it comes to earnings in an earnings season when people are not expecting very much good.
Yeah, so JPM is pricey. Citi is an operational mess. Bank of America is the name you like. Ben, what do you think here of BAC?
Has been a chop basically since May. We're talking 40 to 30. So what I did is just immediately zoomed out, pulled up the daily time frame first and foremost. And what I noticed was, much like Tesla, a couple double, triple tops playing out. Direct your attention first and foremost to the top left corner there, up around that $50 level. And you can see we've got one here, right? Pretty well defined, up around 50, where we had a hard time, couldn't get anything going to the upside with any real follow through. And then as you can see, as we kind of work our way down, we see another one play out here around this. Well, taking a look here, very well defined triple top round. We'll call it 38, but I want to kind of ease that a bit just up to 40. And I'll show you why in just a second, because what I want to do here is actually just, hold on a second. Let me just clear this out and show you how, well, as we do this, I want to point to, well, first and foremost, how we've got a pretty well-defined upper extreme here. Again, around this, we'll call it a $40 level. And then we've got a very well-defined lower extreme here that's been established, again, around this $30 level. So we've got a very well-defined range. This goes all the way back to the beginning of April. And just want to point out here that we're kind of right in the middle of it here, right around this, again, $35 area. So as you can see, holding in the middle of the range that we've been in, a pivotal area with some pretty well-defined upper and lower extremes established. Now, let's take a look at this chart, because you've got a very similar pattern, right? As I look at this, kind of in the middle of a wide range, we're going all the way back to the spring of 2020. This is March, and we were trading, well, we were down around the $18 level. And then you can see, again, we've got a pretty well-defined upper extreme right here around this $50 level. Where we are right now, we'll call it 34. I'm going to look at it and say, hey, we're basically smack dab in the middle thereof. So you can see, again, a bit of a range that's been forming, and Bank of America is in the middle of it. Lastly, just taking a look at where things stand in terms of the 50-day, the 200. We're holding below. Again, you can see in the middle of this range that we just identified. Look at the RSI. It's not really providing a lean one way or the other, smack dab in the middle of the range that it's been in basically since, we're talking August of last year. So again, pivotal area here right now, but no real lean one way or the other.
Right, understood. Okay, and we see that with the two moving averages. Scott Nation's final thoughts here on the big picture of the market, as we heard a little bit from Jay Powell today, but we'll have a Fed meeting 31st and 1st. Is the Fed on the right direction or not necessarily?
Well, I think that, well, one thing that I do think they got right is the terminal rate for Fed funds number needs to be above 5%. We've gotten a couple of inflation numbers that were incredibly high, but slightly better than expected. And people really took comfort in that. I'm not certain that's what you ought to be focused on, is the beat as opposed to the headline number. So I think the Fed finally is headed in the right direction. And that's going to help some businesses. To the ones who can pass along inflationary pressures are going to do really well. And we've talked about some of those names. One of those names, I think, is going to be some of the big banks.
Good to see you, Scott Nations. Thank you. Scott
Thanks,
Nations,
Nicole.
President, Nations Indexes. And our own Ben Lichtenstein, looking at the charts there for the big three today. Thank you both. Coming up next, we're going to spotlight Abercrombie & Fitch. The company raised its guidance yesterday. We'll find out what the team from Jefferies has to say about ANF next.
Watchlist can help you keep track of security invested in. To add a watch list to the left sidebar, select the plus sign, then watch list. When the default list appears, select the name box, then create watch list. Enter a watch list name. To begin adding securities, enter a ticker symbol in the symbol box, then select enter. Continue adding all the symbols you want in your watch list, then select save. The existing list is replaced by the new one. You can also create watch lists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then Add to Watch List. From the Scan tab, right-click a security and then Add to Watch List. And that's how you make a watch list. For more demos on how to think or swim, head to the Education Center on tdameritrade.com.
Thinkorswim by TD Ameritrade is more than a trading platform. It's an entire trading experience. With innovation that lets you customize interfaces, charts, and orders to your style of trading. Personalized education to expand your perspective, and a dedicated trade desk of expert-level support that will push you to be even better and just might change how you trade forever. Because once you experience Thinkorswim by TD Ameritrade, there's no going back.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network. Welcome back to Trading 360. I'm Nicole Penelides, live at the New York Stock Exchange. Thanks for being with us. We're seeing some back and forth action here. The Dow and the S&P down for the third day in 4 at this moment. The Dow is down 6 points at 33,511. The S&P is at 3890, down 1 point. The Nasdaq 11,101, down 6 points. And the Russell is up about 0.5%. Of course, we heard from Fed Chair Jay Powell talking about price stability and that being still the bedrock of the economy. For a look at developing stories, I'd like to bring in Kevin Green, senior market correspondent here on the TD Ameritrade Network. And we're looking at the healthcare space with the rumors here, Oak Street Health, which is jumping 25%. In fact, it's having its biggest one-day move on record. And CVS, is this a done deal? Is this more rumored? What's going on here?
Definitely. So this is actually a Bloomberg report that is saying that CVS is looking to acquire Oak Street Health. And that's why we are seeing a little bit of a pop in the stock today, actually up 28%, as you kind of mentioned here. But when you look at Piper Sandler, they do believe that although this news is very welcoming, they already believe that Oak Street Health actually already had a fundamental story to tell. And it's one of their top picks in 2023 here. They do believe that the company has a scalable business and they're able to provide these services to their customers at a improving unit cost, if you will. So yes, we are seeing this type of acquisition or potential acquisition occur, not only within this name, but there's a lot of acquisitions occurring right now in the healthcare space, Nicole. So I'm not surprised that we are seeing this type of transactions, as well as this adjustment for a lot of these companies that are trying to scale back costs, but also look at ways to grow. And unfortunately, right now, it looks like organic growth is a little bit difficult. So they're trying to synthetically grow by acquiring new businesses. So overall, this is a pretty significant pop. We haven't had it confirmed by the company as of yet from what I've seen. This is just a Bloomberg report, but it is a promising start for a company that has been able to weather the storm here, especially within the last couple of quarters.
Yeah, big news, an important story to follow this week. Kevin Green, thank you, senior markets correspondent for the TD Ameritrade Network. Appreciate it. It's time now for our spotlight on Abercrombie and Fitch. Now, the retailer rocketed higher yesterday. Guidance, good news there. Corey Tarlow's with us, equity analyst over at Jefferies. So it looks like they had some good holiday sales, and they're seeing some good things ahead. Tell me a little bit about your opinion on what you've heard from the company and how you interpret it.
Sure. So I'm here right now coming to you live from warm and sunny Florida in Orlando at the 25th annual ICR conference. And I spent about an hour yesterday with Abercrombie and Fitch management. And if I were to just sum it up simply in one quick phrase for you, it's that the holiday was better than feared. So I think that largely coming into November, December, which is obviously a key time frame for a lot of these retailers, I think people and management teams were a little bit hesitant, or they were cautiously optimistic into the holiday. And what we found out was that, well, the higher income consumers tended to shop pretty well and shop a lot and shop a decent amount so that it supported the Abercrombie & Fitch segment. Hollister segment still was a little bit better, I think, trend-wise than what they saw in the third quarter into the holiday period. But nonetheless, that's a lower income and a younger customer than Abercrombie & Fitch. So you don't have as strong results in that segment as you do at Abercrombie & Fitch. Second, on inventory seems like it's in a really great spot. It's improving. They're planning to end the year flat versus the prior year. Obviously, inventory has been a really big story coming into 2023, where in 2022, inventories were obviously very elevated. Now it seems like that is under more control. And then lastly, on margins, obviously many retailers have been a little bit more promotional. I don't think that Abercrombie & Fitch is unique in that regard, but it seems like by brand, Abercrombie & Fitch has probably had to promote a little bit less. Hollister maybe a little bit more, clear through some of that excess inventory, but is nonetheless well-positioned into 2023.
It's amazing how they did better than expected during a holiday season that I think was really under the microscope, and somehow they managed to do this. You said inventories are improving and cost pressures appear to be coming down, and so maybe more tailwinds instead of headwinds. I mean, we saw better sales than expected, but what's interesting is how the analysts are interpreting what is going to happen going forward. I don't know how much of it is about Abercrombie or how much it is about the consumer. For example, we have Lululemon. One of the articles said Lululemon in the penalty box. So is this a consumer problem, or is this Abercrombie just doing so incredibly well?
Well, I think that it's a matter of measuring and appropriately calibrating expectations, which I think had been relatively subdued into the holidays. So you see many retail stocks have been up the last few days on some of these retail pre-announcements that have been, again, mostly better than expected. And Lululemon, I think, given where it's trading from a valuation standpoint, likely might have some trouble ahead. And obviously the shares were down yesterday on its pre-announcement. But nonetheless, Abercrombie & Fitch is one where, particularly at the Abercrombie brand, a lot of those headwinds that it faced this past year that you talked about, like freight and markdowns and air transportation and supply chain issues, all of those things are largely going to dissipate as we head into this coming year. So what you now have is headwinds turning to tailwinds, which should support, theoretically, better margins as we look to this year.
So tell me what names in the retail sector you like best, where you have strong buys or buys. I mean, Telsey Group actually has an outperforming a $33 target on Abercrombie, while I also saw another one that had an underweight. I think it was Morgan Stanley that had an underweight on this one. So there's not always generic love for all of these names. Which ones do you think are best positioned for 2023? Which names in retail?
So I think specifically within specialty retail, Abercrombie & Fitch is one that definitely stands out to me. And the one of the reasons that I say that too is that they've been really nimble in terms of what they've done from a supply chain standpoint. So denim is one category that Abercrombie & Fitch, and as an enterprise, sells a lot of. It's a top 3 category, but it's not as significant as some other retailers. And denim really hasn't actually been doing that well. So one of the things that Abercrombie & Fitch did rather uniquely is rotate into cargo and woven pants that have actually been selling really well so far into holiday and in the new year. So that's one thing that I think is probably going to support trends at Abercrombie & Fitch in the near term. And then the supply chain nimbleness that it's now stood back up should support trends throughout the rest of the year as we look to supporting more profitable sales growth ahead.
Okay, Corey, thank you for all of that on the retail world. Corey Tarlow, equity analyst at Jefferies. Thanks for being here. Coming up next, disruptors, and we'll find out why KeyBank's getting bullish on Bumble. Now, George Silas will take a look at this one and provide an example trade for us next.
Let's walk through how to analyze a company's financials on Thinkorswim. To get started, Go to the Analyze tab and select Fundamentals. Enter a symbol, then select Enter. To download detailed analyst reports, select Download. By the Numbers provides balance sheet information and other fundamental data. Company Details provides summary takeaways on key metrics and what drives the stock. Takes a more numeric look at similar information. If you find any of the information particularly helpful, you can print it out or take a screenshot. For more demos on how to think or swim, head to the Education Center on tdameritrade.com.
Join me 2 p.m. Eastern Time for the Watch List live on the floor of the New York Stock Exchange. It's Tuesday, so we'll talk technicals with Kevin Horner. And we'll discuss what's next for Bed Bath & Beyond, bankruptcy looming. And our panel is ready for an outlook on all those consumer staples. That and much more today, 2 p.m. for the Watch List live here at the New York Stock Exchange. And welcome back to Trading 360. I'm Nicole Pedalides. It's time for the Disruptors, and we're watching Bumble. George Sillis is with us, Senior Markets Correspondent, TD Ameritrade Network, to take a close look at this name with an analyst call today. George, tell us all about Bumble.
Well, for those who may or may not know, it's one of the leading providers in terms of technologies for online dating. A close competitor is Tinder, which is owned by Match Group. And in fact, younger generations really are starting to catch attention with Bumble with 40 million active users, Nicole. And I think overall, the stock has not fared well in the last year alongside a lot of the other online marketplace or advertised-based businesses like Bumble. But overall, if you consider some of the catalysts going forward, there's some analysts like KeyBank, which are actually very bullish on the stock. They actually moved their price target from sector weight to overweight and a price target of $27 on the stock. They actually see an interesting proposition, a few things going on. One is they're closing their market share with the Match Group, which is its largest competitors. They actually also see quite a bit of additional total addressable market, considering 40 million active users. The percent of paid active users is only about 15%. So there's ability to increase monetization rates of Bumble, but also international. This is an area that Bumble really hasn't penetrated in. And based on last quarter's earnings call, the company did denote some currency headwinds, which caused international growth to sort of stall out. And with the dollar actually having peaked around October and maybe peaked in terms of its 2-year cycle, this might be a catalyst for Bumble. The other thing, looking at the financials, this entire time when we saw some struggling environment for companies like Snapchat and Meta Platforms and even the Match Group, all these stocks are much lower on a comparative basis to Bumble in the last year. Bumble has actually performed in terms of sales growth in the low 20% range, and the guidance is still 20% going forward. And the other thing is the company is both profitable on an adjusted as well as unadjusted basis. Its net income margin or GAAP profitability based on gross margins of around 76% is 3%. And this was last year in a struggling environment. On a forward basis, they're expected to earn every quarter in the next 4 quarters a profitable print. So the quarterly EBITDA growth going forward looks really promising. And I think this is another thing that KeyBank recognizes in their call, alongside 20% sales growth and the ability to continue to monetize their existing user base, where a lot of their existing paid and unpaid users are actually making in-app purchases in which Bumble receives affiliated marketing payments from other vendors, whether it's e-commerce or other marketing affiliate partners. So overall, the company's stock price, it's down quite a bit this year, as you can see, about 34%, but it looks like it's maybe finding a basing support area around $20.
Yeah, and so when we see this, this move here for Bumble to this overweight rating, tell me how you would go about trading it at this point.
Yeah, so looking at the call, looking at the trend in the stock, Nicole, it looks like I said it's basing around the $20 range, which is a good sign. Typically speaking, when there's a turnaround or potential inflection point from companies that are either losing money to profitable or where companies are near break even, which is the case for Bumble, you actually see slight profit growth can actually improve the stock price quite considerably. So there is still risk in the marketplace we have to consider, but also, there's an opportunity for potentially holding this $20 support area. So we could actually go out to February and look at selling what's called a cash secured put, selling the $20 put options for $1.50 a share or $150 a contract. So ideally speaking, what we want to do is have the stock just trade above $20. It doesn't matter how much above it, as long as it's above it to achieve the max profitability of $150 a contract. Now, if the stock does trade below $20, a trader who puts on this kind of structure has to be willing and able to buy the shares at $20, but effectively your cost basis, because you're earning a credit up front of $1.50 a share, is around $18.50. So your return on strike is about 7.5%. That's what your yield is. And again, you have about 13% flexibility to break even. So you get some flexibility to the downside before you're at risk of losing money. But anything below $18.50 would pose a loss for a trader who puts on this kind of trade.
Yeah, and you said neutral to bullish on this one. Thank you for all of that. George Sills,
Right.
love having you on the show with all of this, especially this look at Bumble today.
Sure, Nicole, no problem.
Thank you, George. Thank you. Coming up next, our panel looks at all things Boeing. So we have the experts' take on Boeing coming up.
Let's walk through charts, one of the most commonly used features on thinkorswim. Start by going to the Charts tab and entering a ticker symbol. Select time frame to adjust the time intervals or to favorite a time frame. Select style to change the appearance of the chart. You can add drawings by selecting drawings, drawing tools, and then type of drawing. For symbol comparisons, select studies. This also gives you access to hundreds of pre-built studies, including a number of classic patterns. The grid icon lets you view multiple charts at once. You can even initiate a trade from the Charts tab. Just right-click anywhere on the chart and select either buy or sell. For more demos on how to thinkorswim, head to the Education Center on tdameritrade.com.
When traders tell us how to make thinkorswim even better, we listen. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim Trading from TD Ameritrade.
It's a 13-hour flight. That's not a weekend trip.
15 minutes.
Really? Wow, I'm gonna take off. Now, you downloaded the TD Ameritrade mobile app so you can quickly check the markets?
Yeah, actually, I'm taking one last look at my dashboard before we board.
Excellent. And you have thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set. Have a great flight.
Thanks.
We'll see you. They're getting so smart.
Choose the app that fits your investing style.
Welcome back to Trading 360. I'm Nicole Petalides. It's time for our 360 round. We're focusing on Boeing. We have our panel. We're first talking with Nicholas Owens, industrials analyst over at Morningstar. So tell me a little bit about Boeing. It's a great American company. I was seeing all the deliveries that are on the rise, and they're delivering Maxes and P8s and Dreamliners, and things seem to be improving. You noted the change in management. What's the good news on Boeing, and what are you terribly concerned about?
Thanks for having me on, Nicole. The good news is that I think that Boeing has the worst behind it in terms of the groundings of the 737s, 787s, and as you mentioned, deliveries, including ramping up production, but also delivering the planes that they have on the lot from refurbishing all those planes are on the uptick, and we see them ramping up through 2025. And each of those planes that they can deliver, it represents millions of dollars of revenue and profit. what I'm worried
Right,
about.
understood. Yeah.
Less and less, in the sense that the worst is behind them, and I think they've really done a lot to change how they operate around these, safety concerns and engineering concerns.
Yeah, and that's what you noted in the CFRA report, Colin. You said the recent history of egregious quality control lapses that we've seen, and you really question whether or not the MAX and 787 will ever regain some global leadership the way we've seen in the past. What's the good news to you, Colin, and maybe the headwinds?
Well, I've actually been very encouraged by the resiliency of 737 and 787 market share. So despite all the troubles with those planes and the tragedies and, dropping out of deliveries for over a year for the 787, they're still in very high demand. The airlines want them, and that's really the most important thing for Boeing from a financial perspective, is that last year has been just the supply chain to meet demand for a new aircraft. But we started to see some very positive leading indicators, at least in our opinion, that signal that Boeing and also Airbus, coincidentally, are probably going to exceed expectations on new aircraft deliveries this year. Just looking at what GE's been able to do on engine deliveries and other parts of the supply chain, we think they were very conservative in their delivery forecast for this year. And because the demand's actually higher than what they forecast to deliver and the supply chain is improving, I think there's a lot of upside to their forecast.
And you have a strong buy on this, right? Your price target currently is what, Colin?
It's currently 230. And we do have a strong buy rating. But we think one of the key things we're going to be looking for on the Q1 call is to reaffirm our view of the supply chain, that it's actually improving much faster than Boeing predicted last fall. And also we think over the past 6 months that Boeing has finally re-estimated all these major defense programs under this new inflationary environment. So we're very confident that this period of huge write-offs on the defense side is probably over, because they've done the re-estimating they need to on the contracts. So we're looking for those two pieces of confirmation for our thesis.
Right. Nicholas, tell me, you said you don't think the FAA, the reviews that the FAA is doing now, you don't really see much change in the stock going forward, right?
I wouldn't. I mean, in terms of the panel that the FAA has put together, which kind of follows on some of the action that Congress took after the crashes, I wouldn't expect a radical recommendation or any recommendation from that panel to be radically different than things Boeing has already done. And I wouldn't expect it to have like material effect on the business. Again, they've paid billions of dollars in fines and settlements, not to mention the cost of all the re-engineering and things that we've seen last couple of years. I think optimistically, it would be like a confirmation that a lot of those things are reestablished. And I would echo Colin's points in terms of like the outlook for Boeing, with some of the charges hopefully being in the rearview mirror, is a cleaner set of financials as they keep delivering on these planes. And there's definitely secular demand for these aircraft, both in the kind of pent up demand from COVID, but also longer term. Airlines are growing and replacing their fleets, and that remains the case probably for the next 10, 15 years.
Colin Scarola, CFRA, Nicholas Owens of Morningstar. Thank you both. Good luck there at Boeing. Appreciate it. And thank you, friends, for joining me here every single weekday at 11 a.m. for Trading 360. I will see you at 2 p.m. Eastern Time for the watch list. I'm Nicole Petalides, live at the New York Stock Exchange. Thanks for being with me. Fast Market is next.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you an active trader? Our active trading webcast series is designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcast and start learning today.
I'm Nicole Petalides coming to you live from the New York Stock Exchange every single market day, from the opening to closing bells. Tune in to the TD Ameritrade Network.
When traders tell us how to make Thinkorswim even better, we listen. Like Jack. He wanted a streamlined version he could access anywhere, no download necessary. And Kim. She wanted to execute a preset trade strategy in seconds. So we gave him Thinkorswim Web. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim by TD Ameritrade.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network.
Good morning, everyone, and welcome to Fast Market. I'm your host, Kevin Hinks. I'll be taking you through the next half hour, subbing in for Tom White. Today, I've got a good group of guys, though, to hang out with me for the next hour. I've got Mr. Alex Coffey, the co-host of Next Gen Investing, along with Jenny Horn. He's coming up right after the show, but has agreed to spend some time with us. So, Alex, I see you in the studio there at the TD Ameritrade Network studios in downtown Chicago. We have a market that is pretty resilient after a Friday melt-up, a Monday consolidation, and now here we find ourselves Tuesday with a market that seemed, Alex, like it wanted to go down to start the day, but now has firmed up quite nicely. Your thoughts, Alex Coffey?
Yeah, resiliency to start the year, Kev. There's been several points in what's been a pretty short, obviously, week and a half to start this 2023, where the market's been on the ropes a little bit. The bears have taken control. I mean, I look back to last week prior to Friday. It was very much a back and forth battle. But the resiliency that the market's showing, even when the sellers come in, has been quite impressive. And hey, look, I know there's some red across the board here, Kev, and we're looking at a market that's struggling to, really put in any serious time above 3,900. But you got to start somewhere, and I think that it's a positive start, be it just from a lack of negativity.
Alex, I think it's interesting that you're right. We are waiting for some big news coming up later in the week with CPI. Jerome Powell spoke this morning. There was some fear and hesitation about that, but there's also some market movement today, right? We had NFIB come out, a number that was showing some weakness in the in small business, but we also got a downgrade in one of the big names, both in the S&P and in the Dow Industrial Average. And for that, Jenny Horn is going to talk about. Jenny, welcome to the show. Boeing downgraded today, Jenny, but when is a downgrade not really a downgrade, Jenny?
That's a really good point, Kevin. That's actually exactly what I was going to say. This is not a downgrade on the fact that we're worried about Boeing by any means. It's the fact that Boeing has actually just been doing too well, which is a complete tone shift if you've been watching Boeing over the last several years, which, Kevin, I know you are a Boeing enthusiast. So the story is not actually as perhaps negative as the headline would make it seem. We did get a downgrade from Morgan Stanley to equal weight from overweight with a price target of $220 a share. This was actually up from $213. So not all doom and gloom in terms of at least its price target. But the analyst does see the stock approaching fair value at current levels after its recent outperformance. Just to speak to that, shares are up over 61% over the last 3 months. Now, she said going forward, Boeing will trade on the execution of its 2025 and 2026 aircraft production targets and free cash flow generation. But she does see a balanced risk and reward, noting that the majority of its near and medium-term positive catalysts have already been realized. Of course, given that recent rally in the last 3 months, like I mentioned, I also want to point out it's up 84% off of its 52-week low and up about 9% since just the start of the year. So even continuing that strength now into 2023. But we also did get an update today on its backlog and some of its December numbers. We saw the company record about 69 deliveries in the month of December, and order activity for the month did include 250 gross orders as well as 47 cancellations. And the growing backlog is actually one of the main catalysts why the street has this increasing confidence in its recovery. We actually see 73% of analysts now rate Boeing at a buy. This is 15% above the average buy rating of all S&P 500 stocks. So a strong conviction from the street. This note today, I think, take with a little bit of a grain of salt. It just reflects some of its recent outperformance, frankly.
All right, Jenny, we appreciate you coming on the show as always. Go ahead, Alex.
Well, I was going to say, Jenny, I think that's something we talk about on a daily basis, and we might actually explore this one a little bit further on next gen. But I was going to say, I think it's important that analysts are looking at the playing field. Boeing's been a really strong performer, and it's getting adjusted based off valuation. I mean, this is just prudent assessment and analysis by this analyst.
Right, Alex, and this is something we actually talked about yesterday, when a downgrade is truly a downgrade. And we've talked about so frequently how there's been a lack of commitment to it. It feels like downgrading a stock, you either downgrade it, keep a price target, raise a price target. To me, you see a true sign of pessimism when the analyst says that they're pulling out of the stock or they rate it at a sell and they're lowering its price target. But this conviction today is basically just assessing that recent valuation, which I do think is very necessary given the flux in price we've seen in Boeing, and actually to the upside, which is a welcome change given the flux to the downside we've seen in a lot of other, especially tech-heavy peers.
Yeah, that's right. It was more a factor, Jenny, of how long Boeing has run here rather than a weakening business. Matter of fact, they were actually pretty positive about the business. Jenny Horn, thank you so much for coming on. You'll see her coming up in the next hour on Next Gen Investing with Alex Coffey. But now I'd like to bring in our special guest for segment one of today's show. That is Mr. Randy Frederick. He is the managing director of Trading and Derivatives at the Charles Schwab Center for Financial Research. Randy, welcome to the show. Thought this was looking like a down day, Randy, but this is becoming quite a resilient little market. It doesn't really want to go up and scream, but it also doesn't want to go down, Randy.
Well, you know, Kevin, I've heard you say this a few times. Investors are salivating for a reason to find any nugget of positive news to buy this market. Clearly, you know, the tax loss selling, which was going on for the last couple of weeks of last year, all ended on 12/30. Now everything's down 20% at the start of this year. There's good reason, if you have a long-term outlook, to be nibbling away at good quality stocks that you either own and would like to own more of, or that you've been looking at and hadn't bought yet. So there's definitely some appetite there. And it's shocking when you think about all of the employment-related data we got last year, whether it was part of the manufacturing PMI, or whether it was part of the ADP, whether it was the jobless claims, either initial or continuing, whether it was a labor market, virtually all of those showed a very strong labor market, which should have been negative for stocks. But the one thing that the market grabbed a hold of was the fact that wages, while still up, were up slightly less than expected. And that was enough to spark a strong rally, as you mentioned, melt-up rally on Friday of last week. And yet, you know, that I think illustrates just how excited people are to find anything to jump onto. So Yes, we've had a couple of days where it looked like things were going to be weak. Today was a good example of that, but there's so much appetite out there to keep this thing level. The other thing I think why we might be going sideways is obviously there's only one economic report this week that really matters, and that's the big CPI, which comes out on Thursday. While the Fed watches the PCE, the investors absolutely pay the most attention to the CPI. And if there's one of these inflation reports that will move markets, it's that one. So I think there's a lot of tentative sort of sideways action that we're likely to see not only today, but tomorrow until we get that report on Thursday.
Alex Coffey, CPI is going to dominate the news flow coming up Thursday morning. But we had a hoop to jump through this morning, right, to get through before, and that was Jerome Powell speaking in Stockholm, Sweden. The good news is he didn't scare the children. He stayed on topic at that conference, didn't really say anything that would frighten the markets here. Matter of fact, the markets were down about 0.5% and came back to unchanged when the context of his notes basically came out. So we've got through our first hoop, our first hurdle of the week, Alex. We've got a big CPI number coming out. Now, Alex, some of the expectations, the consensus, are for this number to come down. The year-over-year number, 6.6, down from 7.1. The core, 5.7, down from 6.1. Those are pretty good progress, Alex, in terms of inflation. Is it enough, Alex?
Well, first off, in regards to the chairman speaking, I think it was a little bit of a fire drill here, Kev. I mean, alarms were flashing this morning, but like you said, nothing was really said here. It gives us, keeps us on our toes, keeps us ready for these surprises as they happen throughout the duration of markets going forward. But in regards to CPI, I mean, we shouldn't be surprised that the rate, at least on a year-over-year basis, is starting to come down. This is just the natural base effects taking place. Last year, much of the time was being compared to times that were not inflationary. It's going to be quite drastic on a year-over-year basis. But as we start comparing to those more rapid levels of inflation from last year, we're going to see a normalization on a year-over-year front. What I've been focused on for the better part of the last 6 months is those month-over-month data points. That's more of a reflection of what is the inflation rate right now. What is it pacing for on an annualized basis? And while it's moderated, it's still elevated from what we've seen over the past, let's say better part of a decade. And so still a little bit alarming, but we're trending in the right direction, Kev. And I'm somewhat in the camp that we're moving away. If you kind of keep an analogy of sort of like a relay race, we're watching the baton being passed from inflation to the economic growth picture. And we're in that process right now. How close that baton is to being fully passed over as we start to focus less on prices and more on the economic picture remains to be seen. But I think we're in that process of watching that transition.
Randy, once we get through Thursday, we get to really the start of fourth quarter earnings season on Friday with JP Morgan, Bank of America, Wells Fargo, Citigroup, and throw in Delta Airlines and United Healthcare. 6 pretty good names that are going to come out with earnings Friday morning. Now, if you remember 3-4 weeks ago, Randy, Jamie Dimon, Brian Moynihan, the CEO, Charles Scharf from Wells Fargo, Frazier from Citigroup, they all came out and talked about a slowing U.S. economy and a slowing consumer. They've already guided in a way to a weak economy. Now, here's the question. What's the biggest thing that you're looking for, that Randy Frederick is looking for in this release? Is it net interest income? Is it the overall health of the business? Is it loan loss reserves? What is your view on what our viewers should look at when the financials release their earnings Friday morning, Randy?
Well, those are all important factors. We do know that investment banking went way down because IPO was basically dead last year. I mean, no one wants to go public in a market like that. Net interest revenue could be solid. Loan loss reserves have gone up a bit because, as you said, all the banks are talking about the potential for a bigger slowdown this year. Whether or not that happens or not, they are preparing themselves for it. I think what we should be looking for is pay attention to companies like Jefferies, for example, that announced today. There wasn't a whole lot of positive news in there, and yet somehow the stock moved a little bit higher. again, investors are just looking almost to the point where we don't even need positive news. Just a lack of negative news is enough to get people excited enough to sort of buy into some of these names. So that's what I would be paying attention to. Here's what we do know from a Q4 earnings perspective. On an average quarter, optimism wanes as the quarter progresses. Normally, the downgrade of earnings expectations from the beginning of a quarter to the end drops about 2 to 2.5%. For Q4 of last year, earnings expectations fell 6.5% throughout the quarter. So the bar has been set substantially lower, as you said. And we all know it's not really what you earn, but what you earn relative to what was expected. Potentially, I believe the bar has been lowered substantially, enough to the point where it's not going to take a whole lot of upside positive news of any kind, whether that's a guidance, whether that's a higher revenue, even if earnings aren't as good as expected. And there's a potential for some upside surprises, which means we could get some bumps higher. As you said, Friday is sort of the unofficial start when these big banks announce.
Alex, I think Randy just made a really interesting point there that our viewers should really pay attention to, which is, stocks trade off of earnings versus consensus. Mm-hmm. And the consensus is so horrible right now. I think Friday's payrolls number taught us that when it doesn't take much to have this market really spring to the upside here with a relief rally. What does it take, Alex? What do you see in financials or in Delta Airlines? Anything stick out at you for earnings season beginning?
Yeah, I think Delta right now, the better they can do to kind of stay out of the spotlight that's been put on Southwest. That's going to be the kind of the key right now. Talk optimistically about the future and travel demand and what you're doing to meet that demand is going to be important for the companies in the airline space. As for the financials and as for ultimately what they report, they all have their different nuances and their niches and which part of the financial world they're more embedded in. Outside of any major surprise on any top or bottom line figure, I'm really not all that focused on the exact numbers that are going to be posted by these banks. Of course, surprises always warranted, but it's more of the commentary that you get from the leadership, particularly Jamie Dimon at JP Morgan, and kind of the thought that one, he's been there for a really long time. Been through a lot of different market environments, but the visibility a company like JP Morgan Chase has into the interworkings of the U.S. and global economy and the picture that they can paint for what they see for the future, the market hangs on every single word, Kev, when leaders like this talk. And so to me, it's going to be more about the picture they paint going forward, less about what they're going to show us how the last quarter went.
Yeah, exactly. I think Ed Bastian could get away with something as simple as, hey, we're Delta Airlines. We're not Southwest. Remember that. But, this is going to be a real interesting earnings season for the airlines and financials. All right, guys, let's take our first break of the day and come back with our first stock of the day, which is we're doing home repair, right? Retail home repair, but Amazon is a sneaky participant in that home repair. Take a quick break. Come back in 2 minutes with more Fast Market. See you then, everybody.
Let's walk through charts, one of the most commonly used features on thinkorswim. Start by going to the Charts tab and entering a ticker symbol. Select time frame to adjust time intervals or to favorite a time frame. Select style to change the appearance of the chart. You can add drawings by selecting drawings, drawing tools, and then type of drawing. For symbol comparisons, select studies. This also gives you access to hundreds of pre-built studies, including a number of classic patterns. The grid icon lets you view multiple charts at once. You can even initiate a trade from the Charts tab. Just right-click anywhere on the chart and select either buy or sell. For more demos on how to thinkorswim, head to the Education Center on tdameritrade.com.
When traders tell us how to make thinkorswim even better, we listen. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim Trading, from TD Ameritrade.
It's a 13-hour flight. That's not a weekend trip.
15 minutes to report.
I gotta take off.
Now, you downloaded the TD Ameritrade mobile app so you can quickly check the markets?
Yeah, actually, I'm taking one last look at my dashboard before we board.
Excellent. And you have Thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set. Have a great flight.
Thanks.
We'll see you. They're getting so smart.
Choose the app that fits your investing style.
Welcome back to Fast Market, everyone. Kevin Hinks back here for our second segment of today's show. Alex Coffey joining me, Randy Frederick joining me as well from the Schwab Center for Research. Now, let's get to George Tillis. He's going to come in and talk about our first stock of the day, and that is Amazon. George, as you know, I like themes on the shows, and we're doing home repair retailers. But if you Google the top home repair retailers, of course you have Home Depot, of course you have Lowe's, but third on that list, George, is Amazon. Now, they do everything in retail, but there's no part of retail that this company doesn't touch. George, your thoughts?
They don't. I mean, they're expanding aggressively in all facets of retail. And I'm going to call Amazon's home repair retail segment sort of a light version of Home Depot or Lowe's versus a true competitor. Exactly. If you look at what they do, they essentially provide things like furniture, assembly services, things like lighting and window coverings and so forth, and storage solutions. So they're not necessarily a major competitor or threat to Home Depot or Lowe's, but they certainly are expanding aggressively into that area. In fact, if you look at Home Depot and Lowe's, I mean, a lot of their stock performance of late in the last year hasn't necessarily been in home improvement goods, but rather it's services. That includes its contractor services, but also services that go into home repair, home services on home improvement. So if you contract out, for instance, a plumber, an electrician, a lot of times those contract services are done through major home improvement centers like Home Depot and Lowe's. So if Amazon is expanding into the service area to compete with the likes of Home Depot and Lowe's, then I would suggest it may become more of a competitive threat. But Amazon's an interesting business. They try so many different things because they can afford to do so. But if you consider competitive analysis relative to companies like Home Depot and Lowe's, which I suggest really have an effective duopoly in the home improvement business in the United States, price performance wise, there seems to be a pretty significant divergence, because you can actually see Home Depot and Lowe's have actually performed quite well this last year. We know that interest rates are higher, home sales are down, but if you think about the nature of that, people are sort of trapped in their homes, especially those that are encumbered by a mortgage that they secured maybe 5 or 6 years ago, or even prior to the last year, to refinance or move to a new home. They're going to have to pay up in terms of a rate. So I think now home improvement stocks like Home Depot and Lowe's are benefiting from that sort of aspect of the housing market, which is really struggling right now from new home sales or existing home sales. But it doesn't necessarily mean that we'll see a decline in demand for uptake or upkeep when it comes down to home improvement.
George, here's my question to you. When you look at a company like Amazon, if you put in their search engine at Amazon home improvement, you'll get every tool, everything that you might want at Home Depot, but you can't run out to Amazon and pick up a tool or a part. Exactly. It's got to be, there's the differentiator there, right? You can't run over to Amazon and pick up something. So you've got to give yourself a day or 2 days or however long it takes for that to come. That's the big differentiator, is it? Especially when you mentioned the number one thing, which is professionals. That's where both Home Depot and Lowe's are going to grow versus Amazon, correct?
Definitely. I mean, professional services is a huge growth catalyst for both Home Depot and Lowe's. And I agree with you, Kevin. A lot of times people don't want to wait if they've got a leaky pipe or some plumbing issues or some some short or small electrical issues, they want to deal with it today. So they don't necessarily want to wait. Even though Amazon Prime is relatively fast in terms of delivery, sometimes people want to go to the store. And that's where these large, Home Depot and Lowe's retail outlets generate a lot of operating leverage. But the other thing you have to consider also, when you think about Amazon, they're really known for consumer products, not necessarily for durable products per se. They are growing certainly in terms of that area, like the Home Depot and the Lowe's. But at the same time, Amazon's still really reflective from an operating income standpoint, a technology company. And I think that's another thing people forget, is even though e-commerce or retail sales represent close to 80% of sales, Amazon Web Services only represents 16% of sales, but nearly 71% of operating income comes from Amazon Web Services. So it's still really, from an operating income standpoint, a cloud-based company, which is a technology theme. And we know that technology themes have struggled this year. And I suggest that's one of the reasons why Amazon continues to underperform the other retailers this entire year. In fact, there's a big divergence in October, which you can see there's a huge preference for value-orientated companies. Home Depot was in the Dow. We know the Dow has performed rather well, versus, again, retailers like Amazon, which are growth-orientated, not necessarily value-orientated.
You're right, George. You can compare these companies, but they're really not the same. There's so many different facets to a company like Amazon, and Home Depot and Lowe's are eerily similar in their makeups. Even the fact that Marvin Ellison, the CEO of Lowe's, is a Home Depot alumni. But George Hillis, always appreciate you coming on the show, giving us your thoughts on these companies.
Thanks.
George, have a great day. Thanks as always. All right, now let's bring back in Randy Frederick and Alex Coffey to the show. Randy, I'll go to you first. Amazon will sell you just about anything they want, but like I just said to George, you can't run out to Amazon to pick up a part or a tool or anything that you might need, but that doesn't make it formidable in encroaching on their business.
Oh, there's no question they're encroaching on it to some extent. And I mean, I admit I've bought power tools, lawn and garden tools and things like that over Amazon, mostly because the variety is just so huge. But I can't imagine a day where I'm going to order a sheet of plywood or half a dozen 2x4s and have those delivered to my door from Amazon. Maybe I'm wrong, but I can't imagine, or a washing machine. It weighs too much for that delivery, especially that young lady driving that truck to carry up and put it on my front doorstep. So there's definitely some areas where they can't go. And I don't know about you, but if you ever go to a Lowe's or a Home Depot at 6 o'clock in the morning, there is loaded with nothing but contractors ready to grab all the stuff they need to go do the job. They're not going to order online and wait for that stuff to be delivered the next day. They just can't afford to do that. So yes, I agree, they are encroaching, but there's going to be certain areas where they just can't quite compete. But that doesn't mean they won't try, and that doesn't mean they won't nibble away at some of that core business, I think.
Alex Coffey, I mean, Randy is exactly right. There's only so far that Amazon can go in this home improvement space, and the professionals that literally live and set up camp at Home Depot and Lowe's, that's the big variable. That's where Lowe's has to compete with Home Depot. That's where Amazon can't compete. But Amazon has a massive amount of other companies like Amazon Web Services and groceries and all these other things. So these companies are similar in that if you look for a list, Amazon will show up third for home improvement, but they're really not the same, are they, Alex?
No, but I think that you guys are both highlighting good points. I mean, if you need a new drill or a little tool set of, screwdrivers and things of that nature, something quick, somewhat light, easy to ship, Amazon's going to be as good a choice as any. And as efficient as the shipping is, at least to urban areas like downtown Chicago, I mean, that simply could be there within the next 12 hours in some cases. It doesn't necessarily, unless you needed it within the next hour, there's really no reason not to take that more efficient path than, to go to Home Depot or a Lowe's or a Walmart or a Target in person and try to find some sort of substitute on a shorter time frame. But you guys both talked about some of the things that they're not necessarily working on. Things like, let's say, giant quantities of wood or something that a contractor would need to pick up before a job. It's not that Amazon can't do that. It's just, it might not be the most efficient use of their capital to break into those businesses. Right. Lowe's and Home Depot are long established, positioned well, have stores in well thought out areas for this purpose in particular. This is their primary means of generating revenue in many cases. Amazon's got plenty of other things. They're going to try to spend money as efficiently as possible to continue to expand and grow so that you think, oh, I need to buy something, I'll go to Amazon for that. But they don't need to get so niche that professionals are buying 2x4s on Amazon.com instead of Home Depot.
Randy, you brought us a trade in Amazon for today's show. Describe to us what you've created here.
Yeah, so we're just going to do an example on Amazon. We'll take all the information we've been talking about, whether they've got their core benefits. Obviously, as George talked about, they have Amazon Web Services, which is something that Home Depot and Lowe's does not do. So it's a completely separate line of business, and it's critical. Yes, Amazon was down 49% last year. It was a terrible year in the markets for everyone, but technology got beat up pretty bad. So that means they're cheap. Does that mean they're good value? That's a question that we can't necessarily answer. But let's put together an example of a trade where we've got, as we talked about earlier, a CPI coming out on Thursday that could cause the markets to rally again like they did last week Friday, or if it's a little hotter than expected, we might have a sell-off. That makes people a little uncomfortable. We also know that Amazon's earnings don't come out until February the 2nd. As you know, I've done this many times on the show. I try to like to trade away from those earnings. In other words, not be a holder over earnings, because if you look at Amazon, they've had some big moves on earnings. The last one was a big down move, and there's, I don't know if that'll happen again or not, but the best way to not worry about it is just not be there. So I put together a trade that is a fairly neutral, moderately bullish trade that expires only on January 20th. So that's going to be about, a week or two before earnings come out. This is a three-legged trade. It's got a lot of different names. The name I would call it, and this is a name that people use, is called a bullish risk reversal put spread. And what that is essentially is you're taking a bullish position, which is an easy way to do that, of course, is to buy a long call. The long calls on their own are kind of tough for a number of reasons. They get kind of expensive. Time erosion kind of beats you up pretty fast. So the way you sort of make this trade a little bit more affordable is you put on a credit put spread down below it, which will then make this trade a little cheaper. So the trade is basically buying a January 20 $90 call, which gives you some upside potential. That's about $1 or so above where the stock is right now. Then I'm going to sell a January 20 $86 put, which brings in a pretty decent amount of credit to help offset that. But in case I'm wrong and Amazon really goes off a cliff, I want to protect that downside from that short put. So I'm going to buy another cheaper one underneath it, which is an $83 put. What this does is effectively take this long call trade, which might cost me $2.50 to $3, and bring the price down to about $1.60. What that does, of course, is puts my break-even price from the call being at 90 to 91.60. So a little bit of upside, about $1.60 here, and then you got unlimited upside after that. So your risk is about $1.60 unless the stock drops all the way down below 86. And if it goes all the way down below 83, then you've got the $3 spread risk plus the $1.60, which puts you at about a $4.60 risk. So your break even's 91.60. You got a $1.60 risk down to 86. You got 460 all the way down to the very bottom. But this basically is a bullish trade with a relatively low cost if you get a bit of an upside, and it stays away from that high risk zone around earnings.
Alex Coffey, here's what jumps out at me about Randy's trade here. You're only spending $1.72, which is not insignificant, but much less than buying the stock. Your margin is only $300, the width of that short put vertical, but you've got 99 deltas, Alex. Mm-hmm. You've got basically the equivalent of 100 shares of stock for much less, Alex.
Yeah, capital efficiency and using options for leverage here is really the crux of this trade. But I think it combines two elements of things that option traders and stock traders and investors alike all struggle with. You're always looking at trade-offs when you do different strategies and you select things. So if we really look at this trade, it's the combination of two strategies. It's selling a put vertical and it's buying a call. Both individually have their positives and both individually have potential downsides to them. In the case of the call, you have unlimited upside. That's very appealing to many. but you need something to happen. If you just bought the call for, let's say, $2.50 or something thereabouts, I'm sure it's trading at, you would need this stock to move up to 92.5 by Jan 20 to break even on that, all else equal. In the case of selling the put vertical, maybe it's a little bit more strategic. Maybe it has a higher probability of success. But if overnight Amazon ramps up higher to 95, 100, 105, whatever it may be, many investors would be kicking themselves for not capitalizing beyond whatever the credit received was. So this sort of combines the elements of both. It tries to reduce that debit as much as possible, using that credit received from the put vertical, but not sacrificing the unlimited upside of the long call. So I think if you're very optimistic in a name that's been beaten down as bad as Amazon, this is the kind of strategy that many will look to.
All right, I want to thank Randy Frederick for coming on the show. As always, Randy Frederick, the Managing Director of Trading and Derivatives at the Schwab Center for Financial Research. Thank you so much, Randy. Alex Coffey will stick around for the rest of the show, but we'll take our second break of the day. Come back in 2 minutes with more Fast Market. See you then, everybody.
Watchlist can help you keep track of securities you're interested in. To add a watch list to the left sidebar, select the plus sign, then watch list. When the default list appears, select the name box, then create watch list. Enter a watch list name. To begin adding securities, enter a ticker symbol in the symbol box, then select enter. Continue adding all the symbols you want in your watch list, then select save. The existing list is replaced by the new one. You can also create watch lists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then add to watch list. From the Scan tab, right-click a security and then add to watch list. And that's how you make a watch list. For more demos on how to think or swim, head to the Education Center on tdameritrade.com.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network.
Welcome back to Fast Market, everyone. Kevin Hinks back here with Alex Coffey for our cash tag segment. Now I'd like to bring in the co-founder of Likefolio.com, Mr. Andy Swan, to the show. Andy, welcome to the show. We're doing home improvement retailers, Andy, and the big dog in this fight is Home Depot. You've got data. This is really, Andy, in essence, a fight over, when you think about Home Depot and Lowe's, it's really it's a David and Goliath fight, isn't it? Because Home Depot dominates this, even though Lowe's has made a little headway. But this is a fight over the professional contractor, isn't it, Andy?
Yeah, if it's a fight over the professional contractor, then Home Depot, wins walking away. There's no question about that.
Yes.
This is one of those kind of pair trade opportunities I think we've been talking about with you guys and to your audience for quite a while here. Really like Home Depot quite a bit more than Lowe's. So far, it's playing out nicely in the market. And Likefolio data shows that should continue. When we look at, kind of the macro trends involved in this, people are not buying homes right now. They're not renovating the homes that they have. They're, the ability to tap into that HELOC or buy a new home has gotten a lot more expensive with interest rates. So that's kind of dried up. And so that was a driving force of people doing renovations themselves or home improvement themselves. One of the reasons people walk in to a Lowe's, maybe a little bit more than a Home Depot, but what they are doing, if they need to do something, is they're hiring a professional, hiring a contractor, seeing growth in that sector. And that completely benefits Home Depot over Lowe's. And we really see it play out. When we look at the two companies on a, what we call our outlier grid, where we kind of plot the two companies in terms of consumer demand growth and consumer happiness on one chart. And what that shows us is that Home Depot just is beating Lowe's in both categories. They've got happier customers and they've got more consumer demand growth than Lowe's. And so we expect that to continue. Home Depot just kind of pulling away from Lowe's in terms of this battle for market share. And, it may be a declining industry, I think, probably for both in 2023. But if you like to stay market neutral, we continue to like the, plus Home Depot minus Lowe's kind of pair trade concept.
Andy, long time no talk, and I'm glad that you brought it to this particular chart that we have up on the screen, because this is what stuck out to me when I was looking at the few that you sent over here to go over. Obviously, the y-axis is the happiness, somewhat in line. You can tell Home Depot is doing a little bit better. Home Depot's circle is bigger. We'd expect that. We know it's a bigger company. That's not all that interesting. What's interesting is no two companies are more alike in my mind than Home Depot and Lowe's. And the macro environment they're navigating is the same one. There has to be an explanation on a micro front that would cause this. This is not a statistical situation where it just happens. This is an outlier situation, Andy, where you have companies that basically have the exact same business, operate the same way, are completely going different directions. You talked about the contractor customer mix. Is that it solely? Is it that easy to explain, or is there more going on here?
No, I think that is it, but I do think that part of it is almost a reversion to the mean, because for a while there we saw Lowe's really, absolutely dominating in terms of the individual home renovation type of person. They were hitting Lowe's. The marketing with Lowe's was resonating with them far more than it was at Home Depot. And I think really this is a story of Home Depot kind of catching back up, which makes it on a year over year basis outperforming significantly. And so I think that's what has happened. I think Home Depot has gotten a lot better at messaging to that individual homeowner to come on into the store. And that's who we're hearing from. They just simply prefer the Home Depot experience more than the Lowe's experience. And that is a shift. That's a big shift from where it was just a few years ago.
Yeah, Andy, I think it's interesting that even though Home Depot dominates the professional market, they still spent $11 billion last year to come up with a buy online, pick it up at the store kind of business model to attract even more of those customers. They keep adapting to the new environment that we find ourselves. And this stock, with the S&P 500 up 1.4% the second half of last year, this stock was up 15% the second half of last year. Even though everyone thinks the economy and housing is going to slow, their same-store sales ticked slightly higher over the last year. So this company continues to perform even with a slowing economy, even with a slowing housing market. And you're right, it was kind of like, I'll give you the analogy. When Louisville plays a poorer basketball team in basketball, they might hang around for a little while. They may put up a good fight, but eventually the dominant player is going to beat them most of the time. And that's what's happening. Marvin Ellison came to Lowe's and started to close the gap ever so slightly, but now it looks like it's going right back to where it was with Home Depot in a dominant position, Andy.
Yeah, Kevin, I have to tell you, your analogy skills are falling off a little bit. Yeah, apparently, you're not following Louisville basketball this year. I think the team is 2-12, one of the worst teams out there. Yeah, but what you're saying is right. It won't last. Look, it won't last. and the deal is Home Depot, you cited all these headwinds, the economy, housing market, all these headwinds. Another headwind Home Depot is overcoming is less people coming into the store. They're getting much more out of each and every visitor than they were a year ago, 2 years ago, 3 years ago. It tells me that they've really figured out that in-store and online shopping experience in a way that has caught them up or allowed them to surpass Lowe's in terms of the individual homeowner experience. They've got the contractors kind of locked down, but it's the everyday man going in there that Home Depot has really stepped up their game, and it's paying big dividends.
Andy, one last thing before we say goodbye to you. We're looking at 90-day data. So this is pretty quick, and it's moving pretty fast for the most part. Not so fast that it's all over the place, but what are you looking for to see this trade's maybe played out, or this is coming back to normalization a little? Imagine it ever gets.
Yeah, I think that we'll really know a lot more in about 3 months. That is a huge season for, homeowners and do-it-yourself renovators coming into these stores. As we get into spring, the Memorial Day sales are huge for a reason. And so we'll continue to watch the data at that point. But for now, we continue to like the trade that's working, and that is, plus Home Depot minus Lowe's.
Andy, I was going to say Notre Dame versus Navy, but I tried to give you a Louisville analogy, and clearly you're right. I need to
Georgia TCU, Kev. Georgia TCU.
Yes.
Georgia TCU.
Yeah, that would have been a better one. You're right, Alex. That was a better one. Boy, that game was over pretty quick, wasn't it? All right, Andy Swan, thank you for coming on, as always, with your data from likefolio.com. As always, have a great day, Andy.
You too. Thanks.
All right, let's get to our trade now, Alex. Now, what I did, if you look at the chart of Home Depot right now, Alex, it has settled into a pretty tight range. And what will break that range is probably the earnings event coming up on February 21st. So what I did, Alex, I stayed ahead of that. I only went 2.5 weeks from where we are now to the Jan 27 expiration. And Alex, I went with the Iron Condor. I went with about a 15-point move from where we are now. Stock's trading about just below $317. On the upside, I did the 330, 335 call vertical. On the downside, the 300, 295 put vertical. That's trading about $1.81. So relatively pretty hefty premium for what we're doing there. But remember, you're looking for ahead of the earnings, a range-bound strategy. That's only 2.5 weeks out. Mm-hmm. If the risk on this trade, obviously, is about $3.20 because of the move that, $5 strike, collecting $1.80 in terms of premium. So your risk is about $3.20 in either direction. Alex Coffey, your thoughts on a 2.5 week Iron Condor ahead of Home Depot's earnings?
Yeah, I think that's the key, Kev, is looking for what's going to cause this stock to move. Obviously, the overall market can have movement. We talked about the CPI later this week. There are things that can cause macro movement that will likely impact Home Depot. But on a Home Depot specific front, not a whole lot to look forward to over the next few weeks. And so if you have more of the same from the beginning of 2023's trading, maybe this is just a choppy trade until we hear from the earnings.
Exactly. This has got about 2.5 deltas of short deltas in this trade, collecting theta for the next 2.5 weeks. All right, Alex Coffey, let's take our final break of the day and come back with our third stock that we're going to look at. Of course, the competitor in this show, it's Lowe's, coming up next. So take our last break of the day, come back in 2 minutes with more Fast Market. See you then, everybody.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Thinkorswim by TD Ameritrade is more than a trading platform. It's an entire trading experience. With innovation that lets you customize interfaces, charts, and orders to your style of trading. Personalized education to expand your perspective, and a dedicated trade desk of expert-level support that will push you to be even better and just might change how you trade forever. Because once you experience Thinkorswim by TD Ameritrade, there's no going back.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy.
Tune in 24 hours a day, 7 days a week on tdameritradenetwork.com to all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
Welcome back to Fast Market, everyone. Before Alex Coffey and I talk about our final stock of the day, that is Lowe's. Let's bring in Ben Lichtenstein live from the TD Ameritrade News Desk. Ben, give us a quick update here as we reach the 12 o'clock hour. Ben, what are you seeing? Markets holding firm.
They are holding firm here, Kevin. The SPX hanging out right around this 3,900
Lucille,
level
are
that
you
we
paper
found
trading
comfort in
today?
for a while now? And,
Are
I
you
can't remember the
holding?
last time the market had so much
unrolling
information to
position.
digest over
I'm
such
holding,
a short
I
period
think.
of time. I'm just going
I don't
back
know.
to
It
the
depends.
Fed minutes
Because I'm not
last
too
week,
far
all the way
off
through
enough
to
to work it
the
out.
data. This
I
morning,
need to be
ultimately,
above
that NFIB
272.
number, but
It's
as I look today, we're talking
271.35. So
stocks, the SPX down to
it wouldn't take
38.77.
much.
I saw the Russell
If she had a little
down
run this
to
afternoon, I could probably
1793
cash
before
out.
trading back
So if she gets
above
above
there you
272,
can see
I'm gonna take
holding
my
above
money and
1,800. You can
roll.
see the NASDAQ is holding
Take
above
the little
11,000.
pennies
They
and
traded down to
run.
10,500
So
today.
she
And
keeps
the
tapping
Dow
at
again holding up around
272.
that
We'll see. We'll see
33,500
what
level
happens.
as they bottomed out around 33,420
shall
today. Now this
see, we
comes
shall
after some comments
see.
from Fed Chair Jerome Powell. He
Lucille,
said
you're
in a
not by
speech
yourself
delivered
for
to
sure.
Sweden's Riksbank, basically that
But you
while
got a whole
stabilizing prices
community of
requires some
support.
tough
And
decisions,
Bibi, you
and they may be
traded
unpopular
before.
politically. He did say that the absence
So
of direct political
Lucille,
control
you are
over our
not by
decisions allows
yourself.
them to take the necessary measures without considering short-term political factors. But what really stood out to me is he said price stability is the bedrock of a healthy economy. It provides the public with immeasurable benefits over time, but restoring price stability when inflation is high can require measures that, again, are not popular in the short term. And as we raise rates to slow the economy, he's pointing that, again, this is not a popular decision on the short term. What I saw, which is interesting today, you've got stocks on the move higher. All four of the majors across the board are positive. We just showed you. You've got rates on the move higher, the dollar on the move higher. And then lastly, there's some interesting divergent activity going on in terms of the U.S. dollar, which bottomed out below 103 today. So it's been weakening off the highs that we saw late last year up around 115. But the dollar taking out the August of last year lows, while we've yet to see the TNX do the same thing. So the TNX at August low down around 2526. We're hanging in around 3537 for the most part. So still a ways off that August low divergence. We'll see if the dollar's overdone it to the downside or if rates yields have a bit of a ways still to go further lower.
Yeah, higher dollar, higher yields, and higher crude oil, yet stocks stay resilient. Ben, interesting take on these markets. Thank you, as always, for coming on. That is Ben Lichtenstein, the host of Futures with Ben Lichtenstein on the TD Ameritrade Network. All right, now let's bring in my co-host, Alex Coffey, to talk about the third of our stocks today in the home improvement retail. Alex, Lowe's. Wow, it's hard to argue or it's hard to dispute the data that Likefolio just came up with when comparing Home Depot to Lowe's. But Alex, here's one thing that isn't diverging. The chart on these two extremely similar as these two get ready for a mid-February earnings report, Alex.
Yeah, I think that's a critical point, Kev. You know, we made the comparison to last night's game, the Georgia TCU, which was beyond a blowout, Kevin. But, you know, it's probably not fair to Lowe's. They're probably not that outmatched by Home Depot, but they are the smaller of the two companies, and that's notable. But I think you brought up a really strong point, though, with if you really overlaid these charts, at least the shape of them and the general movement has almost been identical. And that should be expected for two companies that essentially operate in the exact same business and are sort of the sole competitors amongst each other. And so I'm not surprised to see that. What is interesting, and that's why I was really talking with Andy so in depth about, you know, why is this divergence happening in the data? You shouldn't expect companies that are so related to be performing that differently, notably differently. One is higher and one is lower year over year. And he provided some of the reasons there. So I thought his ideas of, you know, less than projecting where both these companies are going to ultimately go, but more about how they may fare versus each other was quite interesting. And I think that that kind of insulates you from some of this macro uncertainty that goes out there. That's ultimately how things play out.
Home Depot gets 50% of its revenue from professionals. Lowe's only 25%. They have targeted that as the competitive edge that Home Depot has over Lowe's. Lowe's has updated their store layouts, dedicated checkout lanes, revamped pro rewards programs, all to try to lure in that professional contractor. That's where they think the growth is. But Alex, in terms of a trade for Lowe's, not something as bullish or as range bound. What we did there, I did half of the iron condor, which is just a short put vertical strategy. What I did, I went out to the Jan 27th, same expiration as the iron condor in Home Depot, and I sold the 190, 180 put vertical. Now, I took in about $1.50 credit on this, but here's the problem. It's a $10 put vertical, only out 2.5 weeks, Alex. It's got a little more risk than normal, but this is half of an iron condor, but I widened it out to $10 so I could take in the full 150. Alex, I got about 60 seconds. Your final thoughts. Oh, so here's what it is. When we look at how this is trading, it's very similar to an iron condor in that is a short put vertical with no call vertical. It's collecting theta about $5 a day. It's long deltas, but this is one that is safely below where the stock is trading right now. And as long as there's a range bound strategy here, this stock will be just as profitable, but there's more risk on the downside. The margin here, $1,000 versus only $500 on the 5-point iron condor. But that's our show for today, everyone. I want to thank Randy Frederick, Alex Coffey, and Andy Swan from Lifefolio, Jenny Horn as well for coming on. That's our show for today, everyone. Alex Coffey and Jenny Horn coming up next with Next Gen Investing for all of us here at the TD Ameritrade Network. Have a great day and a great afternoon. See you tomorrow, everybody.
Many traders may be willing to take on additional risk in pursuit of aggressive growth in their portfolio. More power to them. But if you're looking for a less risky alternative, you might want to consider checking out our income investing course. In the income investing course, you'll explore investing strategies designed to generate regular income and preserve capital. First, we'll delve into risk and return preferences. You will learn about the different ways to allocate a portfolio and create a payment schedule. Then we'll take a deep dive into the assets commonly held in income portfolios: dividend stocks, bonds, equity REITs, and cash. You'll also learn about routines for managing a portfolio over time. Along the way, you'll watch videos, take quizzes, and perform paper trades to practice your new skills. So if you're looking for an edge, consider your education. Head to the Education tab on Thinkorswim for the income investing course and a whole lot more.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy.
Tune in 24 hours a day, 7 days a week on TDAmeritradeNetwork.com to all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
We empower those who act. Those who see the correlation between things above and things below the surface. Those who navigate risk by meeting every turn with a heightened awareness of what's possible. Constant assessment. Determine the best position. Catch the perfect wave. CME Group, where risk meets opportunity.
Oh, yeah, I'm going to take off.
Now, you downloaded the TD Ameritrade mobile app?
Yeah, actually, I'm taking one last look at my dashboard before we board.
And you have Thinkorswim mobile?
So I can finish
BB,
analyzing
that's
the risk.
a
Forever. Because once you experience Thinkorswim by TD Ameritrade, there's no going back.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. The platform demo webcast series is designed to help you broaden your knowledge of tools and resources available from TD Ameritrade. You'll learn tips and tricks to help navigate TDAmeritrade.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Oh, I'm back. I'm trying to give you all a view of the, I'm trying to give y'all the, there we go.
Let's walk through charts. One of the most commonly used features on Thinkorswim.
Okay, hold tight.
Start by going to the charts tab and entering a ticker
There
symbol.
we are. Did I get
Select
it right?
time frame to adjust time intervals or to favorite a time frame.
Okay.
Select style to
I
change
got
the
it, I
appearance of the
got
chart.
it. I'm back.
You can add drawings by selecting
Yay,
drawings,
everybody.
drawing tools, and then type of drawing. For symbol comparisons,
BB, you
select
in the
studies.
trade still?
This also gives you access to hundreds of pre-built studies, including a number of classic
I'm
patterns.
still in too.
The grid
I'm just
icon lets you
waiting
view
for
multiple charts at
it
once.
to
You can even
rally
initiate
back
a
up
trade
to
from the charts tab. Just
272.
right-click anywhere on the
It
chart.
got to get
and
above
select either buy or
272
sell.
for me to get out. It's at
For more demos on how to
271.32, so we'll
Thinkorswim,
see.
head to the Education Center on
We'll see.
TDAmeritrade.com.
I got a good feeling about this one. She'll rally, if not today, one day. She'll rally.
Welcome to Next Gen Investing. I'm Jenny Horn alongside Alex Coffey. And Alex, what a tone shift we have seen in the overall market today. Starting off the day lower and now green ever so slightly, but holding across the board.
Yay, green.
Yeah, no doubt about it, Jenny. I think it's important that the market's been able to build on the confidence that was really paved on Friday, and we're slowly but surely attempting to build a base here. We'll see if it can hold. You look at it, though, it's still choppy. It's still this back and forth market that we've watched all year long. It just seems to have a little bit of an upwards bias right now.
Right, and we can obviously see this strength turn back around. Wouldn't be unheard of, as we do still have 3 trading hours into the close. But a lot of names to get through today, a lot on the move. As always, we will start things off with our upvote and downvote segment, and we will chart and trade. Those upvotes are FOMO named today. We are discussing really some turbulence throughout Coinbase as they are laying off 20% of their overall workforce. And then we will discuss
Tesla. I bet you Tesla get back to 119.
As well as Royal Caribbean. A mixed picture from Morgan Stanley today. And last but not least, we will look at RBC Capital downgrading Box on turnaround concerns. So some different names to discuss throughout today's show.
Yeah, plenty to get through. Always fun, always a jam-packed show. Today, no exception. I'm excited to talk a little Coinbase. Obviously not the news headlines that we probably thought we'd be reading a year and a half ago for the company with the excitement that was in that space versus where we are now. But that's where we are. So we'll cover those. I'm excited for that. Also, Box with George will be fun. And then, of course, the cruise liners. Always interesting. I can't believe that they're still sailing at this point. So it'll be fun. Let's start with the movers, though, Jenny, because there's a good list here. And really, I think the first one on the list, of course, not endorsements, not recommendations, really encapsulates 2022 in a nutshell. Just decimated the first half of the year, losing a tremendous amount of value. That, of course, is Netflix. But really, the second half of the year, if you just looked at that 6-month performance, completely different story, although on balance, still cut in half.
Right, and I think that's such a good point. The shares have almost doubled since bottoming back in June of 2022 at around 167. They do remain down about 50% from where they kicked off their 2022, but Netflix has been a name of volatility, to put it lightly, and Goldman Sachs today raising its price target on the shares to $225 from $200, but with a sell rating, which is something we get very infrequently really throughout our coverage. This adjusted price target does indicate a 30% drop from Netflix's closing price on Monday. It is, of course, well below current levels. Around 324 is where we're currently trading in Netflix. But I also wanted to point out, because I saw this amongst the Netflix headlines today, they are the first major tech name to report quarterly numbers. That will be on January 19th. That's next Thursday, after the closing bell. Netflix has been one that, again, we've talked about its volatility. Will be interesting to see its fourth quarter report, as this is a name that has actually benefited in terms of its competition. I mean, it actually was fortunate enough to enjoy its biggest years of growth, and more notably than that, its cash burn when interest rates were near zero. Now, a lot of these legacy players that once operated in the cable realm are trying to catch up in streaming, and obviously interest rates are higher. So it's been interesting to see how Netflix has performed compared to, say, a Warner Brothers Discovery, or even, some of its other peers, because it's actually done quite well, relatively speaking, in the last couple months compared to some of its streaming competition, Alex.
Yeah, and I think what I said at the very beginning about how it encapsulates 2022, I think it is right, because you look at a name, it's still been basically cut in half from its all-time high. Was about $700. Now it's $325 or thereabouts. So a little bit more than 50% of a sell-off. But you talked about how it was down towards like the 160 level. It's basically doubled from that mark as well. It also shows that negativity can get overdone as well. So much of the volatility in Netflix, Jenny, was on like two particular sessions. It was the first quarter and the second quarter of earnings. And you saw just tremendous selling of these names. I think we're down like 40% one day in Netflix in response to an earnings, which just is absolutely unreal. A little bit more bounce back quarters the last 2 quarters of the year. So there's going to be a lot of, circles on calendars for when Netflix kicks off the NASDAQ style earnings for this quarter as well. Obviously a different tone shift than it was a year ago at this time. But you look at this name, Jenny, it's one of those original FANG cohorts. It's always kicked off and kind of set the tone of those big growth companies. It's going to be no exception this year. It's just, starting from a different place. It's not starting at 700, it's starting at 320, which is sort of middle ground.
Absolutely. And I think I'm going to still keep saying FANG, even if it's fallen out of favor. But our next name today now is Bumble. Bumble shares are rising after a key key bank upgrade to overweight from sector weight with a price target of $27 a share. And the analyst noted economic pressures are obviously easing, or hopefully easing, I guess I should say, for this dating app. He said coupled with product initiatives, international ramps, and moderating foreign supply headwinds, they are increasingly confident that core Bumble's app can sustain 20% plus annual revenue growth. In a separate note, he did mention that despite overall declines, average revenue per user growth improved month over month for all brands in December as comps begin to ease. He also did note that Bumble is ramping in international markets and thinks these Forex rates should start to moderate now in the second quarter of this year. So Bumble's 50% off its 52-week highs, has seen a nice recovery, though, of about 38% from its lows and hanging on to about a 1% gain so far this year. And also, obviously, seeing some nice strength today, up 6.8%, Alex.
Yeah, you start looking at these names. I'm going to compare it to Netflix as these are kind of both names within that growth space, still kind of pioneering new industries, but they're in different spots. Bumble is one of the main players within this space. Netflix is the main player within its space when you talk about online streaming versus online dating. I'm going to say upvote for Netflix, downvote for Bumble. This is a stock that's interesting. It's a space that's interesting. I think there was a lot of people who maybe got on these type of apps for the first time during the pandemic when social interaction was limited in some capacities in many places. And it sort of normalized meeting people through an online manner. And so that's a benefit for these companies. But down the line still, it's still got a long ways to go before ultimately figuring out just how to monetize them entirely. They're only as good as the latest app in many ways. This is the same thing as sort of the social media space. You know, one day something's cool and everyone's there, and the next day it's something else. So finding a way to stay relevant, continue to monetize your users, but also keep that experience positive. So they tell people they had a good experience, the more people get on them.
Right, and I do completely agree. There's always like an app that's popular at the moment that falls out of favor very quickly. But our next name today now, Illumina, and that name fell as much as 10% actually in pre-market this morning. Now it has recovered some, but still down substantially on the day after disclosing it expects lower than expected earnings per share of roughly $125 to $150 a share in 2024. This is well below consensus, which had been calling for $267 a share. But the company does also expect revenue growth between 7 and 10% this year. This is the low end of its prior guide for about 10% revenue growth, but not necessarily completely missing their prior expectations. But they are issuing this more cautious outlook, attributing the macroeconomic landscape. They did also see sales of their gene sequencing products moderate in the back half of 2022, which they anticipate to continue now into the new year. So pretty negative headlines for the stock today, although I do want to point out down 5.5%, a little less than, is still a recovery from their earlier losses.
Yeah, this is a space, I've said it, countless times within the healthcare space, particularly the ones who are kind of pioneering new revolutionary technologies in which this company somewhat falls into that camp in the gene sequencing realm. You got to understand this stuff, I think. And it's, way, way over my head. Obviously issued an updated financial outlook. Even I can figure out, hey, if those expectations were for better than what you told us it's going to be, oftentimes it's going to be a company with the repricing of the stock, and that's what we're seeing. But I think this highlights just the risks that are out there with one, investment into things that one are somewhat futuristic or looking ahead, and also just the risk that you could see with any stock. It's not specific to healthcare. Anytime a company comes out and tells you that their business is going to do worse than they initially expected, you should anticipate there's going to be a downwards response to that. And so I'm going to say downvote today. I think it's an important mover to highlight, but the news is out now.
Right, and I only understand the gene sequencing aspect of this enough to translate it into simpler, more easier words to say. That's about as far as my understanding goes, but definitely much more complex of a story if you dive into the weeds here. Our last name, though, is Boeing, and who would have thought that Boeing, Alex, it's our second time talking about Boeing in the last hour. Who would have thought Boeing would be such an interesting mover in the last 3 months, up a whopping 61% in the last 3 months. That's ridiculous to me. And now up 84% off its 52-week low and up about 9% for the year. So despite the fact that we're seeing shares lower today, I think look at the overall picture here. It's been very positive. Morgan Stanley downgrading the stock today to equal weight from overweight with a price target hike to $220 a share. The analyst sees the stock approaching fair value at current levels after its recent outperformance and said going forward, Boeing will trade on the execution of its 2025 and 2026 aircraft production targets and its free cash flow generation. And this analyst sees really at this point a more balanced risk and reward, noting the majority of the near and medium positive catalysts for the stock have been realized given its recent outperformance. And that was exactly our prior discussion, Alex, that this isn't necessarily a downgrade on bad news for the company or the fact that we're seeing a weakness. It's a downgrade on the fact that things have been going too well. We've seen too much outperformance that now this is just somewhat of a valuation reset from this analyst.
Yeah, it's just an acknowledgement of the successes of lately for this company. But you know what's funny is when I was typing this in is something that we should consider looking at. My phone auto-corrected to boring. So I hope Kevin isn't paying attention because I know he loves to talk about Boeing. But I'm going to say upvote here, Jenny, because if you look at the performance of this stock, it's been anything but boring. Over the last few years, it's had micro issues with 737 MAXs. It's had COVID shut down the airline industry. It's then had sizable recoveries as some of those stories started to turn, and we started to be able to go to a new chapter post 737 MAX, post COVID, or at least, letting travel resume to some extent. So, oh man, I've said this so many times, and I stand by it. If you needed a stock to highlight the risks on a macro front as well as a micro front, and then how to navigate those, and just I wanted a whole chapter on it, Boeing could certainly fit that bill. So I'm going to say upvote for Boeing. I'm excited to talk about this one.
And name, I think Boeing would actually welcome the concept of being boring. It has been a volatile years, even pre-pandemic for this name with their own onset of headwinds. So I think boring might be a welcome chapter in Boeing's next. Hopefully that's coming next for a name like Boeing, given some of its volatility over the last few years. But we'll move forward today with our upvotes, those being Netflix as well as, of course, Boeing. We'll be discussing the technicals in both of these names and looking at some example trades coming up next. Stick around. Next Gen Investing. We'll be right back.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. The platform demo webcast series is designed to help you broaden your knowledge of tools and resources available from TD Ameritrade. You'll learn tips and tricks to help navigate TDAmeritrade.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to TDAmeritrade.com/webcasts and start learning today.
Thinkorswim by TD Ameritrade is more than a trading platform. It's an entire trading experience. With innovation that lets you customize interfaces, charts, and orders to your style of trading. Personalized education to expand your perspective and a dedicated trade desk of expert-level support that will push you to be even better and just might change how you trade forever. Because once you experience Thinkorswim by TD Ameritrade, there's no going back.
TD Ameritrade Network has arrived on the floor of the New York Stock Exchange new location with access to the biggest newsmakers in Wall Street, bringing you in-depth market coverage and real-time trade ideas. Do not miss our exclusive interviews with CEOs, bell ringers, traders, and stock pickers, keeping you informed as you navigate your investments. Don't miss Trading 360 at 11 a.m. Eastern and the watch list at 2 p.m. Eastern, live from the New York Stock Exchange, only on the TD Ameritrade Network.
Welcome back to Time to Chart and Trade. Looking at two names from the previous segment at which we upvoted. We're looking at Netflix and Boeing. I keep almost saying boring now, Jenny, but looking at these two names, I think that the funny thing is if you look at the last 6 months, they're really, really strong performers and kind of exceptions to the rule in many ways. These are outstanding names in that sense versus so many other of the stock names that, I mean, look at Tesla, for example, cratering into the end of the year. Not the case for Netflix, not the case for Boeing. There we go. I keep saying it now. I shouldn't have ever said that.
I know, and it's spelled actually like very similar, so I understand the mix-up. But we'll start things off with Netflix, a name that has also been extremely not boring, actually an extremely volatile player in 2022 and having a nice day today and actually a nice week, up 3% over the last 2 trading sessions here. So Rick, for technicals, I think it's very important because I think this is a name that can sort of, I think, spark emotion. A lot of people that have an emotional stake in Netflix or perhaps were hit on the bottom now do feel this sort of response to the recent run-up in this name.
I could definitely see getting emotional about 100% rise off the yearly lows in this name. And coupled with that, you're still down 40 some percent off the highs. So I could definitely see getting some high feelings with a stock like this. Nevertheless, it's been in an upward channel for much of the past 6 months or so here, as you can see between these 2 white dashed lines, mostly staying within that boundary there. We can see that the yearly lows came in near 162 right here. So that was a point that was notable because we formed a double top, or excuse me, a double bottom around that point. The price target cut or change around 225, this blue dashed line right here, and they're bearish on this this company, so they would be looking for it to go down. So that was it seemed like it was the consolidation range from much of this area, July to August, is what they were looking for price to retreat back to here. So we're coming up to a potentially important number today, the 330 level. So that's this red dashed line right here, right below where we are now, or right above where we are right now. That was the site of where price bottomed out a couple times before we had that huge gap downward. So right around here, you can see that it bottomed out there and there. So we've got the 330 level to contend with. We're right below there. We've also got our moving averages to the downside. We pushed above all 3 of them in pretty rapid succession recently. Now we're clawed our way above that purple 252-day exponential moving average. That would be the first one to be looking for some support, though. That would be roughly around the 309 level, would be the first one of these moving averages we'd have to contend with to the downside. The one that really looked important, though, was the orange 63-day EMA right around there, because it's in confluence with our lower trend line. So that's right around the 286, 287 level. That would be an important one to look forward to as well. And an interesting thing that happened as well is that as we moved above those moving averages here, the RSI also broke above its midline. So it rose above that 50 level, which demarcates the difference between bearish momentum and bullish momentum. And we're on the move upward once again here.
Yeah, and Rick, a name that we're looking at that $330 level as a sort of marker here based on its price action right now around $324 a share and also up over 3% on the day. So a name that's definitely seen some upward momentum. However, there are still naturally the critics in this name. I feel like with the applause comes those loud booers right now that basically are rooting against this recent run up in Netflix. So Alex, considering that mindset and considering there is a case always to be made in the more bearish, mindset here, walk us through a trade that does lean more neutral, but perhaps then bearish in nature.
Yeah, one thing's for sure, when you look at Netflix, there's always exceptions, and oftentimes implied volatility will overstate the actual volatility that you see. Netflix has been anything but that. If anything, even tremendous amounts of implied volatility has understated the amount of volatility that we've actually gotten over the last year in a name like Netflix. So it's been a tough, stock to kind of curtail and wrangle with the tremendous amount of movement that it's had. And so even if you want to bet, with or against the trend in this name. Using a strategy that affords you a little bit of room might be something investors look to. And so that's kind of what I looked at here, leaning neutral to bearish in this, acknowledging its recent run up, acknowledging the analyst sentiment. I believe it was from Goldman on this one that was certainly more bearish with a lower price target. And then also what Rick had highlighted, which is that this gap has been entirely filled. Technical analysts would argue that's the easy part. Now it's the hard part again. You have resistance overhead that you have to work through, and using that to the advantage here of this kind of strategy that is looking for resistance to ultimately hold. And so looking to sell an out of the money put or out of the money call vertical, rather, the 365, 370 call vertical in Netflix for $1.25 credit. That's a 3-to-1 risk reward in which we're risking $375 to make $125. So you can, kind of quantify then that it's a high probability of success trade, which makes sense with the break even up at 366.25, almost a $40 cushion from where we're currently trading at about 325. And you can see we're in that max profitability zone. So all you would need with this type of a trade illustration is Netflix to simply not go higher. Doesn't need to go down, just can't go higher, or actually can go a little bit higher as long as it doesn't break through that 365 mark through that expiration. But in the event that it does, and it does work its way back up to those more lofty levels, then you do have risk definition here. $375 in risk is where it caps out, and that takes place above 370 if these options went through the assignment and exercise process and offset for max loss, in which that spread is $5. Net of the $1.25 credit. None of that accounts for transaction fees, of course, but just theoretical look here at this one. Neutral to bearish, one way to express that using options.
And like you said, this is not necessarily a negative trade at Netflix. You just need it to not go up. Kind of like our next story, which was our Boeing discussion today, that it's not necessarily a downgrade. It's just not necessarily saying that we see further positivity from here. So Boeing has been an interesting name over the last 3 months. Rick, I pointed out it's risen over 61% coming into today's session, just over that span. So what a run up this name has seen. But I guess right now a lot of the community is wondering is, can this hold?
Well, that's a good question to ask here, because we're coming pretty close to the changed price target near 220. This blue dashed line right here that we've been looking at, 220 matches up with the old highs from all the way back here. So we can see that that's maybe perhaps the justification for choosing that price target. But, you mentioned you accidentally called this stock boring. This is actually, in my notes, I wrote it was a pretty exciting situation today here, because we're seeing a breakout from beyond our upward channel here. We broke above the upper level of that trend line, and we're retesting it today, but we're still green. We're still holding on to some of the gains that we've made since the open. So pretty notable situation here, sign of strength that we're breaking above this trend line. And also in the RSI, we're in the overbought area. You can see that it's breaking above the 70 level there, which is a sign of strength. Contrary to the name, overbought maybe sounds like it's gone up too fast, too quickly. That's not the case. The way that this indicator is interpreted usually is that going into the overbought area is regarded as bullish, oversold area is bearish. Now the exit from the overbought area would be a more bearish sign here, and we are slipping below it today as price wanes a little bit here. So keep an eye on that one heading into the close, see if we can hold on and push back into that overbought area as well. In terms of support and resistance, that 220 level seems like a very likely area to encounter some resistance or consolidation in trend. Likely that a lot of traders will have their eye on it, And to the downside, we've got our yellow 21-day exponential moving average right here. Near about the 194 level, just above our lower trend line. And that would be not quite in confluence, but they're pretty close to each other. The lower trend lines maybe around 192 or so. Beyond that, we've got our two moving averages to the downside there, near about 177 and 171. That seems like a pretty far cry at this point to be worried about, given that the stock is trading above 206 right now. So, yeah, basically a pretty interesting, noteworthy situation for a company that's had a noteworthy year.
Right, a noteworthy year, and hopefully that can progress into 2023. And I kind of feel like I'm rooting for Boeing just based off of the onslaught of mass negativity that has hit this stock for the last 3 years. So I do see and appreciate the recent run up in this name. And Rick, we'll leave it there. But good technicals in Boeing to look at today. Rick Ducat, our chart master, every day on Next Gen, of course. And Alex taking this optimistic approach as I love when you can see a stock that has continued its run up. I feel like a lot of these rallies have faded or been rejected at certain levels, but this has continued. Walk us through example trade, then leaning more neutral to bullish.
Yeah, just taking the trade that we looked at in Netflix, Jenny, and just flipping it upside down, the same general concept. So rather than needing Boeing to continue its rally, just rather hold its rally. Don't want it to go down. That's kind of the concept behind this. I think that's the sentiment from the analyst as well. It's not necessarily a bearish call. It's just more of a, hey, cool off for a second here. Let the rest of the market maybe catch up to the outperformance and then continue with some positivity here in the stock. Rick had highlighted just below the 195 mark, but both those measures that were determining that support are upward sloping. So as time goes on, it'll work its way towards potentially 195. And that's sort of where I circled and went to for the short strike here on this short put vertical strategy that we're looking at for the trade illustration. And so going out to February, the same monthly expiration as we did in Netflix, February 17th, the 195, 190 put vertical for the exact same credit that we looked at in Netflix, $1.25. So risk reward identical, 375 to 125, 3-to-1 ratio on that. Break even of 193.75 kind of coincides with what Rick was talking about with that moving average and that upwards sloping bottom part of that channel that he had highlighted on his chart. But again, as those move out in time, they are moving upwards right now. So potentially those support levels could just continue to increase if this could hold on to some of its recent gains. But looking at this, for this one, obviously in the max profitability zone already, just needs to hold on to that. A little bit of cushion of about $10, $11 until we get to that strike if it does turn sour. A little bit over a month or so in this trade if it was held to expiration. Best case scenario would be that these options expired worthless. But in the event that Boeing does slip, it is risk defined, as we said. Max loss takes place below 190. If those options went through assignment and exercise and offset each other for max loss on this one. So really just showing the exact same strategy, but in the neutral to bullish sense instead of the neutral bearish as we did in Netflix.
And utilizing a more neutral stance and, of course, just being straight in your conviction with neutral or, bullish or bearish. But also important to keep in mind for both of our example trades today, they do contain multiple legs that can lead to higher transaction fees. Short options can be assigned at any time, and carrying option positions into expiration can add risk like unanticipated exercise or assignment. Now, coming up next, we will talk Coinbase actually having a really nice day despite news that we got that they're laying off 20% of their workforce. We'll dive more into the crypto exchange stock coming up next.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads like counters and diagonals are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the education tab on Thinkorswim for the full Options for Volatility course and a whole lot more.
TD Ameritrade Network has arrived on the floor of the New York Stock Exchange new location with access to the biggest newsmakers in Wall Street, bringing you in-depth market coverage and real-time trade ideas. Do not miss our exclusive interviews with CEOs, bell ringers, traders, and stock pickers, keeping you informed as you navigate your investments. Don't miss Trading 360 at 11 a.m. Eastern and the watch list at 2 p.m. Eastern, live from the New York Stock Exchange, only on the TD Ameritrade Network.
Opportunities can be hard to find, like catching lightning in a bottle. In uncertain times, it's tempting to retreat or simply wait and see. At CME Group, we empower those who act. We deliver tools to help manage risk and capture opportunities in every market climate, across every major asset class, to seize each possibility at precisely the right moment. CME Group, opportunity is everywhere. Each possibility at precisely.
It's time for Developing Story. Joining me now, senior markets correspondent for the TD Ameritrade Network, Kevin Green, is here. And KG, you got your eyes on Apple and Broadcom. What's going on?
Yeah, definitely. So we had some news from Apple. They are actually going to be producing their own Wi-Fi and Bluetooth chips by 2025. And really the main supplier of those chips right now is actually Broadcom. And we are seeing the impact on the stock for Broadcom right now, down about 3%. But overall, it's just a part of their strategy when it comes to Apple to be able to really try to internalize their own manufacturing processes. They're actually doing the same thing for chip components that are coming from Qualcomm as well. But one thing to just kind of note, when we're talking about Broadcom, Wi-Fi and Bluetooth chips are really only a small portion of the overall production that's actually provided to Apple. The really big portion of their business is going to be the wireless charging chips as well as radio frequency chips as well. So we have some Bernstein analysts that are coming out and saying that the impact of Broadcom's earnings in 2025 may be about 3 to 4% when it comes to earnings per share. So obviously that's still a little bit measurable, but there's other components that Broadcom is going to be able to provide in the long term here. But we are seeing this shift coming from Apple from trying to outsource a lot of its production for its chips and trying to internalize them, trying to be able to lower the cost for the business in the long term here. And we're just going to see how long it's going to take for them to transition. Right now, the target is 2025, but we might see it a little bit earlier, Alex, depending on the overall market conditions.
Yeah, or later, too. I mean, it's already, they've had a little bit of hiccups in their chip ventures thus far, so we'll see if they can navigate what has been a little bit more tough than I think they initially thought it may be. But you know, my question, I think you kind of answered, was going to be, you know, what's to stop a company from Broadcom to say, you know, screw you, Apple, we're just going to not do any business with you anymore. But it sounds like, you know, this pivot, at least for now, is just starting with a small piece of the business that these two companies work together on. But you know, you start looking at this, if you're a company like Broadcom or Qualcomm or the others, don't you sort of see the writing on the wall of where this is ultimately going?
Potentially, but you also have to just keep in mind, too, they want to be able to keep that revenue in-house as much as they possibly can. So even though we see these type of transitions in corporate America, you don't want to just completely write off somebody that you've been doing business with for a long time. That also impacts your overall brand within the market space here. But it does give them a little bit of time to be able to readjust, maybe focus on other product offerings that might be able to provide higher margins, or might be something of a futuristic type of technology here, Alex, as well. So yes, we are seeing this transition. We'll see if Apple is going to be able to pull it out. You're right when it comes to the Qualcomm chips that they're trying to replace. It's been a little bit slower than what they have expected. But what's good about Qualcomm is they've already really factored this into future earnings as well. So they're really assuming that they're going to provide about 60% of the chips for this year when it comes to Apple, and then slowly pare itself down over the long term. But yes, obviously we are seeing a little bit of an adjustment. This might be an adjustment as well when it comes to geographic strategy for manufacturing. Obviously, when we saw the COVID-19 pandemic, that really impacted a lot of these technology companies. And so they're trying to strategize on how to minimize that impact if we do see a COVID pandemic or another economic event that could impact supply chains.
Yeah, I was seeing as well, Apple also making news. It looks like they released some of their App Store revenue data as well. And maybe that's highlighting a little bit of slowing, might explain why you see a little bit of a downtick today in Apple. But obviously this story is more the center around, what dominoes fall. And as you talked about it, it's ultimately Broadcom that is the potential loser to some extent of this transition. But as you've highlighted, small portion of the business these two companies work together on, and obviously a story that's going to unfold over the better part of the next couple of years. But Kevin Green, always a pleasure. Senior markets correspondent for the TD Ameritrade Network. Always great insights. Bring Jenny back in. Let's talk some Coinbase. Time for FOMO. And, this is, to me, the most kind of crypto story of all time. Kind of a, restructuring, seems like bad news kind of a situation, yet the stock goes higher.
I also think that with this restructuring news, just because we've gotten so many other companies that have announced similar headlines in the last few weeks, is that a lot of it's dictated by the overall market. So we're right now in a green market. Obviously, we're seeing some strength across the board. We are seeing a strength and a nice move higher in Coinbase. We saw when Salesforce announced their layoffs, they also saw a nice rally because we were rallying with the overall market. That has not been the case when some of these companies have reported on different sentiment in the overall market. So I think that's also important to keep in mind, because this was objectively not good news. I mean, they're laying off around 20% of their staff. They're enacting broad cost cuts, which is the latest sign of pain for this cryptocurrency exchange. Now, they will reduce their operating expenses by about 25% from the prior quarter, including then laying off about 950 employees. By the end of September, they had around 4,700 employees. So just to put it into mind scale, this is not a massive company by any means, but important to keep in mind that rival exchange FTX's collapse has sparked a fresh round of layoffs throughout the entire crypto industry. This is not necessarily a Coinbase specific story, as they are just the latest company to announce similar news like this. But in a blog post explaining the layoffs, their chief executive, Brian Armstrong, cited the fallout from unscrupulous actors in the industry and said there could still be further contagion ahead. That is, to me, the biggest problem here, is if this is another round of layoffs for the company, if there's more ahead, that is a concern for investors, of course. But the slowdown in the broader tech sector has sparked layoffs. We've seen just in the last 2 weeks, Alex, companies like I mentioned, Salesforce, Amazon, Stitch Fix, Goldman Sachs, McDonald's, and Vimeo all announced layoffs. So while I do think there's a crypto element here, it is also just a element of 2023's economy, I think.
Yeah, and we keep reading about how strong the job market is, et cetera. I mean, we got to look at the writing on the wall at some extent, too. I mean, these are jobs, particularly a place like Coinbase, that there isn't other jobs like this out in the market. Like, there isn't just crypto jobs all over the place right now. So you start looking at this, and yeah, maybe it's isolated to particular parts of the economy more so than others. But, McDonald's to Amazon to Salesforce to Coinbase, there's not a ton of overlap between all those companies. So you start looking at this and saying, hey, I understand that the household and establishment reports are saying one thing, but all these big companies are telling us a completely different story. And so we'll see where this all comes to a point. What's interesting to me, though, is, you look at a place like Coinbase, had all this excitement for investment because of all the excitement around the future of what digital assets could and were ultimately supposed to be from the kind of pitch that a company like Coinbase makes to investors. How do you get there if you're making these type of decisions? And obviously, I'm not saying that they couldn't or they didn't have to make them. Obviously, they got to find ways to preserve capital, cut costs, and the like. But you look at this, and how are you going to revolutionize things if you're pulling back on expenses? Like this is the meta dynamic as well. They want to revolutionize the metaverse. But if you're not going to spend there, how are you going to do that? And so you start looking at this space. Ultimately, it's going to come back to trust and integrity in the space and establishing themselves as one of the names that deserves that. And ultimately, time will tell if that's the truth or not. But it starts also with Bitcoin maybe stabilizing and maybe working its way higher too.
I think that's also critical. And I think you have to have some faith built back in Bitcoin and the broader crypto space. I think that some degree of trust has been lost. And when you read deep into this FTX story, which I have on countless occasions, it only makes you mistrust some of the system and the infrastructure that's built behind this entire industry a little bit further, which is, I think, then it's not like FTX collapses and this is great news for Coinbase. I think that it's negative for all crypto exposed stocks, which we've clearly seen in its recent price action. But then when trading this name, Alex, what are you thinking? Because I think this is a little bit of a black mark right now. I think that a lot of people right now don't want to touch these names and don't like investing in something that is still so speculative.
Yeah, I think that can be opportunistic for some, though, who are willing to stomach that risk. And there's risk here, no doubt about it. Particularly when you look at, you talked about some of the peers of this industry and the kind of the black eye that has been put on this industry from some of those choices made by different companies within this space and the integrity being at question. But I've always questioned the idea of these centralized exchanges for what's pitched as the decentralized currency or market. Those two things don't jive. But for those who are believers in this, are looking at a name that's been, bettered over the last few years, a space that has almost all-time low sentiment right now. Maybe you have oversold conditions and a bounce, even if it's just short-term, could be in the making, and there's ways to capitalize on that. I think risk definition is paramount in a name like Coinbase or anything that is perceived as highly speculative. And so I wanted to highlight a trade illustration, Jenny, that is risk defined, but still could capitalize on an upwards move. And so looking at buying a call calendar here, Jenny, the February, March, give it a little bit of time for some sort of move to develop and unfold. But buying the 55 call calendar for $1.25 debit. The strike is somewhat arbitrary. It could be selected at a different mark based off a particular investor's outlook on a name, but this stock's been so beaten down. When it does move, it has the potential to move a lot, both directions. We've seen that. And so I wanted to give it a little bit of room here, and just in the event that if it does bounce, and it does bounce a lot, we don't get overrun. That's still possible even at 55, as this stock has proven at times that it can have tremendous volatility. But this strategy benefits the most, the more precisely and accurately you can project where ultimately it goes. And so it peaks out here on the risk profile right at 55, as anticipated. This is customizable. Someone who's more bearish, more neutral, less bullish, more bullish. There's a strike out there that maybe better reflects the level that you see going, but this is just one way. Limit that risk a little bit, still take a speculative directional position on a name like Coinbase, participate, have an opportunity to have some sort of multiple on that $1.25 as return. But in the event that it doesn't happen, the risk going in. And for many, that would be something they could stomach. And I would hope for all that risk on any trade is what they can stomach before they ultimately click that button.
Yeah, that should be absolutely something you consider before you go ahead and click that send trade button. I do think that's something I always consider. Just risk right now is so important, especially in a name with a lot of risk like Coinbase. But that does it for our FOMO segment today. And now coming up next, we will talk the cruise lines, the names that have actually performed quite well so far this year. We'll dive into why one analyst feels that we can see some strength in Royal Caribbean and some not so strength in Norwegian Cruise Line.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Looking to improve your portfolio management skills? Our portfolio management webcast series breaks down key concepts like retirement planning, income generation, ETFs, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcast and start learning today.
Thinkorswim by TD Ameritrade is more than a trading platform. It's an entire trading experience that pushes you to be even better and just might change how you trade forever. Because once you experience Thinkorswim by TD Ameritrade, there's no going back.
Oh, yeah, I'm going to take off.
Now, you downloaded the TD Ameritrade mobile app?
Yeah, actually, I'm taking one last look at my dashboard before we board.
And you have Thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set.
Choose the app that fits your investing style.
I'm Nicole Petalides, live on the floor of the New York Stock Exchange, empowering investors every single market day. Tune in to the TD Ameritrade Network.
Welcome back to Next Gen Investing. Let's talk some cruise liners here. Jenny, we're looking at a couple of the names in this space, and you know, we're on record. We're not cruise people.
We're not cruise people, but I can't get excited about the fact that, I mean, Royal Caribbean's up about 18% since the start of this year. That makes me excited a lot more than getting on a cruise, I will admit. But mixed picture from Morgan Stanley today, upgrading Royal Caribbean, downgrading Norwegian Cruise Line, which Norwegian Cruise Line was the great outperformer of the cruise lines back in 2022. So here to tell us now more on this analyst note is Renita Young, Senior Markets Correspondent for the network. So Renita, what are your thoughts here? What is this Morgan Stanley analyst saying, and why do they like Royal Caribbean better than Norwegian?
Well, first off, for the record, I'm not a cruise person either, so we all have that in common.
You're in good company.
But right now is a really good time to talk about this because it's the peak appointment season, the peak season where people are starting to make their reservations for cruises. They call it the peak wave season, the wave season specifically. But Morgan Stanley is happier about Royal Caribbean, less happy about Norwegian Cruise Lines. And so far, the major difference has been the ability to hold debt. Norwegian Cruise Lines, this analyst says at Morgan Stanley, has more debt, and that's the bigger risk than what's happening over at Royal Caribbean. Now, they're both under a risk of the consumer tightening their pockets, right? But then you still have those consumers who, they may not buy the iPhone, they may not buy the electronic piece or whatever gadget that might have been on their minds, but they may buy the experience instead. And so Morgan Stanley downgraded Norwegian from equal weight to underweight from equal weight. And the price target set that at $11.50. He's seeing a choppy path to reopening during this really uncertain consumer spending environment. Royal Caribbean, on the other side, is seeing an upgrade from underweight to equal weight. And Morgan Stanley boosted their price target on Royal Caribbean from $40 to $50. And so they're also still, again, concerned about something different, actually, overcapacity dampening the pricing power. There may be too many people who want to go on these trips, that it may start to knock some of the prices down. The companies, that's not an issue that they want to have.
Mm-hmm.
Yeah, it's super interesting. There's dynamics within this space. You know, they might go 0 for 3 amongst the three of us here, Renita, but there is a big section of the population that is all in on these cruises, big enough at least for some of them to have overflowing demand. But I know that there's pricing dynamics as well, and sort of the perception of quality amongst these. The Norwegian kind of perceived as that higher quality experience versus its peers. But we're going to leave it there. It's been a choppy waters, to say the least, for the last few years in these names. We'll see if 2023 can be a little bit easier sailing for them. But Renita Young, always a pleasure. Thanks for joining us, Senior Markets Correspondent for the TD Ameritrade Network. Coming up next, it's Under 30. George Tillis is going to stop by. We're going to be looking at Box with George, so stick around. We'll be right back.
Watchlist can help you keep track of securities you're interested in. To add a watch list to the left sidebar, select the plus sign, then watch list. When the default list appears, select the name box, then create watch list. Enter a watch list name. To begin adding securities, enter a ticker symbol in the symbol box, then select enter. Continue adding all the symbols you want in your watch list, then select save. The existing list is replaced by the new one. You can also create watch lists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then add to watch list. From the Scan tab, right-click a security and then Add to Watch List. And that's how you make a watch list. For more demos on how to think or swim, head to the Education Center on tdameritrade.com.
Thinkorswim by TD Ameritrade is more than a trading platform. It's an entire trading experience. With innovation that lets you customize interfaces, charts, and orders to your style of trading. Personalized education to expand your perspective and a dedicated trade desk of expert-level support that will push you to be even better and just might change how you trade forever. Because once you experience Thinkorswim by TD Ameritrade, there's no going back.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network.
Welcome back to Next Gen Investing. It's time for Under 30. Taking a look at a name that is under pressure here today. Box Incorporated down 6% here, Jenny, to $28. So back under 30.
Back under 30. I need a lot more details about Box Incorporated, Box Inc. Ticker symbol Box tells me nothing about this company. All I know is that RBC Capital did downgrade shares today. So here to tell us more now on this name is George Tillis, Senior Markets Correspondent. So George, what is going on with Box? What's up with this news? RBC Capital not feeling too positive, clearly, in the market not loving this name today either.
They're not liking it today, but it's been a pretty good performer actually since the pandemic. But for those who don't know, I mean, it's basically a cloud-based content management platform. In other words, cloud-based content storage and content collaboration among small and medium-sized businesses, which actually are the focal point for customers of Box. But they also allow customers to utilize custom application development and web and mobile desktop applications for their services. And one of the things about the company itself is that actually it's essentially agnostic or separate from companies like OneDrive from Microsoft or Google Drive, which are a couple of major competitors. And I think that's one of the attractive value propositions for Box as an alternative to Microsoft or Google. The company itself did receive a downgrade today, so it's down substantially because of this. RBC moves their target to $24.28. They moved it to an underperform from sector perform. They actually see some of the growth catalysts for the company, in particular their Japanese market, where their revenues are about 20%. They actually demonstrate some decelerating sales in Japan. In fact, if you look at Q3's sales in that region of the world, about 43% growth, and Q2 is 50% growth year over year. So that's still substantial for about 1/5 of their sales, which is, again, in the Japanese marketplace, but they're demonstrating sequential or quarter over quarter declines. And so with that said, the expectations on earnings for Box, which are expected to be around $1.17 a share in the next 4 quarters, might be challenged because of some deceleration in growth prospects in their Japanese core market. So I think that's one of the reasons why we see RBC downgrade the stock. I think it's more of a modest downgrade. It's not necessarily a sell rating on the stock. The trend is still intact. If you look at it on a 3-year weekly chart, it's actually been performing quite well. The lows are right around the pandemic, where I think $11 or $12. So since then, the stock has more than doubled.
You know, George, I have a feeling this analyst might be a fan of the show, because one of the key points that this analyst highlights is something I feel like I say and ask you about every time we talk about one of these up-and-coming tech firms, which is what happens when Microsoft decides to swat the fly that's just kind of annoying them. And it sounds like that's another thing that RBC is highlighting here, because they're saying a threat from Microsoft and its underinvestment in SharePoint and OneDrive. All it takes is a little bit of focus, and what is Box going to do?
That's a great point. At the end of the day, there are competitive challenges, especially with the vertically integrated behemoths like Microsoft and Google. And all they need to do is, like you said, Alex, make a small amount of investment to enhance their services to perhaps outcompete companies like Box Incorporated. So I think these are risks that you have to consider. And it's really the competitive landscape risks associated with major storage competitors, like you said, Microsoft and Google. But at the end of the day, the market will tell us. It'll tell us essentially when there are challenges from a competitive front. The company itself will start either downgrading its earnings guidance, missing earnings, or effectively demonstrating deceleration in revenue and EBITDA growth. Now, for the next 4 quarters, the company is still expected to grow 12% revenue growth. Now, that's a little bit less than the last 4 quarters at 15%. But at the same time, they're expecting their EBITDA growth to grow at 20%. Now, that's probably going to change now because of the analyst downgrade from RBC. But at the end of the day, this is the information we have. EBITDA growth is nearly double that of sales growth on a forward basis. And that's promising for an upward trend. But again, once they report earnings, when they report the Q4 earnings, if they demonstrate earnings and sales that don't manifest into expectations, it might start to pose a challenge for the company's stock price. But until that point, I mean, the trend is still higher. It's still trading above its 50-period moving average at the very least on a weekly basis, despite the decline today. So I think what you're saying, Alex, is poignant. It does make sense. That is a threat to the company. But there is another avenue where a company like Box, which is profitable and is growing its revenue and EBITDA on a forward basis, might become an attractive target for other competitors out there. I can't say who it would be, but it's just something to consider.
Yeah, and George, like you mentioned, it is up about 26% off its 52-week lows here, but a rough start to the year, now down about 9% since the start of 2023. But we'll leave it there, George. Appreciate all of your insight and filling us in on Box, a company I admittedly did not know a ton about other than their Salesforce partnership. But George Tillis, senior markets contributor for the network. That also does it for Alex and myself for Next Gen Investing for this Tuesday. Coming up next, we have the watch list with Nicole Petalides.
Let's walk through how to analyze a company's financials on thinkorswim. To get started, go to the Analyze tab and select Fundamentals. Enter a symbol, then select Enter. To download detailed analyst reports, select Download. By the Numbers provides balance sheet information and other fundamental data. Company Details provides summary takeaways on key metrics and what drives the stock. Takes a more numeric look at similar information. If you find any of the information particularly helpful, you can print it out or take a screenshot. For more demos on how to thinkorswim, head to the Education Center on tdameritrade.com.
We empower those who act. Those who see the correlation between upswings and downswings. Those who manage risk by meeting each obstacle with a perfectly executed strategy. A measured approach, the right tools, driving accuracy. CME Group, where risk meets opportunity.
When traders tell us how to make thinkorswim even better, we listen. Like Jack. He wanted a streamlined version he could access anywhere, no download necessary. And Kim. She wanted to execute a preset trade strategy in seconds. So we gave him thinkorswim Web. Because platforms this innovative aren't just made for traders, they're made by them. thinkorswim by TD Ameritrade.
Many traders may be willing to take on additional risk in pursuit of aggressive growth in their portfolio. More power to them. But if you're looking for a less risky alternative, you might want to consider checking out our income investing course. In the income investing course, you'll explore investing strategies designed to generate regular income and preserve capital. First, we'll delve into risk and return preferences. You will learn about the different ways to allocate a portfolio and create a payment schedule. Then we'll take a deep dive into the assets commonly held in income portfolios: dividend stocks, bonds, equity REITs, and cash. You'll also learn about routines for managing a portfolio over time. Along the way, you'll watch videos, take quizzes, and perform paper trades to practice your new skills. So if you're looking for an edge, consider your education. Head to the Education tab on Thinkorswim for the income investing course and a whole lot more.
Good afternoon. Welcome to the Watch List. I'm Nicole Petalides. It's 2 p.m. Eastern Time, coming to you live from the New York Stock Exchange. Thanks for being with us. After some back and forth action, markets are clearly in the green here. You can see across the board, all four of the major averages are gaining, with the Dow 33,616 up 99 points. The S&P at 3908 gaining 16 points, and the Nasdaq up 0.5%, 11,164. The Russell at 1 full percentage point higher. Those small caps gaining 1814 is the level there. This as we await the CPI inflation print. We already heard from Jay Powell, and of course earnings on Friday. For some of the biggest stories in the markets, we welcome in Renita Young, senior markets correspondent here on TD Ameritrade Network, to take a look at some key names. Broadcom lower today on news that Apple might make their own chips. Tell us all about it, Renita.
Increasing this push to try to bring the creation of its chips in-house. And because of that, we saw a report saying that it's going to stop using some of Broadcom's components by 2025. This is a huge blow to Broadcom by some measures. Now, some analysts say that because this is one of Broadcom's main contracts, it's a blow. Broadcom is down right now on that news, and it could be a potential risk to the business, of course. But at least one analyst of another company is saying that this is not as bad as you think it is. Now, he reiterated the outperform rating on Broadcom and a $675 price target, saying that since Broadcom sells several other parts to Apple, those are currently affected, the connectivity chips, those represent a small part of Broadcom's Apple and wireless exposure, in that if, for instance, the radio frequency chips were going to be brought in-house, that would be a much bigger blow to Broadcom. But there's also news out talking about Apple removing some of Qualcomm's pieces. Qualcomm has turned positive on the day. So we'll find out how this will impact at the close.
Yeah, and there was even one report that said Apple could be just saying this so that they can get a better deal from Broadcom and using it as a negotiation tactic. Less likely, but I thought it was an interesting perspective. How about the news on Coinbase? Because we've already heard about layoffs, and now in the second round coming.
Yes, second round now in the past few months. The latest round was in September. Then we heard, of course, don't forget about the round we heard earlier last year over at Coinbase, where they laid off more than 10% of staff at that time. But Coinbase is laying off about 20% of its current staff. And this came through a regulatory filing. But investors like this news. They're saying, hey, listen, any way you can cut costs, we're here for it, because the stock is up nearly 8%. But the CEO there talking about some bad actors in the cryptocurrency industry that are really making the contagion worse for other companies. We're looking at FTX, of course, and the collapse of that. And something interesting also happened today. The first crypto insider trading case just yielded a 10-month prison term. And this involved a former Coinbase employee whose brother was able to net close to $900,000 while using a fraudulent technique, and that's according to prosecutors.
An interesting part of the story. Renita Young, thank you so much for all of that. Appreciate it. Now let's take a look at the bigger picture. Greg Swenson's with us, founding partner at Briggs McAdam. Thank you, Greg, for being here. So what are your thoughts on 2023, where I feel like we're already somewhat embedded here? Started off really great because we had the Santa Claus rally and a good start, but does it feel like a bear market rally?
Yeah, I still think it's a bit of a bear market rally. It's interesting. It's almost like the market is challenging the Fed, which is somewhat confusing because or they're embracing this bad news is good news. The employment numbers came out Friday, which on the surface looked like good news, but then you when you dig in, you had temporary workers lost 35,000 jobs, which is usually the sign of the end of the cycle and the beginning of potential recession. So so I think there's some there is some conflict. I think we'll have the first half of the year being a bit more cautious, and you'll see maybe a continuation of last year where the defensive sectors do well, and then maybe at the toward the end of the year when we can see the Fed reversing and possibly even easing by the end of the year. That will turn things around or give a lift to the market. But I think it's still early to make that assumption.
And how likely in percentage terms, let's say, so we get a feel of, how likely is that they actually not only turn it around, but also start easing?
Well, there's a bit of a, you have to look at the plateau, the time from the last hike to the first ease. Now, historically, or in the last 50 years, it's been roughly 4.5, 5 months. But the last 7 cycles, it's been a little bit longer. It's 7 to 8 months. So I think, if you see the Fed tighten a few more times, get the Fed funds up to 5%, try to get it to a level that might have some effect on economic output and especially on employment. Then you can look, when you've made the assumption that it's the last hike, you can look at, anywhere from 4 to 8 months before they start easing. It sounds like the market wants that sooner than they might get it. And again, I think they're pricing in a lot of good news here.
Right, understood. So at this point now, the Fed, they're making it their case to continue moving forward with rate hikes. How many more rate hikes do you think we're likely to see? Because we did hear from Daly and Bostic talking about 5% plus.
Yeah, I think we can safely bet on that, because the only way to address inflation is to have economic contraction and higher unemployment. I hate to say that, but because of the hostility to the private sector, to the supply side, I don't think there's any other way to do it. 40 years ago, when we had a similar inflationary environment, you had rate hikes, yes, but you also had liberation of the private sector in the form of tax reform and especially deregulation. I don't expect that in the next 2 years. So I think we'll see continued hostility to the supply side, to job creators. And that means the only way that they can stop inflation or reduce inflation is to reduce demand by increasing unemployment. There's really no other way, given that they're constrained, or the economy is constrained by hostility to the supply side.
And what's your advice to investors? I see that you have multiple ways of putting money to work in different sectors, for example, even in private equity. Tell me a little bit about some ideas that you tell folks about.
I think in the near term, if you have to be in the liquid markets, buy short-term bonds. You could buy 3-month bills, 6-month bills, and get close to 4%. So I don't see any reason not to do that. Stay away from long duration, both fixed income long duration as well as long duration equities like tech, and then start to make the transition mid-year in the liquid markets as you see the end of the Fed hike cycle, and you can have a bit of a lens on easing, which we could get, believe it or not, in late 23, but more likely in early 24. And then as far as the private markets go, there's a lot of opportunity in, critical infrastructure, agriculture, the basic needs. You see basic needs up in the U.S., gas, groceries, and utilities up in the high teens. So, the CPI numbers are going to come in, 6-7%, and yet the critical ingredients are still in the high teens. So that's worrisome. And then you see it globally with the food security issues and energy security issues, especially that we're seeing here in Europe and in the UK. So I think there's a lot of opportunity in energy, in private capital, as well as agriculture and infrastructure. You saw one of the best performing markets last year, obviously, was commodities, the best performing, but also right behind it was Latin America because of their correlation to commodities. So there's some opportunity in places like Africa and Eastern Europe that are harder to play in the public markets. But if you can invest in private equity, infrastructure funds, those are the places that will really benefit from non-correlated, inflation-protected investments in really critical needs that we saw, became front page news last year, especially after the invasion of Ukraine.
Yeah. And you said you don't like Europe at this point. That's something that is important in the big picture. You don't care for Europe at this point. Tell me a little bit about here at home. Are there any mistakes anybody can make? Would it be to do nothing? Would it be to get into a certain sector or area that you think probably won't work?
I think you have to be patient. So, there is this temptation, especially when you see rallies like today, there's a temptation to get, ahead of the Fed and start buying cyclicals or consumer discretionary, some of the sectors that were really beat up last year. But I think you have to be patient, wait till the end of the year. You're never going to time it perfectly, but there will be an opportunity. And, you're seeing a rally today. You mentioned, Nicole, in small cap US. I think we'll see a lot of that toward the end of the year. And some of the laggards from last year, like real estate and small caps, will do really well. But again, you have to be patient. So I would be really cautious. Stay with, for now, utilities, staples, some of the defensive sectors. But there'll be a moment. I also think banks might be attractive. And actually, I think they're attractive right now. But again, I think you can be patient with those.
Yeah, we'll have a lot of banks on Friday. We kick off earnings season. Do you like some more than others?
Yeah, well, you've seen a real rally in the non-bank financials. So, the insurance sector has done really well. Some of the finance companies have done really well, and are up significantly in the last few months. 15%. Whereas the banks, the large cap banks are only up 2 or 3%. So I think when you see the numbers come out this week, you'll see some opportunity. JP Morgan, I think, is cheap by most metrics. And I think, some of the other large banks like Wells is coming around. So there'll be opportunities, in the banking sector that have, specifically lagged the non-bank financials.
Yeah, understood. Greg, it's great to chat with you. Greg Swenson of Greg McAdam. Thank you very much. Plenty ahead here on the watch list. Another earnings miss for Bed Bath & Beyond. So what's next for this company? Stock is jumping. Why is that? Bankruptcy could be looming. And we'll discuss how high energy prices are impacting the overall economy. Our panel is ready for a consumer staples outlook as well. And Technical Tuesdays, Kevin Horner standing by to take a look at the charts of Exact Sciences and Walt Disney. That is all ahead right here on the watch list. Stay with us.
Let's walk through charts, one of the most commonly used features on thinkorswim. Start by going to the Charts tab and entering a ticker symbol. Select time frame to adjust time intervals or to favorite a time frame. Select style to change the appearance of the chart. You can add drawings by selecting Drawings, Drawing Tools, and then Type of Drawing. For symbol comparisons, select Studies. This also gives you access to hundreds of pre-built studies, including a number of classic patterns. The grid icon lets you view multiple charts at once. You can even initiate a trade from the Charts tab. Just right-click anywhere on the chart and select either buy or sell. For more demos on how to thinkorswim, head to the Education Center on tdameritrade.com.
When traders tell us how to make thinkorswim even better, we listen. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim Trading from TD Ameritrade.
It's a 13-hour flight. That's not a weekend trip.
15 minutes.
It's only fine. I'm going to take off.
Now, you downloaded the TD Ameritrade mobile app so you can quickly check the markets?
Yeah, actually, I'm taking one last look at my dashboard before we board.
Excellent. And you have thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set. Have a great flight.
Hey, thanks.
We'll see you. They're getting so smart.
Choose the app that fits your investing style.
Welcome back to the watch list. I'm Nicole Petalides on the floor of the New York Stock Exchange. Let's take a look at some of the movers in the market right now. We're watching Oak Street Health. It's up almost 27% after a report that CVS Health is exploring a potential acquisition of the company. The deal could be worth $10 billion. Oak Street Health runs primary care centers for Medicare recipients. Morgan Stanley downgraded Boeing to equal weight. The analyst saying that the stock is approaching its fair value and that near-term positive catalysts have been realized. William Blair downgrading on Semi to market perform from perform without a price target. The analyst said auto demand will test the company's gross margin. And Bumble is higher after KeyBank upgrading that stock to overweight. They are increasingly confident that the dating app can sustain 20% annual growth given the recent consumer trends and product initiatives. And here's a look at Bitcoin today. Every single day we check in on Bitcoin, still holding at 17,000 mark, 17,505, up 1.6%. It's time now for Technical Tuesday. And of course, Kevin Horner's with us, Senior Manager, Trading Services Education at Charles Schwab. Kevin, great to see you on this Tuesday as usual. I know you're looking at Exact Sciences, which when you look at the chart, you say, oh, look at that, it's up off the lows. And while it's pretty choppy and had some big gaps recently, still 20% off the highs, or I should say 20% down one year down 20%. So looks like it's getting better, but is it? You tell us.
So, it's a bottoming processes take a very long period of time. And one of the interesting things about the Exact Sciences chart is the longevity of that downtrend. It underwent a 75% retreat, peak to trough, February of 21 to about the October bottoms we made with the rest of the market here, middle of the month. So about 75% negative from that substantial move. And one of the things we often talk about with technicals, of course, is that the longer a move, the stronger that move is. And subsequently, of course, beyond that, when that trend breaks is when you may have your best opportunity to participate. So, I have to apologize. Last week, I tried to get to the show. I had technical issues. I couldn't make it. And I was going to talk about this setup potentially being interesting last week. Well, 5 days of trading later, and we found the 200-day moving average here on Friday afternoon in the closing session. And that 200-day provided a little bit of a slingshot. Stock had rallied really, really great on Monday, on the news of a preliminary Q4 results for their earnings that are coming in late February. And so the market really liked that. And what you're seeing in this last 2-day move is just a continuation of the strong uptrend that's been in place since that mid-October bottom. And so now what bulls want to see is some consolidation because this move has been great. We've seen a pop from 45 to 60. That's not a small feat, obviously, 25%. It's unlikely to continue aggressively in such a move to the upside. So we want to see 2, 3, 4 days of consolidating and holding into this area above, say, maybe 55 and above. If we can do that and consolidate for that period, then you may have an opportunity for traders to join into the trend. But the reason that this one came up originally is because of that break. It is such a significant downtrend, having recaptured the 200-day, broken the downtrend, and we are looking at a chart that has the 50-day moving average crossing the 200-day moving average to the upside, a so-called golden cross technical condition, which many are going to be looking for in the coming couple of segments here. So a little bit more optimism than I often bring in charts, but this one was pretty darn intriguing given the length of that downtrend.
And we would have seen the slingshot ahead of time, and we would have seen the 27% that people have gotten in this market Monday and Tuesday. But you always do a great job bringing us everything. And today, the golden cross as opposed to a death cross. So,
That's
we
right.
thank you for that. Okay, I get it. I get where you're coming from. Yes, understand that. How about Disney? It hasn't been looking good of late. What is it that's jumping out to you in this chart?
Well, I have to call it a bearish chart, unfortunately. Disney had a rally into the summer, right? In the early August, we made that peak in the ballpark of about 125 or so in mid-August, and we've really seen that acting as the beginning of the downtrend line that you can see drawn in here. Where we reside today is at that 50-day moving average on a nice move higher off of the lows we found late December. Now, this is an interesting spot. This is a chart that is much more resembling the ones I traditionally bring you. Try to show us areas where we have a decision coming in the near term. And that's pretty much where we are here. We've had the 50-day moving average in purple acting as resistance as well. So you've got a confluence of the downtrend line and the 50-day moving average coming together for a potential pause from here. We are looking at yesterday's close above the 50, today above the 50. I think it's fair to suggest we're just as broad market as well, kind of in a holding pattern, waiting to hear how that CPI number comes out Thursday. But ultimately, this is one of those areas where we could see a continuation that might be just a stair step up. You might have another ledge at about 100 for resistance, and thereafter at around 105. Coincident with that 200-day moving average. And, you know, Nicole, even in these instances where we have these really strong downtrends like Disney, unfortunately, those short-term periods can result in big swings, and you can get a move very quickly up to that 200-day moving average and still not correct anything on the longer chart. So it can be opportunistic. The one thing that stands out for the bulls in this instance is that last low was made with a divergence, a bullish divergence with our RSI, meaning simply we made a new low in price, but we did not make a new low in the RSI to confirm that low in price. So it's, you know, could be said that bulls look at this and say, yeah, we think that the short-term bottom might be in. That can give them more confidence.
Right, right. And, you know, just to get your big picture on what we're seeing in the markets, you know, Mark Newton, who I've known and is a technician, he was looking at certain levels and, in fact, showed some concern. He thought the S&P bounce that we're seeing is going to be running up against resistance, sort of a bear market bounce, and that's likely to break and retest lows in December. He said the key level is near 39.50 to 70 for resistance. Yep. 37.94 to 3800 for support. I'm not asking you to take on his calls, but do you think that's, you know, I'm not asking you to take on his calls, but I mean, that's basically what a lot of the traders are watching.
And the reason, Nicole, is because if you're watching it on a day-to-day basis, the market can be a little bit much, right? We could get way too much information. But if you pay attention to something a little more long run, like a weekly chart, there's a lot of visual reflection that it eliminates a bunch of noise. And the first thing that stands out is we're still looking at lower lows across the board in the SPY. The area where we've got a little discrepancy with that has been in the diamonds. This has been the one that's been leading us. You know, certainly feels like a little bit more a value proposition play in the shorter term. But I agree with that assessment, to be quite honest. I mean, yeah, we've had a good week. We've even had a great start to the year. And ultimately, I know that so-called January effect can have an impact on us. I tend to believe that has an impact on us later in the year. And it doesn't mean that we're necessarily out of the woods. My fear is that you have individuals utilizing some of this positive, this belief or positive bias you've had in the last couple of weeks to really position for the longer period of the year. I would be a little more cautious in the short period of the year, and I want to see the market really give me some ample reasons to be a long-term investor here. And that means taking out that downtrend line. I'm going to feel a lot better over the 40-week moving average on the S&P 500, the 200-day moving average, obviously. Those are levels that I'm watching as a trend trader for sure.
Indeed. Good to see you. Kevin Horner, thank you, of Charles Schwab.
Thanks,
Great
Nicole.
to see you. Thanks, Kevin. Coming up next, to focus on Bed Bath & Beyond, an earnings miss. Bankruptcy concerns have been mounting. Now, the stock is jumping, as the company says. It is now considering all strategic alternatives. And in fact, just this week alone, it's up 47%. It's only Tuesday, right? So Monday and Tuesday, it's up 47%. Much more coming up.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you an active trader? Our active trading webcast series is designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
I'm Nicole Petalides coming to you live from the New York Stock Exchange every single market day from the opening to closing bells. Tune in to the TD Ameritrade Network.
When traders tell us how to make Thinkorswim even better, we listen. Like Jack. He wanted a streamlined version he could access anywhere, no download necessary. And Kim. She wanted to execute a preset trade strategy in seconds. So we gave him Thinkorswim Web. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim by TD Ameritrade.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network. Welcome back to the watch list. I'm Nicole Petalides. A focus here on Bed Bath & Beyond. The company reported earnings. Bankruptcy worries continue. The story is a tough one for Bed Bath & Beyond. And don't be fooled by a big move this week where it's up almost 50% in 2 days. Seth Basham's with us, Managing Director, Equity Research at Wedbush Securities, where in the last note you had an underperform, you had a $5 target, there was a lot of concern. And now we're hearing strategic alternatives seem to be the way to go here. Where do you stand now?
Yeah, sure. We still have an underperform rating, and our estimates are under review as is our target price. But this is a company fighting an uphill battle right now. They've lost a ton of customers. Their sales are reeling. They're down by a third in the fiscal third quarter, and they're losing a lot of vendor support too. Without vendor support and the inventory to sell, they're not going to be able to make it across the finish line.
When I see bankruptcy, you always think, oh, bankruptcy. But in this case, as I was reading through your note, you said bankruptcy could be a good way for them to restructure their debt, provide some liquidity, and could it save them?
I mean, ultimately, could it save the brand? The answer is yes. In a bankruptcy scenario under Chapter 11, the company will be able to terminate leases of its stores that it does not want to operate anymore, where they're unprofitable. You can't do that without huge costs outside of bankruptcy. So that's one thing. And then secondly, restructuring their debt would be easier in a bankruptcy scenario as well. So to get this company on firmer footing, get vendor support, I think bankruptcy protection would be the best case scenario for the company's long-term survival. Of course, that's not a good scenario for the equity.
Is it worth it to preserve the brand? Because maybe, you tell me, they have a credibility issue in that their vendors don't really want to work with them at this point now, right? Because they're worried about, whether they'll get paid. And consumer re-engagement may be tough too. Consumers have gone in there and seen nothing on the shelves or tons of discounted stuff they don't want.
Yeah, there's still a lot of brand equity in the name Bed Bath & Beyond with consumers. So I think that there is good rationale to preserve the brand. The company's made a lot of operational missteps and some strategic missteps over the last couple of years too. So it's not to say that it can't be saved. So I think that the company will likely restructure. They'll probably become smaller, but there are a core set of customers that still enjoy shopping there. The vendors, getting their support again is critical. And that support comes more from the perspective of having the confidence that they'll get paid by the company. So if there's more liquidity behind the company, the vendors will be more likely to ship to them.
Yeah, and at this point now, when we think about the brand itself and we think about what the other companies are doing, I mean, where were the missteps in the first place? Why is it that Abercrombie and Fitch can come out and say, hey, we've seen demand and things are looking good and we're raising our outlook, and Bed Bath & Beyond has just been one bad quarter after another?
Yeah, well, the home furnishings industry overall is in the doldrums right now. So that doesn't help the backdrop. But from a misstep standpoint, some of the biggest ones are around merchandising. Under the former CEO, they tried to put through a lot of private label merchandise that didn't really strike a chord with their customers and sent them out the door rather than in the door. And the current management team is trying to reverse that. So that's the biggest thing. Secondarily, this happened all at the same time of the global supply chain crisis, which made it even that much more challenging to get product on the shelves. And then last, during this time period, that management team misread the situation with demand, thinking that it could persist strongly for the industry for years to come, and bought back a lot of stock, which weakened the company's balance sheet tremendously.
When we talk about strategic alternatives, and they're considering all of them at this point, we did talk some about bankruptcy. What else is there? I mean, there could be an acquisition of some sort. Maybe a bigger company takes it over. Is that in the cards? What do you think are some of the most likely moves that the company may make at this point this year?
Yeah, that's not out of the question, and that might be one reason the stock is rallying today. Secondly, I think from a near-term perspective, cash flow is likely to improve in the fourth quarter, but it's more of a seasonal improvement than an underlying improvement in our view. So I think other opportunities for the company are pursuing what they're doing right now, which is cutting more costs, trying to get more inventory on the shelves, and telling consumers that they're open for business. So those are the tactics that they're using right now. It's very questionable whether it'll be enough to save this company and its equity right now.
And I know, yeah, the equity is the key part, right? Because we always said the bondholders, the preferred shareholders get paid out way before the equity, just common stock. So at this point now, you would consider it a risk to get in there and buy. It's under $2 at this point. But if there were to be a takeover, what would it be worth? And is it worth somebody who wants to play a high risk game and say, hey, you know what? I think they might be taken over. I'd like to buy some of this around $2 because I think if they get taken over, it's worth whatever, $5. What's it worth?
Right. Yeah, I think it's highly unlikely that there'd be a financial buyer for Bed Bath & Beyond right now, meaning private equity. A strategic buyer, another retailer, that's a possibility if they find a use for Bed Bath stores. There had been chatter about that in the past, but in this retail environment, it's really unlikely that will be the case. So I see that white knight scenario being pretty unlikely at this point in time.
I mean, they could become Amazon warehouses. Seth, I'm glad we got to speak about this. I look forward to hearing what we have to discuss next time about Bed Bath & Beyond, because, you know, everybody loves the store, but it certainly has been struggling. Seth Basham, thank you at Wedbush. Appreciate it. Up next, we'll talk all about energy. Consumers have been paying a lot, more than they did the prior year. And what's the impact on the overall economy? What can be done to actually lower those costs? Much more ahead. And here's a look at winners and losers in the S&P 500.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Thinkorswim by TD Ameritrade is more than a trading platform. It's an entire trading experience. With innovation that lets you customize interfaces, charts, and orders to your style of trading. Personalized education to expand your perspective, and a dedicated trade desk of expert-level support that will push you to be even better and just might change how you trade forever. Because once you experience Thinkorswim by TD Ameritrade, there's no going back.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy. Tune in 24 hours a day, 7 days a week on tdameritradenetwork.com and all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device. Welcome back to the Watch List. I'm Nicole Petalides, coming to you live from the New York Stock Exchange in New York City. Thanks for being with us. We have all up arrows across the board today. We heard from Jay Powell, our Fed head. He continues to move forward and focusing on price stability for our economy. And we will wait on that CPI inflation print later in the week and some earnings as well. The Dow is up 134 points, continuing that rally that started on Friday, 33,653. The S&P is at 3913. That's up 21 points. The NASDAQ at 11,187, gaining almost 0.75%. And the Russell is up 1.3%. Ben Lichtenstein is with us for a market update, senior futures contributor. So where do we stand? I was just talking about some crucial levels that we were watching closely. What are you watching, Ben?
Well, really just the green arrows across the board in all four of the major indices. You just pointed out the bid activity we're seeing into the late day trade in coal, led by the small caps. The Russell enjoying a gain up over 1.5%. Now, this comes after we actually saw some selling this morning. We saw the S&Ps, the SPX down to 38.77. I was looking at the Russell, which was briefly down below 1,800, down to 1,793, and the NASDAQ's hanging out above 11K, but it traded down to 11,050. The Dow's low is 33,421. You mentioned Fed Chair Jerome Powell. We heard him talk a little bit about how inflation is ultimately high, and well, how raising short-term interest rates to slow the economy is not what he called, well, politically popular. He said the absence of direct political control over the decisions, those allows the Fed to take the necessary measures without considering short-term political factors. So basically, he was kind of explaining that we're going to see higher rates to come. And again, he was sort of declaring the Fed's independence. Now, we also heard from Federal Reserve Governor Michelle Bowman today. She said that she expects that once we achieve a sufficiently restrictive Fed funds rate, that we're going to need to remain at that level for some time. So kind of continuing that mantra, that drumbeat of higher for longer. I mentioned the lows that we saw, but again, the indices well off those lows as investors really come to grips with everything the Fed said and in anticipation of some of the data due out later this week. What I also noticed here quickly, Nicole, is interestingly enough, today the indices are higher, yet rates are higher, and so is the dollar. So not the normal dynamic that you'd expect to see, but I think it's a reflection of how investors are kind of looking for a little bit more information. We've talked about the wider range that we're hanging out in and how the S&Ps have been comfortable around this 39 handle.
Yeah, you know what? I'm not going to buy it. You're right. You can't have the markets, the dollar, and rates all higher on the, you know what? You're absolutely right. That's a good thing to point out. Because you don't often have that. Something's got to give. How about the story of crude? I mean, we're going to be talking about energy more later in the show, but what are you watching?
Well, a bit of a rally recently off the December lows. It's kind of topping out right now around 75, 76. It's coming off a little bit after reaching that level earlier today. But you can see we're hanging out near the lower extreme of the range that we've established. Well, last year up around that 130, 120 level, down to the lows that we saw in December around 70. Now, really got my eye on that December range, though. We're talking 81 to the upper extreme, 70 to the downside, and crude for the most part hanging out in the middle of that range. range. Keeping an eye on, again, the inventories later today. We'll hear from the API, we'll hear from the EIA tomorrow, but there's some uncertainty in terms of demand. China, you're talking about, the Fed and this initiative. I just mentioned some of the Fed comments earlier and higher rates for longer, and the impact that's going to have on the U.S. economy, the likelihood of a recession or lack thereof, or even just a slowdown in terms of the global narrative. So keeping a close eye on that, but also watching this China reopening trade, as I mentioned. And then I also just wanted to point out here, we were talking about the dollar a minute ago, and I noticed a couple things. The dollar's in the middle of the range that we established last year, 94 up to 114. We're hanging out just below 104. But crude, I think, an interesting story. You normally expect to see kind of that inverse correlation to the dollar, but I think in this instance, you've got the demand narrative, which really weighed on crude in the end of the year. And you've got a range last year. We're talking up around 130 down to, again, that $70 low that I mentioned. So in the middle of that range, crude be at 100. So again, hanging out around 75 really speaks to the demand concerns that we've seen and the recession uncertainties that are weighing on price.
All right. Thank you for all of that and a good setup for our next segment. Ben Lichtenstein, thank you. Let's continue our focus on energy. Joining me right now, David Holt, President, Consumer Energy Alliance. Thanks for being here. So we've obviously come well off those highs. Where do we stand? What does it mean when we're at $75? What does it mean for consumers in the global picture?
Well, I think there is a lot of uncertainty. It's going to be a demand scenario and an inflation scenario. We're looking at maybe China coming back online a little bit from a demand perspective. We have ongoing uncertainty in Europe. We have ongoing regulatory uncertainty here in the United States. So there's a lot of market pressures for kind of that upward movement in the price of oil and therefore the price of gasoline and diesel as well.
Mm-hmm. Are we more likely to move higher or lower going forward? I mean, I hear what you're saying. You're talking about the demand in China reopening. I mean, so it sounds like higher, but I'm going to ask the question, where's the path of least resistance?
I think we're looking at more likely higher than lower. I think that the demand curves look like it's going to be a little bit higher. You're also seeing a lot of restriction in the U.S. market around oil and natural gas, which continues to put kind of pressure on the overall system. You know, the United States and China are number 1 and number 2 in oil demand in the world. So as those countries move, so goes the price of oil, if you will. So we're looking at more demand growth in China, especially, that puts upward pressure on the price of oil and puts upward pressure on the price of energy across the board.
Yeah, I just saw a headline going by about Janet Yellen talking about the caps on Russian oil, and seems to be working basically. I mean, we started to get concerned that there may be more threats from Russia and that they might just turn it off altogether, or they wouldn't tolerate the sanctions that are being put against them. And somehow it all seems to be flowing, no pun intended. That's a real wild card, isn't it?
It is, and it has been for a while. You know, I think when you look at what Vladimir Putin was trying to do in the Ukraine, it was all contingent on his control of European energy, both natural gas, largely natural gas. So I think he was expecting the West to blink a little more than the West has to this point. And he's still relying on a few more months, maybe, of a cold winter in Europe to continue to put pressure on the overall system. So that is an absolute wild card. What could or could not occur in the Middle East, another absolute wild card. And then demand is kind of unknown, coupled with inflation, which is a little bit, or recession, sorry, which is a little bit of an unknown. So we've got to kind of take all these things into the mix, but based on inventories, based on demand growth, based on uncertainty in Europe, again, all these things kind of indicate to us that we're going to see higher oil prices, not lower.
Yeah, care to make any guesses? I mean, not predictions, but guesses where oil could be heading? I mean, are we talking $100 a barrel? We saw diesel higher than regular gasoline. We've seen nat gas coming down right now. There's been a lot of things that have been happening, and we still have a relatively strong dollar at 103. Care to make any guesses or predictions for 2023? Either
hard to pin down because you have these competing issues of a recession and demand growth. So a recession means you're going to have demand destruction. Economy's coming back, which puts demand growth on the upward swing, which would be great, but that's going to put pressure on inventories and the price of global oil. So certainly I think it's going to go higher than we're seeing it today. hard to predict if it gets to 100. And there's a lot of global uncertainties, geopolitical uncertainties that could impact the price of oil and put it on a pretty significant upward trajectory. So hard to pin me down right now, but I do think above 80, above 85 is not outside of the question.
Okay, and so that's $10 from where we are now. We've had our fourth up session in a row on our close today. I just saw that. The other thing I was thinking about is, going green. And that was such a big theme that we were talking about here on Wall Street. Everything, was going green, and then COVID hit, and then, our economy sort of was sent reeling. And now there's been more criticism about how going green is more expensive. Where do we stand on the green? The big picture? I know the administration's been focused on it. We had Powell today saying, listen, I'm not interested in climate change. I'm focusing on the economy.
I think the whole notion of going green is a reality. I think the market has spoken, consumers have spoken, and the government, certainly this administration, is pushing it as fast and as hard as they can. So energy diversity is not necessarily a bad thing. Adding more solar and more wind to our electricity and power mix is not a bad thing. We have to have a more realistic conversation about nuclear as part of that overall mix. But going green cannot and should not mean we are going away from oil and natural gas. Oil and natural gas are the lifeblood of this economy, the global economy. They are affordable, they are reliable, and they are the energy resources that we're going to need to drive our economy and the global economy for decades upon decades. So as we add more wind and solar, we have to keep our eye on the ball and provide more oil and natural gas, continue to develop oil and natural gas, do it in a cleaner, greener, more environmentally sustainable way, which the U.S. Oil and gas industry is already showing that they can do that. So I think that's got to be the conversation. These groups that are out there saying the only way to meet our environmental standards would be to ban oil and natural gas, they're just absolutely wrong. And there's no reality in which that could ever occur. So those conversations need to just end. And those folks need to be kind of pushed aside. We can diversify our energy portfolio. We can add more green energy, but we need to make sure that oil and gas become continue to be a dominant part of our energy mix. And we also have to recognize that electric vehicles and wind and solar rely on precious metals, critical minerals, which involve more mining. And when you have cobalt in the Congo, which is produced by child labor, and you have other things, even some of these so-called greener technologies aren't necessarily environmentally friendly either.
Yeah, understood. So it's got to be done all together, not one or the other, and not so hastily and all that. Got it. It's nice to see you, David Holt. Thank you. Consumer Energy Alliance. Thank you, David. Still ahead, our focus on consumer staples. They outperformed the overall market last year. Now what for 2023? Can that continue? Our panel is ready to weigh in.
Many traders may be willing to take on additional risk in pursuit of aggressive growth in their portfolio. More power to them. But if you're looking for a less risky alternative, you might want to consider checking out our income investing course. In the income investing course, you'll explore investing strategies designed to generate regular income and preserve capital. First, we'll delve into risk and return preferences. You will learn about the different ways to allocate a portfolio and create a payment schedule. Then we'll take a deep dive into the assets commonly held in income portfolios: dividend stocks, bonds, equity REITs, and cash. You'll also learn about routines for managing a portfolio over time. Along the way, you'll watch videos, take quizzes, and perform paper trades to practice your new skills. So if you're looking for an edge, consider your education. Head to the Education tab on Thinkorswim for the Income Investing course and a whole lot more.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy. Tune in 24 hours a day, 7 days a week on TDAmeritradeNetwork.com to all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
We empower those who act. Those who see the correlation between things above and things below the surface. Those who navigate risk by meeting every turn with a heightened awareness of what's possible. Constant assessment. Determine the best position. Catch the perfect wave. CME Group, where risk meets opportunity.
Welcome back to the Watch List. Time to discuss the outlook for consumer staples with our panel. Joining me right now, Alexis Brown, COO, Portfolio Manager, Alexis Investment Partners, and Max Wasserman, Founder, Senior Portfolio Manager at Miramar Capital. Thank you both for being here. So we know that this group did incredibly well. They were, as a group, was very resilient during COVID and fluctuations that we saw. Alexis, what do you focus on when it comes to consumer staples? And do you think there are parts, at least, that could outperform in 2023?
Well, Happy New Year, Nicole. As you said, consumer staples held up pretty well in 2022, and 2022 was a rough year. In fact, one of the worst in the past 100 years. But consumer staples tend to do well in those more difficult markets. But going ahead from here, we're actually looking to be more broadly diversified and seeing places that may come out a lot stronger than consumer staples. If you're asking me to pick a couple names in consumer staples, Pepsi and Walmart, just like everyone else, but they've honestly gotten pretty rich from here, and going forward, you may find them lagging in an eventual recovery.
Right, understood. Max, tell me, I know you liked Pepsi, Coca-Cola. I mean, for example, when we were talking about Pepsi and I saw their numbers and how well they did in snacks, and people just, the demand was there, and these companies in many cases were able to raise prices as well. But you think that these stocks are at this point fairly valued? Are they becoming frothy?
That's good to see you again. Yeah, they're trading roughly around 23 to 24 times earnings, which is about a 10% premium to their 5-year historical average. So we still like the companies, but I think the valuations are near fair value toward the end, the high end of it. They'll benefit from a declining oil prices. They'll benefit from declining commodity costs. Pepsi has the Frito-Lay division, which allows them to raise prices and to capture it. So we like them. We just don't think they're going to have the stellar year they had last year. But in times of a slowing economy, people like the consistency in earnings. They like to know dependability. And that's why they're valued as they are. I mean, they've been an incredible investment for the past year and a half. We just don't think they're going to lead to the same extent that they did the last 12 to 18 months.
Right. And, I think that the fact that they have run up, as you noted, moving up as far as valuation is concerned, but they did have pricing power, did continue to see demand, and not really luxury items. They were more things people needed. You were talking, Alexis, you said the last time you were on, you were favoring consumer cyclicals over staples. Where do you stand now? And could you give us some examples?
I think everything you both have said is completely spot on there. Actually, since the last time we came on, the discretionary on an equal weighted basis has outperformed the consumer staples, although consumer staples have done better than the broader market. I continue to believe, though, that going forward from here, you're going to want to be more, if you're going to be in consumers, be more on the discretionary side than the staples side. Overall, we're just seeing that being more broadly diversified and giving yourself that flexibility so that as we come out of the year that 2022 was and look ahead and get some of these questions answered and start to see the market broadly improve, being less defensive is really going to be better when you're looking to participate in this up move after just having this down. And so we're actually even looking at some other opportunities such as diversifying into foreign as well.
Yeah, and when we think about this group, I mean, we think about it basically as a defensive group for the most part, Max. You know, a lot of the cereal companies, beverages, right, sodas and things. Tell me about some of the names that you like to keep an eye on that you might buy into at some point.
Well, I think the areas, you know, when you look at this part of the market, you can also throw in McDonald's, you can also throw in the Starbucks. They tend to be more of a consumer discretionary staple type. They're a household name. People buy them regardless of what the economy is doing. So we still like those, but again, they're not cheap. If you're looking for areas in the market for upside, I think you got to look for areas that got hit last year. As dividend investors, we like companies that are paying us 3 to 4% dividend yield that have been hit. So we think we might get a little more outperformance going into the new year with those because they've been hit so hard. So I think if we're looking for real value, we should be looking for companies that have strong dividends and have been washed out a little bit. To throw a couple of names at you, we like Walgreens, roughly right now 10 times earnings, giving you 4%. It's a turnaround story, and it's a quasi-staple turnaround discretionary, but we really like what they could do in the market. If you also look at another one, if you look at auto parts, we like an AAP, Advanced Auto Parts. They've been hit, trading roughly 12, 13 times earnings, paying you 4%. That's where we're looking for the outperformance going to take place, is in those type of names that haven't had the upside potential they did last year, but this year they stand in line to really outperform, we think.
Yeah, because we normally think of the group like cereal, soda, maybe even beer. But taking it out a little wider, names like McDonald's, like, some fast food or casual dining and auto parts. And these are some of the things that you need. Alexis, do you think there's some potential in some of these other things? You even mentioned maybe going abroad with your money and putting it to work there. Where's the potential and opportunity for 2023, Alexis?
I think there's honestly a lot of opportunity. There's going to be a lot of volatility. But if you look at being diversified, you mentioned foreign, which I did mention. We are starting to look there. We're not betting against U.S. markets by any means, but traditionally, every 3 to 5 years, you start to see foreign do well, and we haven't seen that for over a decade now. So it is overdue, and we're starting to finally see things look promising in that area. We're doing that pretty broadly with EPA, and then maybe looking into Europe. And again, just taking that more broadly diversified approach, taking that step back, letting you not be scared onto the sidelines, and also letting you kind of adapt to market changes as you're seeing leadership change while the year progresses.
Yeah. And just quickly, Max, you talked about having sizable investments in names like Coke and Pepsi and that being fairly valued at this point. And kudos to you. You were in the right place and you sort of held up in a really tough market. Where do you see having sizable investments going forward?
I mean, I think the ones I've mentioned, Advanced Auto Parts is one. We still like UPS, for example, giving you over 3%, 3.3% dividend yield. We think that has there. Walgreens, we like it. We still like AbbVie. We think that's going to have another tremendous year towards the second half. We like them. If you look at the industrial side, we like there's potential there. We also like technology in the second half. Right now, we still like Broadcom, even though it's down today. So there's areas in the market that we like, that we have sizable investments in.
Max Wasserman, Miramar Capital, Alexis Brown, Alexis Investment Partners. Thank you both very much. Good to see you both. Thanks. That's going to do it for us here on the watch list. Thanks for being with me every single weekday, 11 a.m. and 2 p.m. Eastern time here on the TD Ameritrade Network. I'm Nicole Petalides. Keep it right here. Market on Close is next.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. The platform demo webcast series is designed to help you broaden your knowledge of tools and resources available from TD Ameritrade. You'll learn tips and tricks to help navigate TDAmeritrade.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to TDAmeritrade.com/webcasts and start learning today.
Thinkorswim by TD Ameritrade is more than a trading platform. It's an entire trading experience. with innovation that lets you customize interfaces, charts, and orders to your style of trading. Personalized education to expand your perspective, and a dedicated trade desk of expert-level support that will push you to be even better and just might change how you trade forever. Because once you experience Thinkorswim by TD Ameritrade, there.
TD Ameritrade Network has arrived on the floor of the New York Stock Exchange new location with access to the biggest newsmakers in Wall Street, bringing you in-depth market coverage and real-time trade ideas. Do not miss our exclusive interviews with CEOs, bell ringers, traders, and stock pickers, keeping you informed as you navigate your investments. Don't miss Trading 360 at 11 a.m. Eastern and the watch list at 2 p.m. Eastern, live from the New York Stock Exchange, only on the TD Ameritrade Network.
Watchlist can help you keep track of securities you're interested in. To add a watchlist to the left sidebar, select the plus sign, then watchlist. When the default list appears, select the name box, then create watchlist. Enter a watchlist name. To begin adding securities, enter a ticker symbol in the symbol box, then select enter. Continue adding all the symbols you want in your watch list, then select save. The existing list is replaced by the new one. You can also create watch lists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then add to watch list. From the Scan tab, right-click a security and then add to watch list. And that's how you make a watch list. For more demos on how to Thinkorswim, head to the Education Center on tdameritrade.com.
Good afternoon. I'm Oliver Rennick. Welcome to Market on Close. Stocks have been chopping back and forth all day, but seemingly a couple hours ago, maybe picked a direction. We got an hour left, so let's see if bulls can close it out and avoid the fade that was a pretty tough landing yesterday. It's green across the board right now. The Russell looks like it's moving with some conviction. This is happening even as the dollar is higher and interest rates are higher as well, as bonds are selling off with the 10-year Treasury future down 60 bips. Yet another example of how some of the assumed and very reliable correlations of 2022 have been fraying lately and getting a bit messier. If the dollar was higher while interest rates were higher, generally that would mean stocks were lower by the standards in the regime of trading last year. But as concern about the underlying economy has perhaps surmounted concern about inflation, we're getting a little bit more of a mixed bag of relationships in this market. It's making it harder to decipher, but generally the trend of the dollar downward over the last couple months is still very important. And we are overall seeing a high beta growth style bid into the stock market, basically since data last Friday showed kind of a Goldilocks to somewhat negative outlook for the short term. Now, I've been arguing that the rally here started after the core ISM services figure. I do think that lines up on the charts. I think it's easier to argue if you look at the intraday move the last few days that we're trying to do this bad data is good for the stock market style rally. Because employment, while it was nicely threading that needle of strength in the labor market without runaway wage inflation, I don't think it's obviously the move here because the yield curve is taking a beating in a very big way. We're looking at new lows in the yield curve that has been leading stocks downward over the past year. So it's just a very tricky game to play to try and bet that this bad data is going to be good. So with that said, let's walk through some of the moves here. Bitcoin's up 1.5%. The chart for BTC, I think, is kind of interesting here. 18.5 has pretty much been a hard line in the sand for the better part of the last 9 months. So now that you've got Bitcoin pushing for weeks to try and get out from the FTX malaise, that's the big red candle breakdown in the middle of the chart, you potentially have some strength in the crypto market. Also, as we've seen the story about Coinbase layoffs leading to a rally there, you've once again got a situation where the market's trying to look past bad news for companies. And I think that is somewhat telling about perhaps some of the worst getting priced in. We'll see. We'll see how that goes, if that is really sustainable. Again, looking at ARK higher too, high beta type trades, ARK up 1.8% today. A bit of a different technical look there, where if you look at the chart, I think 35 is the appropriate level. And right now we're on that, we're coming to that from the downside. So it's a very different approach, but similar in some ways, really. In fact, it's probably more similar. Given that ARK made new lows in the past 2 weeks, it's definitely weaker than the Bitcoin chart, but both of them now coming up to what had previously been lines of support that broke. You might have a way to kind of gauge the extent to some of this high beta rally. If ARK trades back above 35 and Bitcoin trades above 18.5, maybe you've got some momentum building here for a more sustained bear market type rally. This is happening as bonds are selling off. TLT is down almost 2% today. Long-term bonds are getting hit. And also Apple is just still stuck. Apple chart doesn't look great after it made lows. It's not really catching the bid that the rest of the market is. It's not even close to the leader that it was when we had the rally back during the summer, late spring and summer for Apple. So at this point, Apple's looking a little bit more unreliable. And that, of course, is disconcerting, I would say, for bulls. You've got a bid into Amazon, Meta, and Netflix today, but you're missing Tesla, and you're kind of missing Apple and Alphabet, which are a little changed on the session. So it's hard to get that full-throated, big thrust higher without those companies partaking. All right, let's bring Renita on, Kevin Hanks. Let's talk about what's working and what's not. We got a little batch of up movers and down movers today. But let's go back to the morning. Get us started, Kevin, thinking about what Powell said, or maybe what he didn't say in Sweden. Kind of seemed like we got some worries out of the system when he didn't surprise us with anything negative.
Well, I think to start the day, I think the markets were jittery, frankly, about Jerome Powell talking. They were worried about Jackson Hole and the potential that he could do there, but he calm fears. He stayed on topic, right? He talked about central banks and their independence. That was kind of the topic of that symposium, and he stayed right there. He didn't move over into the U.S. economy very much at all. And so I thought the markets, right when he started talking, 8 o'clock, you and I were on the air together when that happened, the markets drifted from down 0.5% to unchanged. And it wasn't soon after that, Oliver, when stocks opened 9:30 Eastern time, that they went green pretty quickly. Now, there was a little back and forth, but I think what Jerome Powell did there was stayed on topic, didn't really address the U.S. economy, and now that moves the discussion to Thursday's CPI number. So even though, Oliver, you're looking at $1 higher, yields higher, crude oil higher, indices higher, one part of that doesn't usually match up, but here we are, Oliver. Yep. We've got now, let's see, 8 of the 11 S&P sectors higher, none of them higher than 1%, but only I've got consumer staples, I've got utilities and real estate all higher just or lower just slightly. The other 8 sectors are all higher, Oliver. So this is a day that turned out to be pretty resilient when Jerome Powell, like I said on Fast Market today, he didn't do anything to scare the children, Oliver.
Yeah, nothing really at all. And in fact, just very little commentary on the macro side. So to your point, observing the same thing that I am, where we're getting more these days where stocks and bonds aren't lining up the way they did last year. Interest rates higher today, stocks higher anyway. And then yesterday, as we faded into the end of the day, bonds were still very well bid, and the yield was down. So we couldn't blame yesterday's fade on bonds. So we'll see what happens here today. We still got some time left. Let's talk some stocks, Renita. What's leading here today? Healthcare companies, Danaher, and the group that's been very good over the past year. I think a lot of people are wondering if that's going to happen again this year. Because if we get a repeat of 2022, then stocks like Danaher could be doing very well.
Well, these may be indications that possibly that might happen. But we got to close out 2022 first. And Danaher gave an update of what that fourth quarter might look like. And it's great. It says that it's expecting fourth quarter sales to rise in the low to single digit % range. And this is a welcome thing for Danaher, obviously for the industry as well. This company, by the way, it designs, manufactures, markets professional medical, industrial, and commercial products and services. And so the company is also saying that its molecular diagnostic business performed ahead of views after securing that more than $1 billion in respiratory testing revenue in the fourth quarter. Now, Danaher is projecting a non-GAAP core revenue growth in the high single-digit % range, and that would be above the previous guidance of a flat to low single-digit drop. So at least closing out 2022, we're looking to see a pretty good number. But it'll be interesting to find out if this company wants to take its projections into the first quarter of 2023.
It didn't quite have the blockbuster year that a lot of other healthcare companies did, but it still held its own and still is well elevated from its pre-COVID highs. The stocks that are able to keep their COVID rally are getting a lot of appreciation in the market right now. 4.5%. Diagnostics biz, as you mentioned, respiratory testing doing well, and then just kind of generally being right place at the right time as people are going back to hospitals, getting regular treatments. And I think there's a good secular theme and trend there that is very uniquely post-COVID. So to put kind of the book on last year and then talk about going forward, pretty encouraging as we're trying to find things that maybe are a reopening trade, but like don't depend on travel, consumer stuff, because everybody's saying we might have blown our money already in the holiday season.
Maybe so. That's a thing.
Yeah. All right, Kev, what do you think here? Is the healthcare trade the true reopened trade?
Well, healthcare is certainly something that would potentially do better in a sluggish economy, Oliver. So a lot of times when investors don't have anywhere to go and things are getting a little shaky, they go towards healthcare. So remember, Danaher's report was things aren't as bad as we originally thought, right? That's why the stock's rallying. But healthcare is certainly an interesting place. Remember, Friday we get United Healthcare's earnings. Yeah, healthcare is always an interesting. I've never traded a lot of healthcare in my life, although I was the specialist in Humana. But healthcare is a tricky sector to trade, that's for sure, Oliver.
Okay, maybe this year we'll bring you along for the ride, Kev, because that was working last year. Let's flip to the other side. There is some stuff dragging today. Some of the chip makers are pulling a little bit lower on the NASDAQ. On semi, we talked about it a little bit this morning when we were looking at the chart for it. Had been a really good chip maker relative to its peers, but a pretty important downgrade, I think, here today. We need to run us through it again.
Yeah, On is off today.
Nice. Had to do it.
Had to do it.
Low-hanging fruit.
Those shares are lower today, and it's all from this downgrade at William Blair, taking the stock from outperform to market perform. And that's, by the way, the average rating among analysts that are polled by Capital IQ. Now, one of On's detriments, some analysts may say, is that it provides chips for an industry that's still expanding, and that this advancement of this particular industry, the advancement of technology, plays a huge role in this industry's ability to be able to replace equipment, which it may need to do as technology advances, obviously, right? But meanwhile, On Semi recently landed two big deals. One of them was with Kia, and the other was with Amped. The Kia deal, it allows On to supply traction inverters for Kia's electric vehicle. And then the deal with Amped, On Semi is going to supply a component that AMP uses in its string DC optimizers. So maybe some hope is still in those new products and those new contracts that On has, which is why this company is still at an outperform or still at a market perform rather than being lower than that even.
Yeah, hard to get bearish on one of the few companies in the sector that actually has done pretty well. A lot else in chips near the lows. On still hanging out in the midpoint of last year. But let's see how it develops, because when you start losing some of the bulls, then we'll see if the rest of the market follows. Thanks, Renita. Thanks, Kevin Hanks. Appreciate it, guys. Let's talk with Ryan Payne, joining us from Payne Capital Management, about what to expect this year. Happy New Year, Ryan. Is anything different in 2023 so far compared to the regime that was so painful last year?
Yeah, I said last year, I agree with you, it was torturous to be an equity investor. You had volatility that harkens back to 2008, which I still have scars on my back from 2008, Oliver. But yeah, I think, we've had a good omen this year with very strong start to the year. Obviously, that jobs report on Friday was like the Goldilocks jobs report, right? Because jobs are still strong, but wages are going up slower, which is kind of disinflationary. It means inflation is maybe slowing down a little bit. You mentioned that ISM number on Friday. That's when the markets really took off, which suggests that the economy is slowing down a little bit. And that's kind of like the perfect scenario, right? I mean, the Fed slows the economy down, but we don't fall off a cliff. We don't go into recession. And I think the economic data is starting to speak to, we might actually get that soft landing that every economist told us we weren't going to get.
Okay, so that, what do you see as the evidence here? What's going to be the tiebreaker if there is a debate raging about soft versus hard landing? Which data is pointing the skew towards soft?
Well, I think there's three big data points. Number one, continually having a strong job market. And no matter what those economists and strategists tell you, we have a labor shortage in this country that the Fed can't fix. So if you have baby boomers just leaving the workforce in droves, and we know we have job openings that are like historical highs, right? You know the stat for every 1.7 jobs, there's only one person looking. So you continue to have a strong job market. But in the meantime, inflation in real time is coming down a lot, right? Oil prices are down, commodity prices are down, money supply went negative. So, we should see the CPI number on Thursday should come in very good or lower. If that keeps coming down, I'd say like exponentially this year, which it probably will, because housing is the lag. And we know housing's fallen off a cliff, given the fact that mortgage rates have gone up so much. The Fed probably has to dial back their interest rate policy to less than 75 basis points that are being priced into the market this year. And then thirdly, which I think is just like the biggest winner, you can't ignore it, is the great reopening of China, right? I mean, you look at, they're cashed up, they've got stimulus like we had here in 2000. Interest rates are extremely low there on a historical basis. Everyone around the world benefits from that, whether you're in Europe, the US. So for all those reasons, I'm hard pressed to think this isn't going to be a very, very good year. And the markets and even the global economy, Goldman even said Europe might not even go into recession now.
The in China reopening story, Ryan, is there a string attached with inflationary forces? We're seeing copper break out for the first time in months. So crude oil is still pretty down in the dumps, but stands to reason it might follow if there's a big wealth of demand coming from second biggest economy. How does that factor in to that being a positive for everyone?
Yeah, that's a fair point, right? That should add some inflationary pressure, but on the flip side, on the supply chain side, it probably should ease some pressure. So I think overall it's a net win, but also it speaks to when you're building your portfolio this year, commodities probably still aren't a bad place to be. Last year, that was the biggest winner in our portfolios. It was a great diversifier. So I think, when you're starting to look at some of the more beat down commodities, like to your point, copper is taking a hit here. Probably not a bad place to have in your, position to have in your portfolio. But I also think with supply chains getting fixed overall, we'll have more moderating inflation, great global demand thanks to China reopening. And if you take technology out of the equation, Oliver, valuations are really, really attractive. In fact, they're at a 20-year low when you start looking at Europe and the emerging markets.
So the non-U.S. case, is that a stronger bull case here, you think, for 2023? It seems like a lot of stuff is pointing out outside of home.
Oh, 100%, right? We're already off to the races. China's up 10% this year. Developed markets are up close to 4%. And again, just mentioning the valuations, they are so beaten up because we already know they have an energy crisis. We know that they have the potential for a recession. But again, They have the same benefits we do. They get to sell to China. If we don't see an energy crisis there that's like exacerbated here, which we're already having a mild winter in Europe, which that also really, really helps. I think these are all good things, and I would absolutely make sure that you allocate to Europe. Probably a better opportunity there, and the emerging markets, which earnings growth has been better there for years. Those prices just need to catch up. So it's a good time to diversify outside the U.S., 100%.
Hey, Ryan, the last point here is, what do you think would tell us if things worsen here domestically? If one believes the yield curve, it tells us it is worsening just this past 5 days. Is there something that you believe more than that would tell us if it's getting rough?
I think actually the fact that yields are going down on the longer end of the curve is really what you want to look at, because that speaks to longer term inflationary pressure. And the bond market, I believe the bond market more than I believe the Fed, Oliver. Can't trust the Fed. They change their opinion a lot. And I think as long as long-term yields stay lower, you're like 3.6% on the 10-year treasury, that speaks to lowering inflation. Now, if you start to see the 10-year spike, you might want to get a little more nervous there. Going to your point, maybe at that point it's because China's reopened, commodity prices are starting to skyrocket again, oil prices start to skyrocket again. That could be problematic. The Fed might have to continue to stay hawkish there. So I would really look at those longer term interest rates. And I talked about this on my podcast, Pain Points of Wealth, one of the fastest growing podcasts in America, is really looking at the yield curve. And what the yield curve is telling you, especially longer term yields, is really critical to what we can expect here, especially when it comes to inflation and that discount rate when you start thinking about buying equities.
Okay, Ryan, thanks. Good framework for us to use this year. Looking forward to keeping in touch.
Thanks, Oliver.
You got it. All right, when we come back, let's talk about investing in private companies. Through a publicly traded stock, Trinity Capital Chairman and CEO joins us. Very interesting business that's been involved in some of the high growth themes, but also those that have crashed pretty hard the past year. I'm looking forward to the conversation about whether or not they see that changing in 2023. Up next.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is, how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads like counters and diagonals are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the education tab on Thinkorswim for the full Options for Volatility course and a whole lot more.
TD Ameritrade Network has arrived on the floor of the New York Stock Exchange new location with access to the biggest newsmakers in Wall Street, bringing you in-depth market coverage and real-time trade ideas. Do not miss our exclusive interviews with CEOs, bell ringers, traders, and stock pickers, keeping you informed as you navigate your investments. Don't miss Trading 360 at 11 a.m. Eastern and the watch list at 2 p.m. Eastern, live from the New York Stock Exchange, only on the TD Ameritrade Network.
Opportunities can be hard to find, like catching lightning in a bottle. In uncertain times, it's tempting to retreat or simply wait and see. At CME Group, we empower those who act. We deliver tools to help manage risk and capture opportunities in every market climate, across every major asset class, to seize each possibility at precisely the right moment. CME Group, opportunity is everywhere.
Welcome back to Market on Close. We've got about half an hour more so, and stocks are holding on to gains right now. Bulls hoping for a better close than yesterday. Growth bulls and those looking for disruptive companies to pave the way for gains this year are hoping for a big reversal from 2022. Last 48 hours maybe giving some hope. Let's talk about what themes and businesses, styles to be in with the chairman and CEO, Steve Brown at Trinity Capital ticker TRIN, joining us from the NASDAQ market site. Steve, welcome to the show. Thanks a lot for being here.
Thanks, Oliver. It's great to be with you today.
Tell us about your business, what you guys do. You're investors, but I also see that you describe yourselves as providing tools for nascent companies and businesses to grow. Walk us through what those tools are.
Yeah, so Trinity Capital provides debt capital to emerging growth companies. Typically, these companies are backed by venture capitalists, maybe private equity, other institutional investors. The capital becomes a non-dilutive set of capital for owners, even for the VC groups. And then we try to provide more than money. We have experts in our house that are technologists, that are operators, that have been in the business for a long time, have effectively been our customers. So that we think we definitely add value beyond just the money as we're providing debt. And it's a little bit of debt with a lot of equity when you're talking about emerging growth companies that have revenue, they're growing their businesses, and we're going to help fund that growth. That's what we do at Trinity.
Are you regulated as a bank? Financial institution, but a bank regulation?
Not a bank, no. We're a BDC, and we fall under the 40 Act of the SEC.
Got it.
But we don't have the bank regulation, which is helpful as we're out there doing business.
I imagine so. So we're, let's see, the past 2 years, there's all these companies that are SPACing, they're doing IPOs. At what point in that process does Trinity want to inject themselves? Where do you have those conversations? Do you want to get into these companies that you like before they go to public markets? Do you buy in if they are public? How does that work last year? And how do you see that maybe changing going forward as things have slowed down in the IPO market?
Yeah, we're definitely pre-public, pre-exit. We're helping companies that are backed by private groups that are building some technology innovation that's going to be disruptive in the marketplace. And we're going to help fuel that growth. And we're going to get a good interest rate. We're going to get fees along the way. It's going to be non-dilutive, so we'll save some dilution. And then we're going to get warrants on most of our deals, which is a little upside. And then that leads to potentially public stock or other, exit value on those warrants. So there's nice upside in our business for those warrants that we get. And we experienced a little bit of that upside this past year. Yeah.
Okay, so with those companies, what's that filtering system like right now? Because anything that promised some disruptive tech, 2020, 2021, they did great. Then this past year, the entire investment world said, hold on, is anybody making money? And basically now has only been buying companies that make money. So those stocks have come down. Trinity, your own stock, has been punished over the past year. So what does that process look? Have you had to change anything?
Yeah, we have not really changed who we are and what we do. We are not, focused on, sort of larger public companies. We're focused on these companies that are backed by VCs and other institutions that typically, even in down markets like we're experiencing right now, they continue to fund the right companies. So our focus is making sure we get in the portfolio the right companies backed by the right VCs and private equity groups that are going to continue to fund even when markets are down. And from that perspective, we're not really tied directly or correlated directly to the broader markets. Obviously, the warrant portfolio and the small amount of equity that we might have is, but the bulk of our portfolio, we make fees and we make interest, and that's the return that we provide to investors. And so we haven't really experienced sort of the downside of what some of, if you will, sort of the tech market, this past year.
It's an important point because while a lot of the generally, if you want to get in on the ground floor, most of your companies are going to be unprofitable. I would imagine that you're investing in. You're pre-IPO. A lot of it, especially last year, these companies IPO don't even have profit. So later stages, they still aren't making money. But your company does. Your earnings beat expectations the last quarter, but the stock still kind of trades like this. So do you think the market is is there an impasse here where investors are linking you too much maybe to the growth aspects?
I think we do get linked in sort of with the tech, and we've gone down as a result of that. And listen, we've been listed now for 2 years, so we're a relatively young public company, but I've been doing this for 20 years, and Trinity's been around for 15, doing it successfully. And we've provided profits to our investors in good markets and bad, and we're continuing to do that. And, since we've gone public, we've increased our earnings, we've increased our revenues, our earnings, and our dividend now for 8 straight quarters. So, we have been able to grow the business. We've been able to provide strong returns to investors. Unfortunately, the stock price today doesn't reflect that. But listen, Oliver, I'm a believer. If we keep doing what we're doing and we do it well and we do it right over a long period of time, the stock price will find its way. It's a great value today for sure.
I'm glad you mentioned the dividends as well, because I saw for the third quarter as well, you added on a supplemental dividend of 15 cents on top of the 60-cent cash dividend that the company has. So that seems like it's a pretty core part of the business. And I imagine that that shareholder-friendly activity, you'd think it would come through and show up at some point. How do you balance those payouts with still deploying capital into investments as they come?
Yeah, so we've delivered growing, dividend yield over the year. I think this past quarter, for the 8th straight quarter, we increased it to a 46-cent core dividend, and then we also paid a 15-cent supplemental for 4 straight quarters. We announced that earlier this quarter for 60 cents of supplemental, and we'll evaluate that going into the new year. But some of that came from a big pop we made on a couple of warrants earlier in the year, which is a part of our market. We had that additional spillover income, we call it in our business, and we wanted to share a little bit of that with investors. Now, it's unfortunate that we haven't seen the stock price, sort of adjust accordingly. But again, if we keep doing what we're doing and we pick the right companies and we have the very low loss rates that we have and we continue to grow our business and our earnings, the stock price will get there.
All right. Great stuff, Steve. Thanks for the explanation and looking forward to following along. Appreciate the details.
Man, really appreciate you having me today, Oliver. Thanks.
Yeah, good chat. Interesting business. Steve Brown, Chairman and CEO at Trinity Capital, ticker TRIN. All right.
The new report today slashing its 2023 global growth forecast to just 1.7%. That is down from the 3% forecasted. CNBC interview with David Malpass. President Malpass, welcome back to the show. Good to have you.
Hi, Sarah.
Not such a cheerful report you put out today. The global economy is perilously close to recession. What is making you so nervous versus where you were a few months ago?
Thanks. There's several factors. One is inflation stayed higher for longer than people had been hoping, and so interest rates are going higher. The capital access of countries gets and of companies gets cut off progressively as this process goes on longer. And we also, of course, have the energy realignment that's taking a long time to sort out.
The thing is, investors, aren't as negative as you might be sounding. On Twitter, someone wrote back when I teased that you were coming on, Caterpillar's trading at a record high. If the world economy was perilously close to a recession, would Caterpillar, a global industrial that tracks growth, be at an all-time high?
That's a good input to you. So Caterpillar works largely, has big markets in Asia, has big markets in the U.S. And one of the things my impression is going on is people are finishing projects that were funded some 6 months or a year ago. And so there actually is strong current demand that's showing in even in the GDP numbers. But the question is, what's it going to be in 2023? That's the forecast that we're looking at. And it looks like a sharp slowdown in most of the world.
China, though, is reopening. Are you not buying into that excitement? I saw you guys took down your China numbers as well by a full percentage point.
We did, but I think China is a key variable, and there may be some upside for China if they push through the COVID as quickly.
I don't know what's going on with this sound. Let's see.
And the dollar, we're at a 0% interest rate environment for much of the world for a decade or longer, and so there's lots of repricing that has to be figured out.
What is your expectation as far as when the Fed stops raising interest rates?
They'll probably stop after they're comfortable with the inflation expectations, and that depends somewhat. They often and talk about their models, and so I'll be watching how they do that. The 10-year yield you saw backed up some today from 3.5 to 3.6, and so you're seeing the market trying to figure out what the long-term resting rate is for interest rates around the world after. As I say, the dominant factor is over 10 years of near zero interest rates. Japan is still working that out because their 10-year yield is capped.
Yeah.
They have a price cap on it.
Do you think we've seen the peak in dollar strength for this hiking cycle? It's starting to come down pretty sharply, and that's been helpful, right, to the world economy?
Yes, it definitely helpful, and I think the best model is to have the dollar be strong and stable over the long run, and so if that can be achieved at the current level, that would be a good outcome. And the question of whether it goes up or down against the euro or the yen depends really on the rate of rate hikes in the U.S. versus those economies, and I think that is just going to depend on a lot on who produces more. If the U.S. could really boost a lot of production, then you'd end up with a somewhat stronger dollar, but a better growth outlook for the U.S. and so on around the world.
So bottom line, President Malpass, do you think the U.S. can come out of this without going into recession, the soft landing scenario?
I don't know why that thing keeps skipping out. So let me do it the other way.
Working very, and we will be with the world community about ways to have more resources, whether from inside the World Bank itself or from the global community. The developing world certainly needs big new sources of resources, sources of money, but also of investment dollars.
Got it. Thank you very much for coming on to talk through the forecast today, President David Malpass. Good to see you. Take a look at where we stand in the markets, up about 113 or so on the Dow. S&P 500 up 0.5%. It is going strong. And there's the NASDAQ. It's winning today, up 0.7%. Amazon, Meta, Microsoft, Netflix, NVIDIA, all driving things there. But also the strength in the media names. Warner Brothers Discovery now up 8% on the day. As far as the Dow, it's Visa, Goldman, and Amgen that's helping lift things higher. CVS reportedly looking to make a big expansion into the pharmacy healthcare industry, and it's sending shares of One Health Network sharply higher today. Details later on the show.
Hey, Marilyn. Welcome back. I'm thinking I'm going to swing my QQQ calls because I need it to be above 272.25 at least. 272.50 would be best. So I think I'm going to swing these calls. I got in around here and I should have got out and I didn't. Because it shot up real quick. It would have been a nice little scalp. And nope, just like that. And then it came back retraced. And this was the highest it got, which was 272.50. So if we could get back up there, that would be cool. No, I should have got out, Miss Vice. I should have got out right here. I should have got out. Yeah. But I'm looking at my daily and my weekly chart, and we'll see. I got some time on these contracts, so I think I'll be okay. But yeah, they really had hit my price target around, that 272.50. That was it. That was where I was supposed to get out. But I didn't. Yeah, they're up, but not by as much as I want them to be. Yeah. But I still got 10 days. This is a 10-day contract. So we'll see. It'll work itself out. We were expecting the Fed meeting, to yield some fruits. It was okay. It didn't have as much of an impact as I thought. Not like on past announcement days. So it's pretty calm today. It's pretty quiet. We're doing a little mini tutorial at 5 o'clock today. If anybody wants to join, it'll be me, Seal, and Bumpy, and we're going over just basics of Thinkorswim.
Check out today's stealth mover. It's Bumble. Investors are certainly buzzing about this stock. KeyBank showing some love for the online dating company, upgrading the name to overweight from sector weight, $27 price target, implying a nearly 35% upside from yesterday's close. The analysts, they're citing valuation mainly after last year's 38% sell-off in Bumble shares, as well as strong global online dating trends. Airline stocks flying high today, have been soaring to start the year. Up next, a top analyst on whether the sky's the limit for these stocks. That story plus Microsoft reportedly making a big bet on AI, and CVS may be eyeing another healthcare deal.
Thank you, living
all
the
when
dream.
We take you inside the market zone with the Dow up 120. That's next.
I take all of this advice. I promise you I do. I should be putting it in a jar somewhere. I have so many ideas. I should take all these little bits of stock wisdom and put them in a jar somewhere. That's a little book. I'm telling you. Stock wisdom. Right there. That's a book. Somebody do it. Yes. Yep. And for whatever reason, most of the day, the news has been kind of spotty, coming in and out. I don't know. I got a lot going on in terms of my internet. But it's such a nice day here today. So if anybody wants to join this study session at 5 o'clock, just email me or just let me know in the comments, and then I'll send you the Zoom link. At 5 o'clock, it'll be me, Seal, and Bumpy, and we're just going to be going over. What are we going to go over? We're going to go over just some basics for Thinkorswim. Seal and I did a session last night, so yeah. Wow. Yeah. I like that. Yeah. Thank you. I need to take a picture of that. Y'all know that's how I get stuff. I take a picture. My phone is full of all of these, all these little gems. Okay. I got a picture of that. I know it's the easiest way to do it, Elle, to just grab it on and in your phone. You always have it. It's even if it's like saved to the cloud. Yeah, I'm telling you, I'm really starting to catch on. I'm learning to Google everything. Watch these kids how they use those phones. They Google everything. They YouTube everything. So I'm starting to do the same thing. Okay, y'all, look. Q. She loves me. She's on her way up. She better. She could do it. I need her at 272. I would take
We are now in the closing
272.50
bell
to
market
be
zone.
honest with
CNBC
you.
senior markets commentator Mike Santoli here to break down these
Yeah, I
crucial
would take
moments of the trading day. Plus,
272.50.
Jeffrey Sheila Kayalu on Boeing
be
and
out
the
the
airlines.
door.
UBS Private Wealth Management's Ali McCartney joins us on the market strategy. First up, though, let's look broad. We've got the Dow up 114 points right now. The S&P up 0.5%. Mike, it's easy to see the case for the bulls and for the bears.
Yeah.
For the bulls, this market has priced in a lot of bad news. And inflation, if it really is coming down in a meaningful way that the market is expecting and seeing, then the Federal Reserve should pause at a time where China's reopening.
Okay, you do know
We
we're
haven't
screen
yet gone into
grabbing
a
all of
recession.
these, right?
That's a good thing. On the other hand, Fed's not even saying that.
Yes.
That's exactly right.
Thank you,
And
living
of
my
course,
dream,
in
trading.
theory,
Thank
could
you.
also get
Yep,
a
you know
bit
we
of an upside
screen
surprise
grabbing
on
them all.
inflation, even though all the indicators say you really do have
You
a
will
good
be in our book
downside
of trading
push
wisdoms.
in inflation measures. You never know what one number is going to look like on Thursday. I think the way the market is trading right now, it's been a relatively broad rally to start the year. You've had kind of the rank and file stocks doing better than the headline indexes. There is some of it just picking up the losers of late last year, of course, but the market is remaining open to the chance of getting lucky. I really think that's what it is. Now, you could say that means there's not enough of a margin of safety. We haven't really priced in a dire scenario. Therefore, why would you buy? But you never know along the way whether, in fact, things can turn out better, especially when economic growth has seemed like it held up rather well late in 2022.
I've seen it greener than
Let's
this,
zero
though.
in on Boeing. It's underperforming today, but finished 2022 on a strong note, delivering 69 airplanes in December, booking just over 200 new orders. Full year deliveries and net new orders were also higher than in 2021. Let's bring in Jefferies analyst Sheila Kayalu to discuss. She's got a buy rating, $240 price target on this stock. Talk us through the delivery numbers, how they compared with street expectations.
Look
Thanks so
at
much,
that.
Sarah. So it was a
Look
good
at
December
that.
number.
Look at that
We were
bounce.
skeptical of whether Boeing could meet its deliveries. but it hit its
Y'all
target,
see
and mainly
that?
on the max. So it delivered 374 maxes in 2022
That's
versus
like
its
bounce.
forecast or
Just look
guidance
at
of
it.
about
Just bounce right
375.
off of the
And we have that
50.
number going up to
Bounce off
425
of this
by
price level.
2023. And why that's so important
Trading
is each
in this
max
little
figure is
range.
about 10 million of free cash
I
flow
don't know.
per
I don't
plane.
want to
So it's really
oversimplify it.
getting them to their target.
But
And
look
their
at that.
23
That
target,
is
as a reminder,
crazy.
is
That's
3 to
definitely
5
a
billion
bump
of
off
free
of.
cash
That's a
flow
bounce for
generation.
sure.
So doubling what it
And
did in
look at that.
2022.
So where does this set
That's
up
what I
Boeing
love. Look at
for
that, y'all.
this
There's
year, especially
math in
against
here.
rival
There's
Airbus?
science here. This is,
Well,
you know,
Boeing and Airbus
in my
actually have very
mind,
good
I see
orders
that
and
there's a,
delivery. So if you
yeah.
look at orders, they were double the
Love
delivery numbers
watching
for
it.
a book-to-bill of
Love watching
1.7
it. What
times
we got
in
going over
2022.
here?
And we've seen a lot of incoming requests for what other airlines following United's order could order more aircraft. And China, as a reminder, hasn't ordered a single aircraft since at least 2018. So there's order momentum. But the two things we're watching for giving Boeing momentum this year is the 737 MAX production rate. It's currently at 25. It's set to go to 50 by 2025. They need to get incremental step-ups there to 31 by the end of this year. And also the 787 rate. The 787 just restarted deliveries a few months ago. So Boeing had a good December delivery number, but it hasn't really ramped up production rates there.
Let's talk about the airlines, because you also cover them, and they have
Okay.
started. We
No, if it gets up
noticed
to
very
270,
strongly
250,
here
I'm
in terms of
out. I'm
performance
out
in
the house.
2023 after a rough
That's
end
that's
to
my price
last year.
target.
What is
That's where
the
I could
outlook?
definitely get off.
Are investors looking for a slowdown in,
It was up there
in travel
too.
spending or not?
I don't know what I was doing.
We're quite skeptical on the airlines. The momentum thus far this year is because the airlines are trading at a 20% discount to their historical average. So airlines got really beaten up at the end of last year on two concerns. One is ongoing costs. Costs are slated to be much higher. We just saw Spirit Airlines hit their pilot agreement where salaries are increasing 34% over the next 2 years. So costs are a concern for the airlines. And second, we're worried about pricing coming in. We're just talking about inflation. Pricing in Q4 is set to be up about 20% for the airline carriers.
I am so
and we
sleepy
forecast that coming
today.
in,
That's why I'm
with the
MIA, y'all,
Japanese
because I'm
economy is
over here
forecasting a
halfway
hard
taking a
landing at
nap.
the end of this year.
I am
So,
on the couch. That's what I love
we're
about
forecasting
trading. I'm
pricing coming
sorry.
in. And
I'm
the
telling
third
the whole
headwind
truth
for
and
the
nothing but the
airlines is,
truth.
of course, the operational issues
I
at
am sitting
Southwest,
on the
as well
sofa
as
with the
all their free cash flows
screen
going
doors
towards
open.
new
It's such a
planes that they
beautiful
have to buy. So
breeze.
it's positive for
Oh my
Boeing, bad for
goodness.
the airlines.
I advocate this
But on the
lifestyle
flip
for
side,
everybody.
China reopening, big source of international travel demand.
We view that as a beneficiary actually to the commercial airospace name. So on a
What
China
are we doing?
reopening play, we would buy
21.
Boeing and
See, I'm
Spirit,
telling you,
a big structures
my friend.
manufacturer, as well as
Jump on up there
HEICO,
to
an aftermarket play
270,
that's not
250.
well known, but
Hold
is
on
a
tight, y'all, because I
spectacular
might be able to come out here
investment in
before
our
the day
view.
is
So
done.
the airlines
Hold
on
tight,
China
peeps.
routes, United would
Don't
be
go
the best player,
anywhere.
but it's only 2% of
She is
sales
my
overall,
friend.
and actually very low margins given they compete against the state-owned carriers.
You're not buying it. Airlines up 14.3% to start the year. One of the best performing S&P subsector. Thank you, Sheila. It's good to see you. Sheila Kayalu. Let's talk healthcare. Look at shares of Oak Street Health soaring on a report that CVS is exploring a deal for the company, which provides primary care for Medicare recipients. That deal could be worth more than $10 billion. Bertha Coombs joins us.
32.
CVS
Look at
in another
QQQ.
speculation here for a deal.
Oh
It's been
my
it feels like a
gosh.
string of these
That's
over the last year or
crazy.
so. What's the
30.
strategic interest here?
It has been. You know, basically all of the pharmacies are looking to grow primary
Just
care
I'ma
as a way
play
to keep
right in
people
your
coming in,
face.
not just for prescriptions, but also to give them other services, particularly for Medicare patients, to really wrap a
play
bunch of
right in
services
your
around for them to
face.
keep them coming and keep them engaged. And for CVS, especially with an insurer, Aetna, that makes a lot of sense. Last summer, we heard that they were in the hunt for One Medical. Amazon took them over. Then they bought Signify, which is a health assessment. And now we're hearing that they may be in talks here with Oak Street Health. Now, Oak Street is one of the better performers in this Medicare primary care space. Although they're not profitable, the company did give a bullish outlook for 2023. They expect to grow from 150,000 members to over 200,000 members this year. They have more than 160
I don't know if we're gonna have
shops,
time, but it
clinics
can
where
get
they
up
treat
there.
these members. So they do have an
We gonna
infrastructure, and they
see.
also have that technology. That's what CVS is looking for. At JP Morgan today, Karen Lynch said they're still exploring their options. And one of the things we have to think about here, Sarah, is that it may not necessarily be some of these publicly listed companies. There are also some private options that they might explore, companies like a City Block Health or others. They are basically saying they might build something rather than necessarily just buy one piece.
Well, it looks like investors are giving their approval. CVS Health only down 1%. Bertha, thank you. Bertha Coombs. Microsoft, speaking of deals, reportedly investing $10 billion in OpenAI. That is the parent company of the popular chatbot ChatGPT. The investment, part of a new round of funding that values OpenAI at $29 billion. Microsoft declined to comment on the report. Steve Kovac joins us. It's interesting, Steve. What does Microsoft get out of this?
Yeah, what they get out of it is a really cool tool, Sarah, that can boost a lot of their
Does anybody
existing
know
products.
how
So
to use
obviously, when we all started
GPT?
ChatGPT botting, we thought, okay, this would be really good for Bing search.
Yeah,
Yes, and
Marilyn,
that's
I
a
only
threat to
took one
Google.
trade.
But beyond that, there's a great
Nope, no
report in the
overtrading for
information
me.
this weekend talking about how Microsoft plans to
And
inject this
I'm just
technology
relaxing. I'm
into
sitting
their
on the
office
couch.
apps. So Microsoft Word, PowerPoint, Excel. So imagine, telling Microsoft Outlook to, find me every email Sarah Eisen has ever sent me, for example, or draft an email to Sarah Eisen about doing the Market Zone segment. So they do have some tangible
There it
plans for
is.
this. And you can just
She's
imagine it
up.
helps Microsoft more than just user-facing stuff, but also people, their back-end engineers, their IT people who
you
are
can do
literally
it.
coding Windows. This is also a tool for them to use as well. And basically, they get in on a really hot technology that appears to be further ahead than even something that Google has been able
Y'all
to
see
come up with,
QQQ
Sarah.
shooting up.
It is impressive if you haven't tried
Yeah,
it.
it's great.
Just
funny.
what this ChatGPT can actually do. Steve Kovac. Steve, thanks.
Thanks.
Wanted to ask Mike about Microsoft. It's up 0.5%, so it's actually underperforming the market right now. A lot of people are watching Amazon, Apple, and Microsoft really on the recent weakness as market leaders. What have we seen in these comeback days?
Well, yeah, they've certainly underperformed. They have not been the area where people have rushed to pay up for still premium valuations. I think that, as a stock, Microsoft still probably has
Look
a
at
little
it
more
shooting
work
up.
to do to come back into line
272.70.
valuation-wise with where the overall market is, where growth rates are. It's not expected to have particularly impressive earnings growth in the current fiscal year. But bigger picture, I mean, this proposed or possible deal in AI is almost exactly why strategically Microsoft has been this core holding for so many people, because they can integrate almost anything that happens in technology, spread it across their portfolio. It's a $1.7 trillion market cap. $10 billion is nothing to throw out there
I'm
if it
getting
can
out.
be an enhancement. So it's kind of a good long-term story, but right now the stock feels as if it's just not where the market's fresh money wants to head.
Well, we've got 5 minutes into the close, and we are seeing some strength. We're actually at the highs of the day.
Did y'all
Certainly on
see
the
it shoot
Dow,
up at the
Caterpillar
end of
adding
the
most. Look
day?
at that, up 184. Also on the S&P
Oh
and the
my
NASDAQ, which is
gosh.
outperforming. Allie McCartney joins us, Managing Director
That was
at
nothing
UBS
but
Private
pure,
Wealth Management. Allie, you've been
just.
pretty cautious all of
QQQ
last
is my
year, really,
friend.
on the Fed hikes and the
Did you all see it?
economic
Let me
forecast.
show
Are you
you.
telling your clients anything different to do right now?
I think that's a big thing that's changed, Sarah,
She
is
shot
that
up.
it's 2023, not 2022.
That's
and although
crazy.
for all of us, having gone through one of the worst years in the
That's
history of
crazy.
being an
Yep.
investor, it's really tempting to want to collectively exhale and start to lean into
And
markets
look, I think
and
she's
think
still
positively.
going.
Now, you were just talking about the optimism that's been fueling the last couple
Oh
of days
my
of
gosh,
trading,
she's
the
still
beginning of the
going.
year. And mind you, we are almost exactly a year out from the historical high on January 3rd last year. And that's based in the steep decline we saw in
That was
the ISM
almost
number,
the
the early
high
signs
of the day. Almost.
moderating inflation,
The
most
high
specifically and most
was
important, the hourly earnings. That is moderating.
272,
But as you
like
said, it's
92.
completely at odds with what the Fed is messaging to us. And so while I came on a number of months ago and said, unfortunately, I think
That was
it's early
crazy.
for a pivot party, I think it's still too early for a pivot party. I think
That's
investors, it's great to be
crazy.
optimistic. And I think we're going to have more clarity through the next earnings
Yeah.
cycle and through the next two Federal Reserve
That
and
was right on
CPI
time.
prints.
But markets and investors
But sometimes
are
that's how it
famously
works.
fickle and
I
fragile.
think she's gonna
And I
surpass
think
that
that staying
the daily high
defensive,
too.
building cash,
Let's see.
leaning
Oh,
into
look at it.
quality right now
She's
with
up to
a
70.
shopping list is the way to go.
So let's talk about then what the strategy should be. Should you still be leaning defensively? And if so, what does that look
72.
like? Is it
Go,
cash?
girl,
Is it
go, go, go.
utilities? What do you like?
Oh yeah, she's
So
on her
first
way.
of all, I think when you look at fixed income, I think you have to put cash now because of the level of returns and the shape of the yield curve in that bucket. And so if you are an idea with largely extraordinarily taxable investors, and you can get the kind of rates, especially state and local tax free, that you can right now for short-term treasury paper, that's super interesting. And it buys you some time to see what happens and what happens with credit spreads in the market. In addition, on the active sort of looking for equity exposure, you led the segment talking about healthcare more in consumer discretionary.
No, I wouldn't have played it that close.
About healthcare, there's a place you can hopefully have your cake and eat it too. We're talking about from a demographic
Closing bell,
perspective,
we
it's one of
made
the
it. Another
fastest growing
profitable day,
defensive
folks.
sectors there is. From a valuations
Another profitable
perspective,
day, everybody.
Oh, sorry. What were you gonna say?
No, I was just going to say, relative to both the broader market
That was
and
crazy.
to other defensives, it's
Yeah.
still undervalued. And so
You
that's
never
a
know
place
how
you
it's
can
gonna break,
lean
you know,
in
at the end of the
during
day.
what might
That
be
was so
a
cool.
potential deceleration and recession,
Yeah,
but also
broke it.
even into all the positive that we're going to see, hopefully, at the
Look
end
at
of
it,
2023 and beyond.
272.82.
Allie McCartney, thank you very much. Good to check in with
Oh
you
my
on your
gosh.
forecast and what you're telling clients.
But I
this
never
year
would have played it
from
that close. I
UBS.
never
Mike,
would
what do
have
you see in
held
the
it
market
that
internals here
long.
into the close?
They've been strong, so about 3-1 advancing to
But that
declining
was a
volume.
nice
So
little,
that's
that was a nice little
consistent
pop
with
up
how
at the end
most
of the
of
day.
the first 6 trading days have gone. Take a look at the material
Yay,
sector relative to the
everybody.
market the last few months.
I'm
It's
so
really,
glad we have this
opened
time
up a
together,
bit of a wing
everybody.
here. Hard assets oversold.
I got to
You
get
have
prepped
China
for this
reawakening, things like copper
tutorial.
running pretty well. The volatility index very subdued. We're down by 20. We have the CPI coming
And then we're just
in
saying,
a
notice
couple
how
of
it
days,
broke
and yet still this very
and left
gentle
the
index
bottom
behavior is
tail
allowing
on
volatility
that
to drain
red
out of the tape, sir.
candle.
Dow is up
The low of
191
that
points. We're
candle
at the
was
high for the day here into the
272.51.
close. You've got
That's
Goldman
what you
Sachs,
want to see.
Caterpillar,
First of
and
all,
Amgen
I'm about to
adding the
take a
most to the
picture of
Dow
that.
rally right now. The S&P
I'm about to
500
screen. I'm
up
about to
0.7%
capture that so I
Every
can go
sector
back and
higher
study
except for
everything
consumer
that you're
staples.
saying.
The leader is
Because I'm
communication
telling you
services on this
all,
big rally in the
I go
media
back
names.
and
Warner
look at
Brothers
all of
Discovery.
this.
I
You
keep
know,
mentioning
I
it,
look
up
at
some
charts all
8%
day.
now at the highs
So I'll go
of the
back
day,
and look at
whereas
like
just
my
about all the other
entry
stocks are
and
as well.
where
The
I should
Nasdaq
have gotten
outperformed
in,
today.
how I
It is
could have,
up
you know,
a full
really it was a
percent.
scalp
You've
gone
got names
bad,
like
y'all.
Amazon
It was a
adding a
scalp.
lot to
It
the
had shot
S&P
up. I
and
should have
to
got out.
the
I didn't.
Nasdaq.
That's the
You've
story
got
of my
trading
life.
some of the chip names as
And
well.
so,
The Nvidias
but
and
it redeemed
Microsoft,
itself in the
Netflix,
end.
Apple also adding to the Nasdaq gains.
Yes,
Tesla under
it's
pressure. That's it
jumping.
from me on Closing Bell. See you tomorrow. We've got the CEO of
Got in
Kroger,
past
Rodney
my
McMullen, on
entry
the
and
show
theta
tomorrow.
started
Now into
munching.
overtime with
Yeah.
Scott.
Okay, I'm looking at my email now. Anybody? Oh, let me turn this down. I'm going to do a 5 o'clock Zoom. So if anybody wants to get in on this 5 o'clock Zoom, email me now, because once I get off of here, I'm going to send that Zoom link to anybody who wants to. We're just going to be practicing, you know, just some basic stuff. How to set up our Thinkorswim, you know, how to move around, maybe do some paper trades. I got to check on Marilyn. We did some paper trades with her yesterday. So, Marilyn, I will absolutely check my email. And that's it for today, folks. All right, y'all. I'm out. I'm about to take me a quick nap, and I will see y'all at 5 o'clock. Adios, folks. Bye, fam. I'm checking my email now, Marilyn.